hybrid work model. Do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
From New York City,
in London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
He's
story.
there, the kind of upside.
We're probably going to get, core PC inflation below 3% by the second quarter of next year. It's not like we're talking about, sometime in 2025. We're talking about in 1 or 2 quarters, 1.5 quarters. And suddenly, perhaps, real rate, the real federal funds rate, is then going to be way, way, way too restrictive. And then the market and the Fed can start talking about rate cuts. You're actually going to continue seeing a pretty Goldilocks-y environment.
What is a Goldilocks-y environment?
I know a lot.
Call Max Kettner of HSBC. He'll tell you. He says Goldilocks is back. Welcome back. Thank you for joining us. Your equity market on the S&P positive by 0.1%. Here are the scores going into CPI in America. The 10-year yield lower by a couple of basis points, 4.6142 on a 10-year maturity. In the FX market, the dollar just a touch weaker, euro stronger. Tom, for a third day, the euro positive here by 0.2%, 107.21.
Lots to talk here on FX. Euro 107. Lots going on, and with Jeremy Stretch coming up, that's important. John, I'm sorry. I was looking up Goldilocks. I didn't know she was an intern at Morgan Stanley a few years ago. Worked with Steve Roach.
Is Goldilocks right in the outlook now?
Yeah, she had to deal with Steve Roach. Now she's
She grew up.
She's looking for a soft landing.
She's all soft landing, I think.
Okay.
I'm hearing way too much Goldilocks. That's like V-shaped. What's this about?
It means something different to different people. I remember when a soft landing was just below trend growth without a recession. Isn't that, Bramo, what a soft landing was? Isn't that what it is?
Well, now people are adjusting that, redefining it as simply a shallow recession is a soft landing. Anything is a soft landing that isn't a bigger than expected recession, essentially.
Okay.
That's my sense.
So the unemployment call within that, I think that was the key differentiating factor in the outlooks. We were looking at Morgan Stanley versus Goldman Sachs. The outlook for unemployment,
yes,
Goldman has still got it low going into
Right.
2024.
When
with
does,
inflation getting back to target, the Federal Reserve not cutting.
This goes right back to Julia Coronado when it was her arch call on American productivity. The fact is, everybody's been wrong on a failed job economy in 2023, and there's something John, it's a mystery. Nobody here has an answer as to this machine of labor known as the American economy.
Things are starting to change. The data's starting to shift just a little bit in the labour market.
No question about it.
Deutsche Bank going as far as saying that the data remains broadly consistent with end-of-cycle dynamics. Whether you agree with them is your judgment. That is up to you. But, Tom, we're starting to see that shift. Claims starting to move out just a touch. It's so subtle. Delinquency is starting to rise. This is why this week, by the way, is so important. You've got retail sales, you've got CPI, you've got all the retailers reporting as well. Are we starting to see that slowdown arrive in 4Q, or is it still too soon?
And there's going to be managed cost cutting among those ginormous retailers. Again, we forget the size. I mentioned Home Depot. I think it's 400,000. Let me look up Walmart right now. You can do this on the Bloomberg Professional service. Walmart, 2.1 million employees. I did not know that. That's
not just about the employees, but also the people shopping there as well. They've been talking about trade down for so many quarters now, Tom, attracting customers from elsewhere.
Can you imagine their summer party?
At Walmart?
At Walmart, 2.1 million.
Is that a festival? I think that's a festival, isn't it?
It's a festival. It's like Woodstock.
Like Burning Man.
They show up. It's fascinating. With futures up 2 year, and yeah, I'm very Burning Man.
Burning Man.
Totally. Yeah, like in a really
suit and a bow tie.
Special bow tie.
blowing fire.
All right, in a really nice
I
RV.
can see that. That works for you.
Luxurious RV.
You should do Burning Man next year.
Can we get the countdown clock up here on radio? You are
If you
so
get stuck,
lucky
I'll
on
rescue
radio
you.
that you
you
don't
won't.
have the CPI countdown clock.
In the mud.
I mean, radio deserves their own countdown clock. Well, we've got one. It's somewhere. It's lost in the control room somewhere. Right now, saving us, Jeremy Stretch. He is international strategist, chief international strategist at CIBC. Jeremy, I'm going to do an audible here.
Good morning, Tom.
On the inflation that's out there on this inflation day. And I look at Japan is the worst offender with a 5% plus nominal GDP and a national CPI of a stunning 3.3%. If and when Japan disinflates, what's it mean for our inflation? What's it mean for our listeners and viewers in the West?
Well, I think you've raised an interesting point there, and I think that's one of the variables that we've been trying to rationalize and deal with over the course of the last decade or so is the impact of goods price deflation or exporting of disinflationary pressures from both Japan and to an extent over the period in China as well. So if we do see a gradual reversal of that negative inflation dynamic in Japan, which I think is still a story for 2024 if we do see wage growth picking up, then that may have a little bit further of an inflationary impulse for global markets in terms of global goods prices. But I think it is still this broad sort of generalized moderation in price pressures that we will see over the course of the next few weeks and months. The question is, how long does it take to get back to that 2% inflation threshold? And I think in that context, we have to have patience because it does still feel more likely it's going to be nearer 2025 than it is in 2024.
What do you hope to learn from the 8:30 inflation report this morning?
Well, I think obviously we will be looking to see the path of the trend in terms of core prices and to see whether that 4% threshold can be breached. I think there is an obvious significance in terms of breaking down through some key significant levels. We will be looking for the sub-indices in particular in relation to things like the rental market to see how that is playing out, to see how the lagged impact of this policy tightening is playing out, because of course there is still that obvious inference that we've seen this aggressive degree of policy tightening, not just from the Fed, but in pretty much all global markets ex-Japan, and yet we haven't seen an opportunity for the central banks to identify how their policy mechanisms are playing out. And that sort of plays into the Friedman's fall in the shower narrative, that there is still this risk that policymakers are still very mindful of, still thinking about the possibility of some cases turning up the dial, and what would that do to the policy narrative in view of the obvious policy lags.
And for now, though, the narrative does seem to have shifted yet again this year, probably the 432nd time this year. But there is this question now of just how much people are set up and prepared for us to have seen the peak in yields, the peak in inflation. And is the bigger surprise, and this is my question to you, Jeremy, is the bigger surprise for markets derived from this print if it's an upside surprise or a downside surprise, if the inflation read comes in hotter than expected or weaker than expected, which would generate the bigger response in markets?
Well, I think there's certainly been some whisper rumors that perhaps the risks are more to the upside. I think it's interesting when you look at the Michigan inflation expectations components from last Friday. We did see a significant uptick in both the one-year and the long-term inflation dynamics. Now, that perhaps is a reflection of the spike that we saw in gas prices back in October, and that hasn't perhaps dropped out of the system yet. But I think there is more of a risk in terms of a top-side surprise as far as today is concerned. We're still very mindful that there is a residual risk of the Fed still having one further hike in it, and I think the Fed will be very keen to maintain that policy optionality in the context of the inflation backdrop. So I think in terms of December or January OIS pricing, I think there is scope for a little bit of an uptick, and I think that's the sort of the narrative that I would be very mindful of going into today's print.
And what does that mean for the dollar?
Well, if we do see those repricing of expectations, that we're only pricing them at 4 or 5 beats for December currently, and if we do see just a gentle but progressive uptick in terms of those expectations, then I think that should provide some dollar resilience. You've already talked about the euro looking a little better bid this morning, but I think I'd still prefer to be selling euro rallies up to the sort of 107.5 level, because I still think there is a degree of skepticism regarding the euro recovery narrative. And I think that would provide resilience in both the DXY and the broader Bloomberg DXY indices over the course of the next few sessions.
Jeremy, thank you for your view going into next year. Jeremy Stretch there of CIBC. On the dollar, here's a guy that agrees with him. We talked about Max Kettner over at HSBC. Here's the Fed view. First cut, Q3 2024. Here's the Treasury view. It's likely the next 100 to 150 basis point move in yields is down and not up. Here's the dollar view. We expect the dollar to remain strong in 2024, aided by soft global growth, Lisa, and comparatively higher yields in the United States.
This is what I find interesting. Max Kettner was talking about Goldilocks, and Goldilocks includes fewer rate cuts than some of his compatriots over at UBS. This is calling for more strength, but just enough weakness to give that little bit of a confidence to the Fed to cut rates just a little bit.
Sounds like a recipe. Doesn't it, right?
We've got a lot of recipes
like
in this show.
Cooking channel
Exactly.
on this show. Coming up, more on that. Stuart Kaiser of Citi is going to join us on the equity market. Whether to be constructive, Tom, going into year end.
Well, it's good to have Stuart Kaiser. He's been absolutely dead on about you got to participate in the market. That's half the battle. Can you believe the wides of BNP Paribas and Yardeni Research?
Wow.
It's
spread
like
between the two.
1,500 SPX points. On the break, I'll do the math on that and what that means in equivalent Dow Jones Industrial Average points.
At this point, if we ask the question, is there a consensus for 2024? I think it's fair to say right now there isn't one.
It's going to keep us employed on Bloomberg surveillance.
I heard someone say Dow points. I'm just choosing to ignore them. Stuart Kaiser of Citi, coming up next.
Season is here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power.
We're going to make more money. We're going to make more money. And we're going to make more money.
They're making bank, and I think that is what we can take away.
Bloomberg Television and Radio. Context changes everything.
So many people say the only way to really deal with climate change is kind of eliminate oil and gas and then have more clean energy. Is it realistic to eliminate oil and gas in the foreseeable future?
You actually have to at least mitigate it. I think you have to bring a lot of it down and replace a lot of it, but you also have to, you can also have a huge impact by trying to do things like carbon capture and so forth, right, and around it. And it's going to take both approaches. Even today, greater than 80+% of the way the world operates around energy right now is still fossil fuels, you know, when you kind of look at it. And probably what's more striking is the fact that the demand for it is going up every year.
Things like solar or wind, it's nice and environmentally friendly, but really it's not going to be produce enough energy to really replace oil and gas in my lifetime, I assume, right?
Well, not by itself. So let me just say, solar and wind are critical components. You need, this is going to be sort of a collective effort with a lot of different technologies that are each going to come in and take their piece. What we do at Breakthrough, we look at technologies that could produce half a gigaton, remove half a gigaton of carbon a year. And the way to think about that number is we have to remove, say, 100 half a gigatons, you know, a year in terms of what we have to replace.
On the next episode of the Business Week Show.
Reputation. People say, oh, well, LeBron gave you an opportunity, lucky you did this. But you don't talk about Donald Trump's dad gave him a loan, James Dolan's dad gave him a business. What's the difference?
I try not to care too much about what people think, and if that helps others see that there's more to life than a good reputation, that can be a positive step.
Watch the Business Week Show, Thursday nights, 10:30 Eastern on Bloomberg Television, or 8:30 on Bloomberg.com, or the Bloomberg app on connected TVs.
DOJ or other authorities
Could face bigger challenges next.
Fed was going to keep rating World Cup. This is a 3
As the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We're expecting a growth slowdown pretty much like the rest of Wall Street at this point.
We're not talking about a recession anymore. We're talking about a very soft landing.
It's going to be pretty fine if we're going to be between 1% and 2% GDP growth.
There's so much yield enhancement in this market that it's suppressing volatility, even on the equity level.
We're not in a recession. Look around. The economy is still growing.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Your trading week begins this morning, live from New York City. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio, alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market positive by 0.1% on the S&P 500, 90 minutes away, TK, from U.S. inflation.
The inflation report critical, and I'm going to go to the 10-year yield just simply as the benchmark off of a difficult auction last week. Thank you, Bramo. For that, the 2 standard deviation study, the trading envelope, John, is going to bring that yield down to 4.46% if you get a move within a trend. Right now, in 2 basis points, 4.62%. That gives you an idea of the potential we can have of an 8:30 shock.
We've got to do a few things this morning. You take the economic data, push it through the Federal Reserve. What does it mean for them? Work out what it means for financial markets, and then get to politics. This from Politico this morning. Some private polling presented to the White House in mid-September and recently obtained by Politico. 7 out of 10 people surveyed believed the economy wasn't getting better. Lisa, even after they were told explicitly that inflation had eased and unemployment was near record lows. Bidenomics is not breaking through.
Here's a comment from one of the members of the campaign staff. When we intentionally put our finger on the scale and 100% of people hear good economic indicators before saying if the economy is going well for them, we still get walloped. That frustration endemic in some of these comments that it doesn't matter what the facts are on the ground. People are not feeling good, and that's being reflected in President Biden's poll numbers.
Is that going to change 12 months from now? Where are we going to land? I don't know. Where do people think we're going to land? The fund manager survey out of B of A, worth going through again, Tom. 76% say the hiking cycle is over. 61%, that's a record in this survey, expecting lower yields from here. And just 6% see higher CPI in 2024. A lot of people writing in about that, Tom. Maybe that could be the pain trade next year. If just 6% think CPI will be higher next year.
The pain trade to me is what does incomes do? And, you know, we've seen this with the view of what is cumulative inflation back to 2019. Nobody's going to talk about that at 8:30 this morning. 110% of our audience is living the cumulative inflation rate because incomes for many people, not all, have really not kept up.
You see that in consumer sentiment, Tom.
Yeah.
They don't feel good right now. We'll find out what they're doing. We'll get retail sales tomorrow morning. Then we'll hear from the retailers throughout today. We've had Home Depot. Tomorrow, we'll get Target. After that, we'll hear from Walmart as well. So a decent snapshot of retailers in America coming up over the next 48 hours or so. Here's a snapshot of financial markets at the moment. Equity's just about positive on the S&P by 0.1%. Yields dropping, pulling back by 2 basis points here on a 10-year maturity, Lisa, 462.21. And the euro just a little stronger, dollar weaker here. Euro dollar, 107.19.
You just said something, and I want to sit on that when we look forward to U.S. CPI, which is the biggest pain trade next year, may be that we don't see a massive disinflation. At 8:30 a.m., we get U.S. CPI, and it is not going to show a massive disinflation, at least when you strip out energy and food. You can actually see that stickiness, that coming down to 3 to 4% inflation in the U.S. on an average annualized basis, not the 2% that the Fed wants, 0.3% month-over-month expectation, moving in the wrong direction. Is this idiosyncratic, having to do with healthcare issues, et cetera? That's what we're going to be talking about in about 90 minutes' time today. Fed speakers will also address this, whether they give insight. We shall see. Richmond Fed's Tom Barkin at 8:30 a.m. Bang, counter-programming. Maybe he could do a real-time live commentary on the CPI report. Fed Vice Chair Michael Barr at 10 a.m. Chicago Fed President Austin Goolsbee at 12:45 p.m. How much has their rhetoric underscored this new consensus in the market that bonds are a good bet, that the Fed is done, and that the next move is going to be a rate cut, and that they're really setting the bar much higher to raise rates yet again? And today, We're looking at San Francisco, and not just because they cleaned it up for the APEC summit, but also because the CEOs
That's
are
exactly
landing.
why I'm looking at it.
I know you are. I know you are. And actually, you're right, too, and we could talk about that later.
Sure.
Because that actually is a big issue for a lot of cities, and in that one in particular. But 9:30 p.m., there's a CEO summit, a welcome reception. And I'm actually really interested to see who shows up. The confirmed guests that we know so far, Citigroup's CEO Jane Fraser, Darren Woods of Exxon, Satya Nadella, the Microsoft CEO, Elon Musk, not a big surprise of Tesla given how much business they do in China. The coveted seats at the dinner to be had with Xi Jinping. Very interesting to watch to see whether they get the confidence they're looking for to possibly reignite their effort in the world's second biggest economy.
I said this yesterday. Can she come to New York? Just help Eric Adams clean things up a little bit.
What do you want to see most of all?
I can't sleep. It's amazing to me. Okay, look, I know everyone does this. I know everyone does this. Pick a city, pick a country. Whenever they host an event like this is what they do. But doesn't it speak to ability and not willingness? They can do this. Why haven't they been doing it for the last several years?
It's a good question. I wish I had an answer for you. I wish that we weren't getting used to things like stains of garbage on the ground and sort of rats and all of that. And I don't think anyone needs to be hearing this. It's breakfast time. Good morning.
I saw a picture of CVS, and they're now putting pictures of toilet rolls on the shelf so the staff can go out the back and get them.
You're just trying to wind me up. You know how much this bothers me.
I think it winds everybody
because
up.
basically this is just a breakdown in the social contract.
Exactly.
And that's part of the problem.
Bremo, society in decline. We'll have this
I'm not
conversation
going to go that
later,
far.
right?
Let's be hopeful. Come on,
Stuart
I'm going to be
Kaiser
optimistic.
joins us now, head of US equity trading over at Citi. Stu, we're not going there, don't worry. We're going to talk about stocks. Good morning
That's quite
to
a
you, mate.
lead-in. Thank you for that. Thank you for that.
Why are you comfortable being long equities right now?
Because we're comfortable with volatility, unlike everybody around the table, I guess. But I think big picture, we still think the macro backdrop is pretty good. If I had to really simplify it down, I think if the labor market and services spending is holding in, then you can be comfortable running long equity risk. Momentum tends to do well into year end. We think that's going to kind of repeat itself this year as well. Rates have kind of, let's just call it, calmed down a little bit. We think that'll help a little bit as well. But as you know, our core view this year has been the underlying macro is positive, and you kind of want to be net long equities in that environment, and that remains the case, especially the Dow.
You said, if the labor, I'm leaving that there. I'm leaving that there. You know that winds me up. TK is just doing this for you. Wants to talk about Dow points. Okay, do you have a Dow forecast?
Of course, yeah, 36,000. I was just looking at it on Tom's screen, actually.
Stop it. You said, if the labour market held in, is it holding in?
I think it is. It's strange that people have tried to talk about the last labor market report like it was super weak. I mean, if you take out the strike, it was 185,000 jobs. The previous, even on a revised basis, was almost 300,000. So, I do think the labor market remains pretty strong, at least strong enough, to keep equities moving higher. Yeah.
If we get Kaiser optimism, do we get a better breadth, or do we get a repeat here of 20 stocks and pick and randomly lead the way?
Into year end, we think it's going to be pretty narrow leadership, and what's worked year to date is going to kind of work for the next couple of months. I think the rotation discussion is much more a 2024 discussion, or a broadening out is much more a 2024 discussion. Scott Kroner, who is our U.S. equity strategist, a key part of his forecast next year is a broadening out in earnings. This year has been very narrow earnings growth. Next year it'll be broader, and we think that helps exactly what you're talking about.
But with disinflation, do you get a weaker top-line revenue off of a weaker nominal GDP?
It's definitely possible, because what surprised the bear case this year was that earnings were nominal. So I think we've been reminded of that. Next year, if you do get a slowing of inflation, it could put some pressure on top line. And the question then will be, how do they manage that from margins perspective? Are they able to maintain margins if revenues are a little lower, given that they've, a lot of the wage growth has been pushed through, and that's pretty sticky.
But at least if Walmart is 2.1 million, round it down to 2 million because it's television. If they got 2 million, I think that means they can fire 100,000, and that's a 5% reduction. I mean, that's the cost visibility that's there for some of the, to do a Disney, if you will.
We're going to be checking that as we get some of the earnings reports, and we are reaching the end of that. I am wondering, though, how any of this features into trading, the day-to-day volatility. Yesterday, Jim Reed of Deutsche Bank said this morning. Markets have been extremely dull over the last 24 hours. Why are they dull? Is it because people just are tired of narrative roulette? Or is it because they're waiting for something in particular to be a trigger to go full bull?
I'm not going to complain about a 24-hour respite, but yesterday was a little quiet. We've had a couple quiet days, and I think it's when the market is waiting for information, and we have a lot of information coming out this week, whether it's Xi, Biden, and San Fran, whether it's inflation today, whether it's retail sales tomorrow, which I think is kind of being under talked about from a catalyst perspective. So if we were quiet yesterday, I think that has a lot to do with it. We've had 2 very painful weeks of a lot of repositioning and rebalancing. So people probably trued themselves up ahead of these events, and now it's kind of sit on your hands until we get the data.
You said that we're underestimating how important retail sales could be. Why do you say that? What is the potential surprise there?
Well, I mean, if you look at last month, you had very, very strong positive surprise in retail spending that actually ran counter to our credit card data, ran counter to a lot of the spending data we've seen from other places. We're heading into holiday season. So I actually think, Wednesday is going to be a really interesting test for that narrative. Do we get another strong back-to-back retail sales print, which means people are going to get very bullish about the holiday spend into year end? Or does last month's retail spending look like a bit of a head fake and we kind of start to compress back down to what the credit card data is saying? So I think there's just a lot of potential outcomes from that data.
But then where does that catalyze stocks in a world where people see bad news as good news still because it could mean Fed rate cuts, right? I mean, it's head spinning in terms of what this means for where stocks go.
Well, you're winding me up. You know that I'm a good news is good news person. So, look, I think for me personally, if you get another solid retail spending print, I think that's net positive for equities because that'll get people, I think, more excited about the holiday spend going into year end. I think if you get a very weak print, then the market's not going to like that. So I'm still in the good news is good news camp.
You are, aren't you? That separates you from a lot of people who think this is upside down. What's the difference between you and them? Is this just what's worked in 2023?
Well, I lived in New York City in the 1990s, so I'm used to all this stuff.
You've got a different benchmark.
It doesn't freak me out. I like the volatility. Honestly, I think it's just that it can be too complicated, and we've just tried to really simplify it down. And I think if you're long a nominal growth asset, you want nominal growth to remain positive. It's the equivalent if you're driving a car. Do you hope the car will break down so that you can go to the mechanic? No, you want the car to keep driving.
Depends who you are.
Well, it depends who the mechanic is too, right? If it's Putty from Seinfeld, then maybe your answer is a little different.
You're killing me this morning, but you've raised up a really important market question. I really do think you have. When you look at crime in certain cities, you can always sit here and have an extreme benchmark like the 1980s and say it was so much worse then, it's better now. You can do the same thing with equities, always. .com, it's not as bad as then. Is that a decent way of looking at markets, just picking an extreme benchmark just to make yourself feel comfortable about where we are currently?
Well, it's recency bias, right? I mean, you're going to react to what the most recent economic environment or equity environment was. So I think that's one of the big things this year is the most recent comp is 2022, where you had a ton of tail risk from both growth and inflation. You had a huge amount of volatility. So coming into this year when quote-unquote event risk didn't realize itself, it really just made equity markets more investable, I think, and it allowed people to really engage that way. The other thing is yields are very, very high right now, right, from a cash perspective, right? So I think a lot of folks who are not used to that are saying, I can get 5.5% without doing anything. So, that's another aspect to it. But yeah, I think to your point, because 2022 was so uncertain and so volatile and so sort of regime shifting, it's made 23 just, the bar is low, effectively. Yep. And that's probably why we're more optimistic.
Stuart, thank you, sir. It's good to see you. If you're just joining us, welcome to the program. Your S&P 500 is positive by 0.1%. On the S&P, yields are a little bit lower by a couple of basis points, 462. Raises the question, Stu, just how high or low is the bar going into 2024 now? How have we reset things this year?
I think so, just in the sense that a lot of economists have sort of taken out the recessions for 2024, which I think has raised the bar a little bit. Obviously, the price point in S&P, if we enter 2024 on a 45 or 4,600 handle, then yeah, I think the bar is going to be higher. So yeah, I think the bar is higher for next year. Luckily, there's still a lot of opportunity. As Tom mentioned, the narrow leadership, I think, is a really interesting dynamic as we get into 2024 because you have a lot of laggards to choose from. and the last 2 years, frankly, January's have been really painful. We've had these very violent kind of rotations in early year, both
Tech
in 2022
just ripped at the start of this year.
Yeah, and
unexpectedly.
If you go back to 22, you had this huge move into Europe that got derailed by the Ukraine war. So I think early 24 is going to be really interesting. Are people willing to sell the 8 or 10 stocks that have driven the market higher and move into the quote unquote laggards early in the calendar year? So we'll just have to see. It's going to be very fascinating, I think, early next year.
This was good fun. We'll catch up with you hopefully before year end. Stu, it's good to see you. Thank you, buddy. Nadia Lovell of UBS joining us in the next hour. Look out for that. Equities right now just about positive from New York City this morning. Good morning. CPI is just around the corner.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
On Wednesday, as you have heard, President Biden and President Xi will meet in the Bay Area for a summit. We anticipate that the leaders will discuss some of the most fundamental elements of the U.S.-PRC bilateral relationship, including the continued importance of strengthening open lines of communication and managing competition responsibly so that it does not veer into conflict. The way we achieve that is through intense diplomacy.
We'll see some of that intense diplomacy later this week. That was White House National Security Advisor Jake Sullivan previewing tomorrow's meeting between President Biden and China's Xi in San Francisco. More on that in just a moment. If you're just joining us, here's the state of play, the scores, if you will, in financial markets. On the S&P, positive by 0.1%. Yields a little bit lower by a single basis point. The 10-year down to about 4.62. In the FX market, a euro, positive 0.2%, 107.22 on the euro. Bit of an update on Thanksgiving travel. Don't know if you guys saw this, but the US Thanksgiving travel period is shaping up to be the busiest since 2019. Here are the numbers. 55.4 million Americans expected to travel 50 miles or more from home. This according to the forecast from the American Automobile Association, making it, Bramo, the third highest Thanksgiving travel in records going back to the year 2000. We're getting back to it.
You know, I just think to myself, which is a reason why I don't want to travel this year. But
so many people on the roads.
It's just, yeah, exactly. How much is this because of gas prices? How much of this is just simply people are going back and finally doing the Thanksgiving that maybe they were not doing and going on trips instead for the post-pandemic years? I'm just suggesting, you know, people are going to get back to their routines.
Any signs that we're getting back to normal? TK, they're welcome signs. That's another sign this morning.
I think it's underrated. We're still in pandemic psychology. Granted, there's different flows and glide paths and all that.
But is that becoming an excuse just to exclude family members? That you just say that the other half is scared of...
I would never do that.
That only works. That only works for a year or two. It doesn't work anymore. That's off the table.
We're not having a large family gathering this year.
We are.
We're very concerned. We're very
we've
concerned
gone
about
beyond that.
We did that for 2 years.
I'll be cooking in the kitchen, and you know, Mrs. Key's looking at me. Right? Which restaurant are we going to?
Have you booked this year?
We booked. Yes.
Okay, good.
Yeah, they've extended hours. It's so successful.
Are you going to name said
hours.
restaurant to get a discount?
We're going to an Alan Ducasse restaurant that I can't say enough about, and they do the usual beautifully, and then they have one or two other things. It's this French word, fixie.
Yeah.
Fixie.
Prefix menu.
Yeah, that's it. Thank you. Prefix. And, you know, I'll be cooking.
I thought Alan Ducasse was in the Dorchester in London, no?
Yeah, but I'm not going to be at the Dorchester.
Okay.
You know, I'm going to be at his more basic restaurant.
Does it start with a B?
Yeah, it starts with a B.
Okay. End in a T.
You got that right.
Benoit.
That's where we're going to do Thanksgiving. What I'm going to say is this is a sign of the optimism we just heard from Stuart Kaiser. Everybody's cautious, and all the I mean, I'm fascinated to see what holiday spending is like. I have no
Likewise. For me, Tom, standout this week, it's retail sales and the retailers and what's happening with the consumer in this country going into Q4 and beyond.
We're going to have to see on that. Right now, we're going to see, there's so many things to talk to Amory Horton about. Seriously, our Bloomberg Washington correspondent, but we've really got to move to tomorrow. Amory, percolating out there is the domestic reality for the President of the United States. The senator from Ohio and others are saying, look, UAW, the Big Brown, UPS, and let's just generalize the AFL-CIO. How is big labor going to be in San Francisco with Biden and Xi?
Well, I think a lot of what drives Biden when he talks about foreign policy is the domestic concerns. So he's going to want to tout the manufacturing legislation that his administration got through, some of that in a bipartisan fashion, at least for the hard infrastructure, but more things like the CHIPS and Science Act, bringing manufacturing back into the United States. If you look at things like electric vehicles, which is the future of the auto industry, China absolutely dominates.
Yeah.
And I think what Biden will try to sell is that not only with the UAW workers were they able to get what they would say much fairer wages, but also looking at the future. So, some of these contract negotiations did, on the fringes at least, start to look at the future of what the electric battery of a car and that type of manufacturing when it comes to EVs might look like with union workers. And the president himself said he liked Tesla to unionize next. So I think when the president talks about foreign policy, we're going to try to see him pivot it back to domestic policy, because polls show, again, Americans are not going out on foreign policies when they vote next year. It's on domestic issues. The economy rate's number one. Also, fentanyl will be a huge topic of discussion tomorrow when Biden and Xi meet.
You know, I think of former President Trump in the theater, if you will, of his meetings with the great and worthy of Asia. What's going to be the theater tomorrow that we should anticipate?
I'm not sure President Biden does theater the same way you see from former President Donald Trump. When they met at the G20 in Bali, it was really on the sidelines. They came out, they did a few photos. I think this will be a little bit more of a grand opening, red carpet welcome for Xi Jinping. We saw in terms of what San Francisco was doing over the weekend, the New York Times, when they led this story, talked about it with San Francisco cleaning up. They said San Francisco had the air of, you know, college students cleaning up after a house party before their parents come in. So clearly everyone is trying to put on a good performance, and it's not just the Biden administration that's meeting with their counterparts leading up to that Treasury Secretary Janet Yellen and her counterpart, but it's the executives that are joining, as well as some everyday Americans from Iowa that Xi Jinping met 35 years ago. They're being invited to this dinner, these farmers. So this is where you're going to see a little bit more of the theater in terms of this grand welcome for Xi Jinping and the number of meetings he has. But you're not going to see, I think, the way the former president did theater versus this president, which is definitely a little bit more muted in that realm.
Anne-Marie, how much is Xi Jinping's presence muting some of the other discussions being had around the event, given the fact that in some ways President Biden is trying to revive some sort of TPP, some sort of Trans-Pacific Partnership type of agreement that's run into quite a few obstacles?
Well, that has definitely run into quite a few obstacles, especially since we're going into an election year, and this is something that the former President Trump and his populist rhetoric would want to rail against. It's a great question, though, because other discussions that might happen on the sidelines are not going to get the full-on press. Everyone is focused at this APEC summit about the meeting that's taking place adjacent to the APEC summit, and that's Biden and Xi Jinping and his dinner with chief executive officers. But for everyone else that's there on the sidelines, depending how these meetings turn out, that will give them a path forward of how they may deal with relations with Beijing when it comes to, especially when it comes to economically, after this meeting between the U.S. and China.
Mate, in all seriousness, what do you make of this cleanup in San Francisco? And is it going to stay that way?
I think you pose a very good question, Jonathan, when you say it shows the ability of elected officials to clean cities up, which I think a lot of Americans are showing in the polls that they're very hungry for. But also, I shrug a little bit because this is nothing new. I actually, at one point, wanted to write a story about the mini economies that world leaders basically build around them when they travel. I've been in far parts of Russia, and President Putin would show up, and they'd re-tarmac every road in these tiny cities. This is what happens when heads of states visit cities. It happens all the time. But I think probably to individuals in San Francisco, they're saying, thank you, about time. But others are saying, well, why did it take so long? And why did it take the head of China to come to this city for elected officials to actually start caring?
Maybe that means the San Francisco Giants get a new shortstop.
Maybe. Do they need one?
They need one.
But yeah.
Yeah, bad year.
What happened to the Red Sox this year?
We want to forget about the Red Sox this
Forget
year.
about this season.
We're in the
Look ahead
hot
to next
stove league season where we talk about.
How's baseball doing? Change the rules? Was getting quicker, right?
The quicker was very successful, but I am shocked at what you've done to me with English Premier League football. I mean, Emery warned me about this.
You're gravitating towards that on the weekend.
No, I just think the slow motion and the endless commercials is just too much. I love English Premier League. They throw the sponsor up there.
Just
you know, it's there while you're there, and they just play. Emery agrees with me.
AMH agrees. She's gone. She agrees so much she's left.
I'm shocked.
AMH, thank you. Down in Washington, D.C. Coming up shortly, Woody Caesar at Credit Sites on this credit market. Right now on this equity market, equity is just about unchanged on the S&P 500. We are 1 hour and about 4 minutes away from US CPI data. That's your main event. It's coming up a little bit later. From New York, this is Bloomberg.
Kenyan athletes are getting better and better, and their times are getting quicker.
Agnes Tirop takes the win and the world record.
With all the success, there also is a dark side to it. And this comes about when men in the community look at women as prey.
The sports fraternity is in mourning tonight. Our world beater Agnes Tirop was found dead today.
When you're moving into the career of athletics, you have to carefully look at who are the important people in your life. Even in a partnership, it can move into manipulation.
A lot of people let Agnes down. She felt that the threat was real. What she was told is exactly what happened to her.
These CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. A new industry is poised to launch. Electric air taxis are on the horizon.
You will see these products come to market by the year 2025.
CFO Mark Messler has Archer Aviation on a financial path to a smooth takeoff.
I know where every ounce of cash is going, but we also have to be nimble around that as well because things change by the day.
Watch Chief Future Officer Wednesday on Bloomberg.
Equities on the S&P 500 just about positive. Your main event in about 60 minutes. We'll get to the inflation outlook in just a moment. Here's the backdrop for equities this morning. In the stock market, we're positive by 0.06%. On the Nasdaq, up by 0.2%. Just a touch softer, negative on the Russell. The small caps lower this morning by 0.1%. If we turn to the bond market, let's sit on treasuries for a moment. 2-year, 10-year, 30-year. 2-year yields just about unchanged. North of 5% still on a 2-year going into inflation. If you think about where we were the morning of the last inflation print, I was looking at the numbers for you just yesterday afternoon. The 2-year opened that day at about 5%. It's where we are. The 10-year opened that day at about 4.55, back down to about 4.62. So basically, yields have had quite a ride, quite a journey in the last month or so, but yields are almost back to where they were the morning of the last inflation print, almost across the board here. Beyond bonds, into foreign exchange, we look like this on the euro. The euro at the moment looking at a third day of strength against the dollar, 107.23. That currency pair positive by 0.2%. Lots of data this week, also lots of earnings as well. I just want to sit on Home Depot just for a moment. Came out with numbers a little bit earlier, still looking for a revenue decline, just narrowed the range for that revenue decline, Lisa, a little bit earlier this morning. But the line that jumped out for you is the line that jumped out for me. The pressure in big ticket discretionary categories. Are we going to see more of that through the week?
Is this just a housing-related specific issue, or is it broader? And I think that's really we're going to parse through with the retail sales figures that we get tomorrow. And then with Walmart earnings on Thursday, what we're seeing is a stock that's been beaten up this year on high mortgage rates and the fact that people are investing less in their homes after gangbusters years in 20 and 2021. How much, though, does this really cross over with this big-ticket discretionary spending to the other sectors?
And to the question for Stuart Kaiser in the last hour, the basic idea to me is what happens at the top line. This is a company that's, done some solid upper single-digit work over 20 years, and all of a sudden now it's lower single-digit if they're lucky. That's the key thing to me today. And you frame out, how do you fix that? And as Mr. Kaiser mentioned from Citigroup, there's one easy way to fix it. You cut costs. Maybe Disney's out front on this with the ardent costs we're seeing in streaming.
Well, they're under huge pressure, the cut costs over
That's a structural issue. I get
Without
it.
a doubt.
Home Depot's worried about, John, I take real issue. The 1/4-inch, 3/8-inch ratchet socket set from Milwaukee, is that a discretionary item? That is not a discretionary item.
It sounds discretionary. What is that?
$268, and it comes in a fancy thing there,
And that's a staple for you.
Yeah,
of course.
You can put together grandchildren's kitchens with that.
I've got no idea where this is
Other
going.
stuff.
This will generate some intrigue, the story that's just crossed from Axios this morning.
Huge
I'll
deal.
share
Yes.
the lead paragraph with you. JP Morgan Chase CEO, according to a top banking source speaking to Axios, Jamie Dimon has been talking privately with GOP presidential candidate Nikki Haley about the global economy and believes she has the potential to bring the country together. According to this reporting, according to this source speaking to Axios, Dimon admires Haley's grasp of the economy and her recognition of the role that business and government can play in driving growth by working together. I don't know this morning, and I'd love your view on this, Lisa, whether that generates more intrigue about Nikki Haley or Jamie Dimon
Exactly.
this morning. Where do you sit on this one?
At this point, everyone's been speculating about Jamie Dimon as U.S. Treasury Secretary or some other position. Pick your post in any kind of cabinet. There is a question about what his involvement is, but he crystallizes this idea of support from the establishment for Nikki Haley. She just has to get through the primaries, and then a lot of people think that she has an easy win versus President Biden, but that's a big if because everyone's talking about Trump as the front runner.
Well, if you get support from the establishment, does that get you support from the electorate, particularly the base, in a primary, become the Republican candidate?
Or is it actually the other way around, right? Does this actually harm her chances with the primary debate? Look, this is sort of this ambiguous moment in politics where the primaries skew very much to the polls rather than to the center, but the entire electorate is skewing more to the center, which raises questions about the primary system, et cetera.
Well, what's interesting about this, Secretary Dimon's out front on this. I mean, I'm looking at his annual report, 64 pages, whatever it was. Potential trouble brewing from unprecedented fiscal spending, quantitative tightening, and geopolitical tensions. Secretary Dimon's out front with his brief as he considers potential office.
When I ask where the intrigue would be after a story like that, your intrigue is more with Jamie Dimon and JP Morgan?
No, I think we have a national candidate gaining momentum, and in a former president who is decidedly incumbent. But I do think a lot of people have talked about a Secretary Dimon. Okay. Full disclosure, take it over to the passive world. They've also talked about Secretary Lawrence Fink. I think these are in the zeitgeist of global Wall Street.
I imagine Mr. Dimon meets with a lot of people. And we'll probably see a lot of stories
That's
like
probably
that
what you'll hear from Joe today out of JP Morgan when you guys have lunch.
Sure. I'm not sure that lunch is happening. Under surveillance this morning, just 1 hour away from US inflation data. Let's get through some stories for you. The report expected to show slower progress towards the Fed's 2% inflation target, likely keeping the central bank biased towards more tightening. Bloomberg Economics predicting consumer prices, excluding food and energy, rising 0.3% for a second straight month in October. Your next story, the House of Representatives set to vote today on Speaker Mike Johnson's new short-term plan for funding the US government. Johnson's plan facing opposition from at least 8 hardline House Republicans who want immediate spending cuts or changes to immigration law. His proposal would need a 2/3 majority in order to pass, opening the door for a possible bipartisan solution, Elisa, ahead of Friday's deadline.
Which is exactly what got Kevin McCarthy canned as
I was going to say that was verbatim where we were X number of weeks ago, wasn't it?
Which raises this question, how is this time different? Can we see Michael Johnson retain his position and clout even if he moves ahead with some sort of bipartisan plan?
This one's going to linger all week, isn't it?
Yep.
Okay, so let's go to the next story. President Biden set to meet with China's Xi Jinping in San Francisco tomorrow. The two leaders expected to announce an agreement that would see Beijing crack down on the manufacturing and export of fentanyl. Under the deal, which is still being finalized, China would go after chemical companies to stem the flow of both fentanyl and the source material used to make the synthetic opioid, which has been fueling, Tom, a years-long public health crisis here in this country.
Our romance of China and Shanghai and heroin, or maybe out of Southeast Asia, is poppies and people carting them out. This is baloney. There are 3 methods: Janssen method, Siegfried method, and Gupta method. Is something as inorganic as phenethyl bromide. Don't ask me. I did poorly in chemistry in school, but this is deadly, deadly serious, limiting inorganic chemicals which come out of China and make up this killer 50 times more powerful
and
than
go
heroin.
through Mexico, Tom, across the border.
Via
so this is becoming a huge, huge political issue in this country.
These are not TV shows. This is the real deal of inorganic chemistry killing people.
It's a big issue, Tom, particularly for 2024.
Yeah, absolutely. We're going to continue on here. We're really focused here, 50 minutes away from this really important CPI report. Joining us now, Winnie Caesar, Global Head of Yield at Credit Suisse. Winnie, wonderful to have you here. I got 8 ways to go this morning. Let's go to the inflation report. How does your world react to inflation? What do you expect at 8:30?
So we do expect that the inflation report could come in a little bit hot, just given some of the moving pieces at the line item level. Now, we're not particularly worried that there's going to be a massive gap higher in yields, especially in the long end of the curve. We saw the 10-year hit 5% and has come down pretty nicely since then, but we do expect yields to be relatively stable. And for corporate credit, we think that the outlook looks pretty good, with U.S. investment grade still yielding north of 6%, high yield at 9%, with double Bs in that 7 to 7.5% area. That's really attractive, even if core inflation is trending at kind of 4% year on year, as we do expect disinflation to continue throughout the next 6 to 12 months.
It is attractive if you're an investor. It is really unattractive if you're an issuer that's gotten used to paying rates of below 3% for so many years. There was this report out from CalcBench that Bloomberg got a hold of that showed that non-financial companies in the S&P have more than $100 billion of debt coming due next year with coupons below 3%. Refinancing at current rates would add another $3.1 billion in collective interest expense, additional to what they're currently paying. How much does this alter the fundamental profile of some of these companies?
So I think you have to be very careful in discussing which universe is going to be most impacted by these higher borrowing costs. For the investment grade world, where you have much larger term structures of debt with much more kind of segmented maturities, with some in the near term, some in the immediate, some much further out, and also very robust cash balances, which is actually allowing a lot of corporates to kind of operate like banks and generate positive net interest margins, that is not, to us, a particularly threatening issue. For the high yield universe, and especially the leveraged loan universe, you have very large percentages of capital structures maturing in the next, call it 2 to 3 years. For the loan-only capital structures, there is a number of companies where 100% of their outstanding debt are actually going to come due in the near term. And so they're going to have to refinance entire capital structures at materially higher rates. And that's where we're most concerned. But for a lot of the corporate credit market, the maturities at higher financing costs are not going to be quite as detrimental to fundamentals.
Within investment grade, what you just said there, that some of these companies are operating like banks, that their cash piles are earning that 5% interest and can offset any additional increase in borrowing costs. How much are they building those cash cushions with the expectation that that kind of basic interest revenue will continue?
So the real build in cash was during the pandemic, when we saw borrowing costs at rock bottom lows, and also earnings were good. There was solid profitability across a wide range of companies. Now, since then, cash balances have come down, but they're still very elevated relative to pre-pandemic levels. In aggregate, I realize that it's not all evenly distributed across the market, but in aggregate, cash balances are still quite elevated. And we are seeing that management teams are still very focused on cash management, balance sheet management, ensuring that their capital structures are appropriate for whatever this next move is, be it a continuation of higher borrowing costs or a deceleration in economic growth and earnings.
It's a big challenge for next year, whether we get that deceleration. Willie, thank you. Willie Caesar there of Credit Size. We've been waiting. Subtle signs of it. We've been talking about those subtle signs, Bramo, all morning. Claims starting to inflect just a little bit higher. Delinquency starting to climb. Is that slowdown, Lisa, just around the corner?
And this is sort of what people are banking on, which is maybe underpinning the conviction in bonds that we're hearing out of that Bank of America Fund Manager survey. We'll see. I mean, honestly, that's why retail sales, to echo what we just heard from Stuart Kaiser, is so important on tomorrow and then on Thursday with Walmart.
If you're UBS and you've got Banu Buwaja essentially saying that Fed funds is going back to a one handle, must believe that this Treasury market is a screaming buy right now. If you believe we're going back to 1% on Fed funds.
Ian Lingon at BMO Capital Markets is there. John, we're up 3% on the 4-week moving average of claims. Just teen sweets, and it's just underway. But there it is. But Buwaja has decades of experience.
Tons.
This isn't some young Turk out there trying to make a name for himself. This is an acclaimed guy who stops audiences in Southeast Asia, among others, for UBS.
If you're just joining us, we'll continue this conversation. Equities at the moment just about positive by 0.03%. Yields are a little bit lower by a basis point, 462. Comes down to one question, TK. Do you think the world has changed? Is this truly a different regime post-pandemic? Banu Buwaja over UBS is essentially saying it doesn't think this time is different. This is not new. We're going back to the old world.
And John Williams,
come back down to one.
In one of the 45 speeches he's made in the last 32 days, John Williams talks about this. We're going back to the regime he envisioned before. And so I think the arch debate is, do we still go OMG, bad news is whatever Lisa talks about? Or do we go back to what we knew years ago?
All right.
Do we go back to 2018?
Okay, hold on a second. Okay. All right, well then I'm going to challenge you on something that you just said.
Okay.
You said he's not a young Turk. He's someone who's been on Wall Street. What's wrong with young Turks? I mean, honestly, people coming in and seeing the new technology and understanding what the change might actually be.
What did Marco do today? Marco reaffirmed.
Hey, don't involve me. Carry on. I'm loving this.
Oh, are you actually? No, but seriously, I mean, at a certain point, we are seeing some fundamental sea changes in, the structure of how we do business when it comes to tech, when it comes to how that may revolutionize things. How much does that change some of the baselines?
Are we going to go back to the gross cancel the break? Are we going to go back to? Are we going to go back to the gross macroeconomics we knew before, or is there a new regime out there? I would suggest with technology, we need to be sober about saying it's going to be 2019 again.
This was great.
This is great.
So I enjoyed that. I'm so excited for the next commercial break.
I can't believe what our therapist
cannot wait.
Lisa, we're not doing this again.
For what's about to come.
The younger generations are more, of course,
pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Last month, you had very, very strong positive surprise in retail spending that actually ran counter to our credit card data, ran counter to a lot of the spending data we've seen from other places. We're heading into holiday season, so I actually think, Wednesday is going to be a really interesting test for that narrative. Do we get another strong back-to-back retail sales print, which means people are going to get very bullish about the holiday spending to year-end, or does last month's retail spending look like a bit of a head fake, and we kind of start to compress back down to what the credit card data is saying?
Stuart Kaiser of Citi was just absolutely fantastic a little bit earlier this morning, just looking ahead to some of the retail sales data we get tomorrow morning. And I'm with Stu. This week for the retailers, for the consumer, huge week. We'll get CPI in about 45 minutes time, then on to tomorrow morning with retail sales just around the corner. Equity futures look like this. Here are the scores. We're totally unchanged on the S&P 500 and going absolutely nowhere for a second session potentially. We'll see if that changes. The fate of this session seems to be in the hands of the data point we get a little bit later this morning. Yields coming in a couple of basis points on a 10-year 462.21. Just a sneak peek of foreign exchange for you. 3 days of euro strength against the dollar, 107.25. We're positive there by 0.25%. I mentioned this week is a big week for retailers. We had Home Depot out with earnings a little bit earlier this morning, narrowing its guidance for full-year profit and revenue. The CEO weighing in on earnings saying this: similar to the second quarter, we saw continued customer engagement with smaller projects. And Tom, this is the key line for Lisa. She mentioned it as soon as the numbers dropped. Experiencing pressure in certain big-ticket discretionary categories. That's a big focus for us this morning.
Yeah, that's part of this. There's a story here of a company that's up 20% per year since time began, and you wonder again how they adapt out of this. To the domestic I just had with Lisa, it's really a question of how do we move on beyond the pandemic, and it comes down to how America adapts to this and what they do at Lowe's, Target, in Home Depot. I think it's a massive mystery.
They had a massive merchandise problem, Tom. They couldn't get enough, then they had too much.
Yeah, exactly. These
Still
are
working through some
changes.
of these issues, yeah.
And they're working through it. And, I'm going to see it. I mean, Lisa, you're looking at one of those refrigerators. You see this refrigerator she's looking at?
Double doors?
Yeah, like, she hit the kids with one of the doors and
that would be great.
maimed them.
Yeah, I am buying a refrigerator. I'm trying to move against the trend.
What's the door like? Because mine has glass in it, and you can see into the refrigerator. So it's very well organized, as you might expect. Everything's nicely lined up.
And if anyone moves it,
everything's got a place.
Yeah, and if anything changes, then
I'll
we have
notice and it'll
problems.
get pushed back. Not problems. I'm not going to go mental. I'm not mental. I'm not.
I'm not mental.
Everything's just very well organized.
Yeah.
You
I can't imagine.
I don't think mine's
Can you imagine his refrigerator?
Mine's going to be absolutely opaque doors that nobody can see inside.
It's like my Christmas tree.
I know.
Just,
perfectly orchestrated.
It's just right.
Tom.
We don't talk about my refrigerator. Here's what we know. In Western Massachusetts, there is all sorts of academics, and the acclaim of one Smith College, and their applied mathematics program is legendary. It's equivalent to the Williams College PPE Wonderman, a little bit further out to the far west. Joining us on applied mathematics of big box retail, Elizabeth Suzuki joins us at Bank of America Securities. When you were going through polynomials and, you know, doing Ferris proof and all that in applied math, you think you'd be in aisle 4 at Home Depot?
I did not. I never thought that my work was going to include channel checks at stores that I just go to anyway. In fact, now, you know, as a homeowner for the last, 6 years, I'm in Home Depot pretty much every weekend, maybe every other weekend, but I mean, it just never stops.
Wonderful. I've never been to the one downstairs. Farrell's down there once a week picking up something. Let me cut to the chase, which is the new post-pandemic Home Depot world, and for other big box as well. Can they fix the problem on the income statement? Mm-hmm. Can they take out expenses like Disney or you name the bank?
Sure. You know, I wouldn't really categorize it as a problem on the income statement. When we think about what Home Depot is going to do this year in terms of sales, they're probably going to end up about 50% higher than they were in 2019. And just putting that in context of the broader industry, which is tracking up about like 20% versus 2019 levels, that's an amazing amount of market share that Home Depot has been able to take. I mean, we're coming down off of these very, very high levels of spend during the pandemic. Homeowners had, easy rates to be able to borrow against. They also had, stimulus money to spend. They were moving at much higher frequency. A lot of people moved out to the suburbs during the pandemic. I mean, we've seen a slowdown in that. And, I think what's been surprising this year to the downside and just where we've seen that pressure on the top line is really mostly from housing turnover basically coming to a standstill. So as we expect,
really?
So I think, as rates start to moderate or potentially even come down, maybe towards the second half of next year, I think that's going to help spur that housing turnover again, and we're going to see more of a return to normalization in terms of that top line sales growth.
Given where mortgage rates are, do you really think we can normalize the fact that there are some people just locked in their homes with a 2-3% mortgage who just aren't moving anytime soon?
Yeah, I think it's like once rates really stabilize, maybe come down a tick, a couple of rate cuts potentially in the second half of next year, then, the homeowner is saying, okay, like rates are probably not continuing to go up. I can potentially refinance if I were to, move today. I'm locking in a rate that's higher than what I wanted, but I feel like there's some potential for that to come down over time. And maybe it means that people buy a house that's a little bit smaller than what they wanted, or it means that, some people who are moving and, are going to have to absorb a higher rate, but because households have such high levels of savings, they actually can absorb that. It's just, it is uncomfortable, right? So right now we're feeling that discomfort in terms of existing home sales, which are the lowest they've been in 13 years.
How much does Home Depot rely on the housing market versus the fact that if people aren't moving, they are buying new refrigerators, I'm just saying, or they're buying new stoves or new microwaves or other items in the house that might break? I mean, at a certain point, does that actually help these companies?
Yeah, I mean, the sector is not as sensitive to housing turnover as one might think. I mean, when you're seeing these, negative data points on housing every day, and if you already have sort of a negative bias, each one of those data points just kind of confirms your bias, and you're going to say, of course, things are terrible right now. So what we've done is we've tried to look at basically every macro factor you possibly could, and this is really where, that applied mathematics comes into play, is we built a proprietary indicator of home improvement demand, and we narrowed it down to 14 different factors that are reported monthly that we can correlate to Home Depot and Lowe's same-store sales growth. Because at the end of the day, that's pretty much what drives these stocks, is same-store sales growth. So we narrowed it down to these 14 factors. We built an indicator off of it, and then that indicator helps inform our views where we don't have to be dependent on the company's guidance. We don't have to be dependent on third-party forecasts. Like we're able to actually look at the factors that matter, and then month to month, we can track each of those factors and not get distracted by the noise that we hear in a lot of these other data points.
How correlated is Home Depot to some of the other retailers that are not related to the housing or home improvement sector?
Yeah, I mean, that's a really interesting question. And I think, when we boil it down and look at the broader sector and look at Bank of America's credit card data for the home improvement retailers, which is, just very broad category, Home Depot has outperformed that group pretty consistently, like actually very consistently over time, and Lowe's has as well by at least 200 basis points. So, the market share gains here are pretty material, and that's something that I want to just continue to kind of hone in on in this result, is even though their sales are down 3%, we've seen the category down, mid to high single digits year over year for most of this year. But in terms of correlation to, to other retailers, it's pretty independent. I mean, it's some factor of the broader consumer and the health there, and so obviously there's correlation to like a Walmart and a Target, but because it is related to housing, and really home prices are one of the most important factors driving home improvement demand, that's really where it kind of differentiates.
We've all been surprised by the strength of this economy this year. There's a bunch of companies that fall under your coverage. We're trying to work out whether we are at the precipice just around the corner from a severe weakening of the economy. Do you see any of that emerging whatsoever going into year end?
Yeah, I mean, I think that there are categories that we follow that are struggling more than others. Appliances, we talked about refrigerators. I mean, appliance sales are down. The volumes have been under pressure. Margins are coming under pressure as well. We saw promotions that started in October for appliances. So you should get on it if you're in the market for a fridge, because I think those promotions are going to be pretty attractive this year.
You need the camera off, Rama. She looks so happy. You're so impressed with yourself.
Please go on.
What kind of discount did you get?
No, I just want to hear what you have to say. Carry on.
But consumer electronics is another one, right? I mean, as Home Depot said in their press release, they're seeing pressure on big ticket consumer discretionary products. So consumer electronics, definitely one of those. Appliances kind of fit in that bucket as well.
Ken from New York University just emailed in. So you're sitting here with Ken Langone. He's going to go, this is all a lot of great chat, but the bottom line after 3 years pandemic malaise, let's call it, is can they get back on track to the total return that we were weaned on? Can they get back to 16, 18, 20% per year share return?
Yes, I think, in this current macro environment, that's tough, because the consumer is pulling back on spending, and we are coming off of this, sugar high from the last couple of years. But, as we look to 2024 and 2025, we see no reason why there shouldn't still be growth in the home improvement sector beyond the broader economy.
Liz, this was great. Thank you. It's good to see you in person as well.
Yeah.
Getting back to normal. Just want to see more of this.
You just see her down at Home Depot underneath us.
I know. I'm going to make a shopping trip on my way out.
At least I've been to the Home Depot beneath us.
I just am channeling Will Ferrell.
TK's never been, never been
old school
to a Home Depot.
I know. It's good Saturday activity.
A cruise ship is much more than a flotilla of financials and numbers. Naftali Holt showed me around the Celebrity Beyond, Royal Caribbean's newest ship, rolling out not the red carpet, instead the magic carpet, an example of investment that's yielding returns in several different ways.
Originally, actually, we designed it because we wanted to have a really nice platform for tendering, because sometimes we can't home port
so
in destinations.
Functional.
Exactly, value functional. And then we looked at it and said, why don't we just make it a really cool feature spot where people can enjoy it beyond the functional space? And we created this bar. It went up and down.
Now, what does it take
How
to
about the Instagram? Can you speak about that?
I can imagine.
Instagram moment with the sunset, having a drink with your friends or family. I mean, that's amazing.
So what does it take to do something like this? And I'm thinking cost, engineering, time.
Yeah, a lot of effort from a lot of people. So it starts from just the design and the conceptual aspect of it. Then we need to figure out a lot of technical factors, the weight, the wind, and so lots and lots of hours of really hard work. And every time we up the game, we see that customer willing to spend more.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Do you think there's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised.
And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
This is Daybreak Europe. I'm Kriti Gupta. Let's look to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Right now, you're seeing really different signals in different parts of the market.
What's going to matter? The slowdown? How big of a slowdown is it? And importantly, what will the Fed's reaction function be?
As inflation declines, real rates will rise, and this means the Fed has scope to cut rates.
What's not changed is sort of cautious near-term outlooks.
If we lose the labor market, we lose consumers. If we lose consumers, we're done.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. CPI Tuesday it is, on radio, on television. In the next 30 minutes, your world's going to change with the direction of disinflation, the character of disinflation in America. I'm sorry, John, 8:31 a.m. is an unknown.
I think it's a three-part act, Tom. It's just one part of the broader story. Get inflation data later, retail sales tomorrow, and we'll hear from the retailers as well. What is the state of the U.S. consumer at the moment?
Yes.
Keep going back to this line from Deutsche Bank. The latest data remains broadly consistent with end-of-cycle dynamics. Is it? Starting to see claims start to pick up, inflect just marginally. Is that slowdown really just around the corner? Because we've been talking about that now for 12 months.
We're going to dovetail this with the outlooks. We're just starting to get out the outlooks as well. What a great job by our team. Greg Bowdle, the Bear, on earlier. Stuart Kaiser, optimistic as well. We're going to talk to Nadia Lovell in a moment. And the CPI report, John, folds right into where will the stock market go.
I'll get the outlook from JP Morgan, Marko Kolanovic, with this to say this morning. We believe stocks and the risk reward for them remains unattractive. Goes on to say restrictive monetary policy is likely to remain in place for some time. Equity valuations are rich and consumers are likely to begin to retrench. I go back again, Tom, to that last line. Are consumers likely to begin to retrench in the Q4?
And the news we'll see in 28 minutes here as well. And of course, part of this is the debate, the wide dispersion that we're seeing. And Lisa, it's from Greg Bowdle, 4150 out to Ed Yardeni with that bombshell, I believe yesterday, at 5400 on SPX. We provide a service here with a calculator on the Bloomberg Professional Service. That divide in SPX is almost 10,000 Dow points. That's the separation.
Wow, I'm going to have to translate that somehow into the S&P points.
John
What I'm
will do
looking
that for
for,
us.
yes, I'm sure he would be happy to. Honestly, I think that one of the biggest question marks is this time different? And everyone hates those words, right? But essentially, if you don't believe this time is different, there needs to be a slowdown. There needs to be some sort of increase in unemployment rates that is commensurate with something, if it isn't a recession, a serious slowdown. If this time is different, then we don't know what the new normal is that we're going to, which really explains that range of 10,000 Dow points that you calculated somehow.
Into the China visit tomorrow with the president. I mean, the basic idea here is there goods deflation, goods disinflation, or that subset I don't understand that Mike McKee will tell us about of some form of core service sector. Will that be the dynamic at 8:30?
I think it's going to be just as simple as if core inflation accelerates more than expected, that's going to throw a lot of cold water on the thesis that a lot of people are coalescing around. The disinflation has taken hold. We've seen the peak in bond yields, and inflation is going a lot lower.
I look, John, at this, and you know, to put in equities, bonds, currencies, commodities. There's a global piece. George Saravelis with that shocking piece from Deutsche Bank linking the inflation trauma of Japan right over to something like the inflation report here in 27
Well,
minutes.
let's work through it, Tom. What are we converging towards? 2% or 3%?
That's the arch debate.
And
yes.
what's the difference for the
Yes.
Federal Reserve? And let's go a step further. We've had, 18 months, close to 2 years of inflation picking up here. Is that starting to become embedded in inflation expectations? Andrew Honhorst of Citi reflecting on this. I think it's important just to reflect on some of the data we've had. I know I joke a lot about you, Mitch, consumer sentiment, because of how many people they call to get that reading, but let's just go with that data for now. In that data, the surprising point of that going into the weekend is that gasoline prices have pulled back, yet inflation expectations were higher and consumer sentiment was lower. I think it's worth asking the question, has higher inflation started to become embedded into consumer expectations? And what does that change about what we could converge towards? 2 or 3? And what does it mean for Fed policy next year? When you've got some banks on the street making a call for 2024 of a return to the old story, back to the ones on Fed funds.
Before the data check, though, what's important here is in 26 minutes, Lisa, we're not going to get a cumulative inflation study back to 2019, and yet 110% of our audience, that's how they're thinking. That's how I'm thinking right now.
I was reading actually a report on the psychology of inflation last night, because that's what I do with my time other than buy refrigerators. And there's this real idea, people focus more on how much prices have increased, even if their salaries increase commensurately. They don't count that in their calculation of inflation. They feel worse from the bigger prices that they pay, even if they're receiving bigger paychecks. On the other side, that is the reality underpinning this inflation pressure.
Without a doubt, and that's why people don't feel good, Tom, about this economy in a lot of places.
Inflation, where do you begin? I'm going to go to the real yield, 2.30%, John. As we look at the data, it's going to change here in 25 minutes.
It's quiet. I keep saying this. It's been a quiet start to the week, but it's about to get busier in about 25 minutes' time when US CPI drops. Equities at the moment positive by 0.1% on the S&P, just about. Yields coming in a couple of basis points, 461.81. Crude settling down. This is not the picture in the commodity market we expected maybe a month ago. Looking at 1 month, we're back in the 70s on WTI, in the low 80s over the last week, Tom, on Brent crude.
Team Bloomberg Surveillance has just outdone themselves in the last 24 hours on the stock market, on where equities are moving. Greg Bottle joining us, Stuart Kaiser joining us, and now we do a hat trick of quality with Nadia Lovell, Senior U.S. Equity Strategist, UBS Global Wealth Management. Nadia, you're sort of in between here. I'm not going to call it consensus because at 4,700 SPX, you got a lift to the market. How do you respond to the set of things we need to shock and get a much better number, as Ed Yardeni suggests?
I think you need to see a healthy reacceleration in earnings growth. We are looking for that next year. We're looking for high single-digit earnings growth. But if you can get double-digit earnings growth, at the same time, you'll have bond yields coming down because inflation has come down, not because of a slowdown in growth, and you could see further upside to the market well above that 5,000 range.
Can we pick a sector, Nadia? You still like energy. You still think crude's going to be in the mid-90s maybe next year. Nadia, walk us through that. What brings about that story for you?
Yeah, it continues to be on the supply side. I mean, reality is this pullback that we've seen in oil prices is not reflecting the solid fundamentals and the tightness in the oil market. The supply picture continues to be constrained due to the OPEC cut, and also the demand picture remains pretty solid. It is a bit uneven. You are seeing strength in areas like China and India, and some disappointment within Europe. But we think ultimately that the oil market will remain supplied. OPEC and Saudi Arabia will maintain those cuts into early next year, and that will help to support oil prices. And so we think that this pullback and lighter position does provide an attractive entry point into energy and oil to sort of capture that upside.
Based on that rationale, Nadia, can you be bullish on oil and not bullish on consumer discretionary, which also would benefit from some of those trends?
Now, remember, consumer discretionary as a sector is very concentrated. The top two companies account for much of that sector. So our view on consumer discretionary and neutral is more reflective of our view on those top two companies. also reality is the recovery in the consumer is somewhat uneven. It's continued to be the higher end consumer that remains solid, but the lower end consumer is struggling. And remember also within consumer discretionary, that sector is more driven by the goods area of the economy and less so by the services sector, where we're seeing more a bit of a pickup in spending around that.
We've been talking about the different events that are going to be happening this week that could potentially be market moving, including what we're going to get in about 21 minutes time. Which event or which data point do you think is going to be most important for you as you craft the nuances around your message heading into 2024?
I think in terms of, like, of course, everybody's watching the inflation numbers coming in shortly, but we are more focused, honestly, tomorrow on the retail sales numbers. We know retail sales have been pretty strong the last couple of months, and this retail sales will give some clues on the impact of resumption of student debt repayment, and is the consumer remaining resilient? And so that's why we're closely watching that. We do know that the American consumer does have the propensity to spend in the fourth quarter and into the holiday season. So we'll be listening very closely to retail earnings and commentaries from those companies this week to see how the holiday season is going. We did hear last quarter, as you remember, from some of the retailers, a pickup into delinquency on some of the stores' credit cards. So we want to see what is the overall health of the consumer and is that continuing into the fourth quarter. So we think that that's more important. The inflation data, I think there's a bit of an expectations already that it could come in hot. And so if it doesn't come in hot, that could be a positive for markets as well.
Nadia, we've been joking about the economist who cried recession all year. There's always been a long, long list as to why the consumer is about to weaken, why we're about to enter recession. Student loan repayments in Q4, part of a long, long list. Can you think of some tailwinds to growth in 2024 that you think might persist beyond some of the warnings we've had? Goldman Sachs are on board. Jan Hatzius, I'm sure you saw the outlook from them recently, talking about tailwinds to growth in 2024. The disinflation can continue and ultimately the labor market can remain strong. Where are you on those points, Nadia?
Yes, we're not calling for a recession next year. We think that we will get a period of slower growth, but that's not surprising. We've had 4.9 GDP in the third quarter, so it's not a surprise that we should see a slowdown. So we're looking for more something in the 1 to 1.5% range. And reality is, as we know, the consumers still have a lot of excess saving, particularly the middle and higher end consumer. The job market does remain strong, and reality is cash is or have a yield now, and consumer wealth has been pretty strong this year, and we think that that continues into 2024, and so that could help support economic growth in 24, despite some of the headwinds that we're watching into as you've listed, student loan repayment and sort of a normalization in delinquency and credit quality.
Nadia, thank you. Nadia Lovell there of UBS Global Wealth Management. The outlook for 2024, the price target remains 4,700 on the S&P 500. If you are just joining us, anticipating US CPI, it's about 18 minutes away. The scores look like this going into the data point. In the equity market right now, we're positive by 0.1%. Yields are lower by a couple of basis points. 462.21 in the FX market, a euro 107.22. The state of play looks like this. The number drops at 8:30 Eastern. We'll hear from Jay Bryson of Wells Fargo. Reaction from him. Mike McKee's going to, of course, break down the number for you. Ira Jersey of Bloomberg Intelligence. David Kelly of JP Morgan Asset Management. We're pretty stacked if you are just joining us. Your equity market positive by 0.1%. TK, pretty stacked going into the data point in just a moment.
David Kelly's a key interview here, conversation here to see how he's adapted. David Kelly was way out front, suggesting finally we'll see non-farm payrolls break to a lower positive statistic. Dare I say, he said, a negative statistic. We've yet to see that. We need an update.
What I think is fascinating is just the lack of certainty around anything, and the fact that a lot of people are looking past CPI, that once was the most important read of all of the different metrics, and going to the retailers. The biggest mystery of how much people are willing to keep spending and accepting higher prices, which really feeds into the CPI reprint that we get in about, I guess, 17 minutes now.
It's going to sound philosophical, but ultimately, it's a soft landing a moment in time and not the ultimate destination. It feels like one right now, but what are we going to end up in? And some people believe that the price you've got to pay to get inflation lower is ultimately softer growth. You can do a lot on the supply side of things, and maybe we have done already. But if you do believe in these longer variable lags, then growth is about to get hit, isn't it? Based on this massive tightening cycle we've seen from this Federal Reserve.
The only way that you can truly get inflation to come in is if people protest against prices going up too much. And what we saw from McDonald's and what we saw from Starbucks is they're not really protesting that much with burgers and with lattes.
I looked at McDonald's on Uber Eats over the weekend.
It's high.
See how expensive it is? I didn't buy. You see how expensive it is?
You're just doing
to go to McDonald's. I was doing research ahead of CPI. Do you see how expensive it is?
Yeah.
It was like $15 for a meal in New York City.
It's a new price point that's being paid, and that's the key.
Insane.
They're testing the consumer, and so far the consumer said, fine. We'll see how that pricing power goes.
I didn't say fine. I walked away.
You wouldn't have ordered from McDonald's anyway, would you?
I was watching The Golden Bachelor. I wanted a milkshake and a burger, and I didn't get it.
The Golden Bachelor.
The Golden
I'm
Bachelor.
afraid to
It's
ask.
very busy.
I'm afraid to ask.
Season is here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power. We're going to make more money. We're going to make more money. And we're going to make more money.
You're making bank. And I think that is what we can take away.
Bloomberg Television and Radio. Context changes everything.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Let me start with the Moody's decision. They maintained the U.S. AAA rating, but indicated that there's a negative outlook. This is a decision that I disagree with. The American economy is fundamentally strong, and Treasury securities remain the world's preeminent safe and liquid asset.
That was Janet Yellen, Treasury Secretary, speaking at the APEC Summit in San Francisco. Let's dissect some of that. Lisa, hard to argue against the last line, that Treasury securities remain the world's preeminent safe and liquid asset. Hard to argue against the American economy being strong because ultimately we just delivered close to 5% GDP growth in the third quarter. But that wasn't what this downgrade was about. This downgrade was about governance issues, which are clear and evident in DC and have been for a long, long time. And it was about the debt trajectory of the US, which is clearly on the wrong trajectory. And it doesn't matter who you speak to, pick anyone. Former New York Fed President Bill Dudley, unsustainable fiscal path. Hard to disagree with what Moody's said coming into the weekend based on all of that.
In some ways, Moody's is making a rate call, which is something that you pointed out earlier in the week. And at some point, Janet Yellen's also making a rate call that rates are going to go back down to what they used to be, which changes the debt trajectory and the interest payment trajectory. And this ultimately is underpinning a lot of the uncertainty in markets and, frankly, the credit profile of the United States.
Based on what I hear from some commentators, it's almost as if you shouldn't get a credit rating for America. They should be permanently AAA. They should be the sun in the middle of our universe, and everything else is just planets going around it.
How do you really feel?
Seriously, that's basically how the commentary goes. They should be AAA, firmly AAA, etc., etc. If you don't believe that, And if you think they should be based on what dynamics look like relative to other countries, relative to other AAA-rated countries, sovereigns, America is so much worse than those other sovereigns. This comes back to that same issue. Do you believe America has a unique privilege to act recklessly? They have done for a long, long time. Do you think it is losing that privilege, Tom? Arguably, based on the last decade or so, it's losing that privilege, and ultimately, you have to pay a higher price now to get that deficit away than you did before.
Full disclosure, I grew up in a house that worried about this 24/7. My mother was the ultimate debt worrier. John, the real question here is the rate of change of recklessness. And right now, and there's been some great charts just on Twitter in the last 24 hours, the rate of change of interest expense, of entitlement expense, is moving in directions that are distressing.
But it's not just governance issues, Tom. It's not just about our inability to talk to each other down in Washington, which is clearly a problem. It's about successive governments blowing out the budget deficit. To have a deficit of 6% of GDP, with GDP close to 5%, and unemployment until recently in the mid-3s, Tom, it makes sense of that for me.
The unemployment is the productivity and might of our economic growth. And what's bailed us out is quality economic growth versus the rate structure of all that fiscal policy. And many are saying that's changing, to your concern, where you're going to have an R, in the formula, R is going to be more than G, and that's not good.
And I'm not sitting here saying we're going bankrupt tomorrow. That's not what we're talking about here. This is about what's going to happen over the next 10 to 20 years, the kind of trajectory that we're on.
Yeah, we're going to have to see. Michael McKee's going to join us here in about 10 minutes, and we'll do the usual econobabble on CPI. But we thought, and this is a real treat for us, it could be a 3-hour conversation with Jonathan Miller. He's president and CEO of Miller Samuel. And all you got to know is when he wanders down Madison Avenue and he goes in 3 guys up by the Carlisle, the place comes to a complete halt. He is the most important person on real estate in this New York City, and I might add Miami and the rest of the country as well. Do we have a housing crisis in America, and do we see it in an inflation in housing that's 30% of the statistic we're going to see in 10 minutes?
Absolutely. It is a crisis. It's a crisis of affordability at all levels. If you think about the Fed pivot a year and a half ago, it's probably had a disproportionate impact on housing because mortgage rates are such a big driver of the housing market itself. Markets like New York are sort of, it's cash, or 60%, almost 2/3 cash buyers, but those cash buyers are still looking at the financial markets. It's not that they're not impacted by rising rates. They're impacted by Fed policy. And as a result, what we've seen is a sharp drop in sales over the last year and a half, both in cash sales and in finance sales. Cash sales are down about 20%, and finance sales are down between 40 and 50%.
Let's dovetail this into 9 minutes from now when we get CPI and we get the sense of inflation. How do you see rents and home ownership just generally feeding into the inflation narrative next year? Do you think that it is going to disinflate or reinflate some of the discussions?
I think the rental market is going to probably continue to disinflate, using your parlance. They've peaked. They peak in the summer seasonally, generally, in New York anyway, and we're seeing rents come down, but they're coming down nominally. The opposite of rising rents, as I've told you before, isn't falling rents, it's stabilizing rents. And I think we're looking at rents lower than peak, but not low, meaning that affordability is not materially improved.
Some people would argue that for rates to go back to even close to where they were before the pandemic, you would have to see a real decline in house prices. You'd have to see a real material shift in one of the biggest costs for Americans. Do you foresee that anywhere on the horizon?
No, simply because inventory is at, closer at all-time lows in many of the markets most of the markets around the country. That is the housing metric that has been the story.
Help us here, oh wise one. We're going to get this report in 7 minutes. McKee's going to go month over month, year over year. we're all living, our listeners, our viewers are living pre-pandemic. You have published the Miller rent inflation statistic is we're up 30% since pre-pandemic, since 2019. How long is it going to take us to lose that pain?
I would think 2-3 years, even with rate cuts. I think it's a while. Rental markets have momentum of being sustained at a very high level for a long period of time.
So we're going to be miserable here, seriously. I'm not making a joke, folks, till 2027.
I would think so. There's not going to be, at least based on what we know now, there's not going to be a rental price or purchase price correction. Unemployment is too low. Wages are elevated. It's hard to imagine. I mean, if you look at a Fed rate cut in the second half of 24, that's a year from now. So, and that's not going to change overnight. One sort of positive component to this is I think that any kind of rate cut on the set for sale market is going to have a disproportionately high reaction in terms of sales activity, that there's some sort of, the rate pivot interrupted what was this rocket ship of demand. So I think any minor cut is probably going to, we're not talking going to 4 or 3% at all. What we're talking and maybe going in the 6s from the mid 7s.
That's enough to grease the wheels?
I think that's enough to grease the wheels, at least in the near term. Remember, right now in the most suburban markets, we're looking at bidding war market share of 40 to 50% of closings.
Are still in a bidding war?
Absolutely. We had a lull in the summer. The suburbs that surround New York you're looking at 40 to 55% of the closings in the third quarter were bidding wars.
Could you see John, out in Larchmont or, up in
Bronxville?
Bronxville.
I look in Bronxville all the time. There's no supply.
you know.
There's no supply, Jonathan, coming online at all. It's the same old houses.
It's much tighter in the suburbs than it is in the city. If you're to buy, I'm not saying it's more affordable, but the city relative to most markets, because it was late to the party, actually has more supply. It's just still not.
You know anything in the 60s, 70s for John? He's, you know, we're out of
figure this out.
Evidently, he's looking at 5 houses in the city.
Based on TK's track record.
I feel like that's the only reason I'm brought on is to give you house hunting advice.
You got that right. You figured it out. Good, John Miller nailed that.
John Miller there of Miller Samuel. John, it's good to catch up. It's good to see you. Thanks for the clarity.
Good to see you.
The clarity on the housing market in this country, which is a difficult one for a lot of people I know. Coming up shortly, we'll get some CPI data in the next hour on Bloomberg TV. Aaron Brown of PIMCO, Robert Tipp of PGIM, Gargi Chowdhury of BlackRock, all of that and more. Mike McKee breaking down US inflation. Coming up next from New York, this is Bloomberg.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
On the next episode of the Business Week Show, reputation. People say, oh, well, LeBron gave you an opportunity, lucky you did this. But you don't talk about Donald Trump's dad gave him a loan, James Dolan's dad gave him a business. What's the difference?
I try not to care too much about what people think, and if that helps others see that there's more to life than a good reputation, that can be a positive step.
Watch the Business Week Show, Thursday nights, 10:30 Eastern on Bloomberg Television, or 8:30 on Bloomberg.com, or the Bloomberg app on connected TVs.
Worldwide, Bloomberg surveillance on radio and television. We are commercial-free through the rest of this hour. An important inflation report. Lisa, we say this every month, but all of a sudden it's superseding the jobs report is what matters for markets, what matters for the Fed.
And how does the market respond to a potential stickiness to inflation that everybody is expecting for an inflection sideways at 4.1% year over year at a time where the Fed is looking to get down to 2%?
Coming out in real time with an immediate lift to the market, 8, 9, 10 lines on ECO Go on the Bloomberg terminal. And of course, Michael McKee is here to tell us how much it's going to cost to stagger to the end of the year.
Less. And that's the good news. It's a rather amazing number this morning. CPI comes in flat. The estimate was 1/10, and it had been 0.4 back in September, and that leaves the year-over-year headline number at 3.2%, down from 3.7. The forecast had been for 3.3. But here's the big number: core 0.2. It rounds down to 0.2 from 0.3 last month, and that's a tick below what we anticipated, puts the year-over-year number at 4%, and that's down from 4.1%, which was expected. There was a feeling that we might see a stall in the numbers this month. You guys mentioned that, and it has not happened. Inflation not as sticky this month. It goes down, gives the Fed a chance perhaps to say we don't need to raise rates in December, and we'll probably see a market reaction to that effect. Tom.
I see 40 pages on your thing. Dive into a couple of those key paragraphs, Mike McKee. Lisa, markets moving, equities surge. We've got to begin to talk about taking out record highs. Not this moment, but there we are with SPX up a solid 1%, 4475. We may get 4,500 there. The Dow, we're not to 35,000. We may get there in time. NASDAQ up 1.6%.
16 basis point plunge in the 10-year yields. I'm looking right now at 2-year yields, absolutely tanking above 5% before this, now down to 4.87% just in real time. People shifting downward their expectations for how long the Fed could remain on hold. They are celebrating signs of disinflation that they were not expecting from this report, Tom.
Dollar weakness, but critically, the 10-year real yield. I'll have to get the chart out while Mike's giving us an update on the 10-year inflation-adjusted yield plunging down 14 basis points, as Lisa mentions. 2.18% on that statistic. It was 2.50% the last time the Denver Broncos lost. Mike, what do you see in inflation?
Well, the things that people have been watching closely have turned out pretty much the way they thought they would. We saw gasoline prices drop by quite a bit, by about 5% during the month, which really pushes down on inflation. But fuel oil also down 5%. Food up only 0.3, food at home at least. And then shelter costs, we're always looking at what's happening with shelter, and we'll break that down a little farther, but up by 0.3. So not as much. transportation services up 0.8, so airfares probably went up. Medical care services, I have to break this one down for you. That was in the news. It's up 0.3, which is probably less than anticipated. Here's the thing, the government once a year recalibrates
the autumn adjustment.
Health insurance.
Right.
And this month is that month, and the estimation was that they would show a big increase in health insurance, and I got to look deeper into the tables to find out.
But you do that right now. Lisa, bring us your insight. I want to make clear, folks, international ramifications on this report. Futures up a ginormous 53. Lisa, euro-yen is weak yen through 163, the knock-on effects on the far side of the world.
What I'm looking at right now is real average hourly earnings, which actually ticked up, and this I find interesting, to 0.8%. Basically, people are getting wages and they have more buying power.
Less inflation.
Because there is less inflation, which raises this question, can we hold? Is this going to be a temporary disinflation, or is this something that we can really hold on to? And that's what I want to hear from you, Mike, as you parse through all of the specific data points. Does this feel like a sustainable trajectory downward that is in response to people protesting some of the higher prices, not necessarily going with them, and that has some momentum behind it?
Well, I got to look, Lisa, here to see if I can see what refrigerator prices are doing.
Please.
But obviously, you're not protesting. And the thing, and we'll see tomorrow more with retail sales, the thing is Americans are protesting inflation, but they don't seem to be doing anything about it. I mean, it's a verbal protest, but they're not staying away from the stores, which has been good news up to now. So the question is, do they continue to do that? Health insurance, here we go, Tom, down by, no, actually rises 1.1%, but down 3.5% last month. So essentially what we're seeing here is a rise in health insurance offset by other things, and that seems to matter. Rent of shelter, you're talking with Jonathan just a minute ago, up 0.3. Rent of primary residence up 0.5%, which is his story. And then the owner's equivalent rent up 0.4. It was up 0.6 last month.
So it's up less.
So it's up less, and that may be the big contributor given the size of housing.
You mentioned
in
30% to
CPI,
me, the size of housing here. Michael McKee, thank you so much. Let me reset right now on Bloomberg Television and radio for you. Markets seizing up here, just huge moves. As Lisa mentions, in the bond market, 14 basis points, 4.50%, stunning, 4.50% for the 10-year. The 2-year was 5.04 the last time I looked, 4.90. Yields plunge, fixed income prices up, equity surge, SPX up 51, Dow up 300 points in the Dow, and the VIX, Lisa, under 14 really says it all, 13.99.
What a long, strange trip it's been, going from 5% to 5.5% in a couple of weeks on a 10-year yield. Is the Fed done? Is this basically what we're looking at right now? The all-clear sign for the Federal Reserve to have to do more. Jay Bryson, chief economist at Wells Fargo, joining us now. I ask that to you, Jay. Does this sound the all-clear for the Fed?
It does for right now, Lisa. I mean, these numbers are going to bounce around on a month-by-month basis. I wouldn't, our view is that the Fed probably is done, but I don't expect Fed officials to be coming out just because of this one report saying, oh, it's all clear, everything's great out there. I mean, I think they're still going to continue to be biased to potentially tightening. We don't think that will happen. But, if in the next few months these numbers kind of reverse and they kind of pop up and the economy expands at a stronger than expected rate, you could potentially see them going. But again, I think that's a high bar at this point.
This adds to signs that there is some sort of cooling, and this is the reason why so many people are talking about a soft landing, because you haven't seen the real cracks you'd expect ahead of a massive recession. Jay, do you think that that is an accurate categorization of exactly what we're seeing with prices not going up as much as people had expected?
Yeah, I think that's right. I mean, if we were still clipping along at a year-over-year rate on the core of a 5%, we'd be talking about the Fed hiking even more. And when you start to hike even more, that's when you have the problems. So the potential for a soft landing is still there. I guess what I'm a little bit still watching and concerned about is that the real Fed funds rate, the nominal rate minus some sort of inflation rate, continues to drift higher, and that's what matters for the real economy. And so I think the Fed's going to delay easing at this point. And so we may or may not have a downturn early next year, but I think the next few quarters, because monetary policy is going to remain restrictive, I think you're looking at headwinds on economic growth.
Is it mission accomplished? There's a comedy to that, a painful comedy for our geopolitics, our history, Dr. Bryson. But are we getting to a transitory point where this Federal Reserve can say mission accomplished?
Well, again, Tom, I don't think they're going to come out and say that right at this point. But, what I would say is the bar for further rate hikes is getting higher and higher at this point. Many of the members on the FOMC think they have done enough at this point. And, today's rally in the 10-year notwithstanding, we still have seen, relatively high long-term rates. And so there's a fair amount of headwinds on the economy right now. Again, they're not going to come out and say mission accomplished right now. They need to see a few more months of this before I think they feel confident in that. This is certainly a good start in that journey, but I still think you need to see a few more months of 0.2s before they say mission accomplished.
Lisa, the mission accomplished December 12th, a CPI report before a December 13th Fed meeting.
And just to really echo what Jay was talking about, that the bar is getting higher and higher for them to go again. Evidently, the bar is getting a bit lower for them to cut rates. Fed-dated swaps are now pricing in the first 25 basis point cut for June versus July before we got this print. Jay, there is this issue of what we're going back to. Are we seeing a fast enough pace of disinflation to believe that 2% is very much in the horizon? You and your team have been excellent about the last mile of getting inflation down from 3% to 2%. How far along that process are we?
So, if I don't have the numbers here in front of me, Lisa, but, I think if you look at the 3-month annualized change in the core, we're probably at 3.5% right now. So if you want to get back down to 2, what you need is a few months of 0.2s and even 0.1s to kind of get you there. And I think we're still looking at a number of months for that. We don't think we're going to be looking at that sort of number until the second half of 2024. But I don't know if we necessarily need to be 2% annualized for a few months before the Fed cuts. They're going to be looking forward, right? And if they are confident that things are really going to slow down, then they could start to cut rates, maybe summer or so of next year.
Dr. Bryson, thank you so much. The chief economist of Wells Fargo, Jay Bryson, this morning. Mike, you're diving in. The reason McKee does this, folks, and I don't, is the font is this big. I couldn't even see the page like you can. In that teensweens font you're looking at, what matters?
Well, the interesting number that everybody has been following for the last 6-8 months is Supercore, which is basically core services less housing, and that comes in at a remarkable 0.2 for the month of October. That's down from 0.6 the prior month, and on a year-over-year basis, that puts us down to 3.7%. So a major change in the Supercore because of the drop, I guess, in the slower rising core numbers that we saw. And then Lisa, I'm sure everybody is waiting to hear this, including you. You're a winner. Appliances went down 1.2% during the month, and major appliances down 2%. So congratulations on your refrigerator purchase.
You get a house, and you get it.
But this is what David Rosenberg would say. Every single little thing sums up to where we are in price change.
Which really leads to this idea of the soft landing that people are talking about, because real wages are actually increasing at an accelerating clip on the heels of this. How much are we getting a sense of the services versus the goods divide? Are you seeing services continue to go up even as you see the refrigerators and microwaves go down?
Well, I can call that up here on the Bloomberg model Ecan Go, which is a marvelous thing. And it basically gives us an idea of whether services and goods, core goods prices were up less than 0.1%, or services prices were up 4%. Now, those are both declines. So we're seeing a steady decline in both of those categories, but services prices are we're still seeing increases. Interestingly enough, I looked it up now, airfares were down 0.9, and that was a category that people thought might be a little bit higher.
Quickly here, what does it mean for retail sales tomorrow? John Farrow was saying that seems to be more important than the shock report. Could we get a shock retail sales tomorrow?
I don't do enough of the math, Tom, to know if it'll be a shock report tomorrow, but the drop in goods prices is what really affects the retail sales report, like refrigerators.
Refrigerators is a good, not a service sector.
Right, and we're going to talk about refrigerators at 8:30 tomorrow. And so we could see, it would show as a less of a gain because you're not including inflation in that, but there will be a separate category for Lisa Abramowitz refrigerators.
Michael McKee, thank you. And of course, his excellence through the morning here on radio and television. We welcome all of you commercial free towards 9 o'clock on this bombshell inflation report in America. David Kelly will join us. We're going to get to Ira Jersey in 2 seconds. Lisa, your thoughts on bonds?
The volatility that we're seeing is just shocking to me. And the idea that you could see a 15 basis point decline just like that on the heels of a 1/10 of a percentage point difference in inflation highlights how tightly wound everybody is. That is my question. Right. Does this stick? Is this the beginning of the big bond rally that so many people, including Bob Michael over at JP Morgan Asset Management, have been calling for?
Joining us now, Ira Jersey, Chief U.S. Interest Rate Strategist, Bloomberg Intelligence. Ira, there's so many moving parts here in this jump condition report. I'm going to give you an open question. In the matrix, the mixes, the analysis you have off the Bloomberg terminal, what is the fixed income pair, fixed income statistic that matters right now?
It's really that this is all from real yields. So this whole rally is not coming from a reduction in inflation expectations. It's all coming from expectations of the Federal Reserve, right? So, so when you look at what tips are doing versus what nominals are doing, tips are just driving everything. So, you know, Lisa mentioned, you know, is this the start of the rally? I think if this was the start of the rally, this would have to be the continuation because obviously yields were a bit higher not just a couple of weeks ago. But at the same time, you now have people starting to price for the Fed to cut earlier. You have, you know, real yields coming much lower, which is just a sign, I think, that people do think that there's going to be a soft landing here. And I think that the market is just reacting and maybe overreacting a little bit to these data.
What is the character in a December 12th report that has a 3-point-X handle on it versus 4.0 handle? How does that change or endure the bond world?
Yeah, so I think that continues a little bit of what we've seen today, where you have the belly of the curve, the 5-year part of the curve, rally a little bit more than the rest of the curve, primarily because if we do get another data, if we get a 3 handle on inflation, like you mentioned, Tom, then you're going to have the Fed on hold, if not the Fed, you know, cutting rates earlier. At least that's what the market will price. And I think the big thing is, and the big reason why you're seeing these moves in the bond market is just the expectation. Now, number one is data like this certainly takes another hike off the table, at least for now. And then if you do get that 3 handle on core inflation, then, you know, the Fed will be pretty comfortable in just saying, okay, we're going to leave rates where they are until we see inflation come down even further, but we're not hiking anymore. And I think today's move is an acknowledgement of that.
Ira, given that, why do you think that the market right now is overreacting?
Well, the liquidity is just not particularly good in the market. It's not this time of year. It's the entire market. So you have a large stock of debt, like we all know this, right? The deficits have been huge, and they're likely to be big going forward. So you wind up having a situation where you don't have the capacity in the dealer community and in people who disintermediate and intermediate trades just can't take the volume that has to go through now. So you wind up with, you know, relatively modest data like we have, and then people who are short need to cover. They wind up covering a little bit, and that little bit just can't go through the pipes the way that it has in the past. Lisa, so I think it really is all about liquidity.
Lisa, moments ago, and this continues, folks. This trend continues, and Lisa, you see it moments ago. Euro. 1.08. Weaker dollar, stronger core European holding.
And this also is tied to the Fed and the potential for them to not necessarily hike rates in additional time. Following on to what you're talking about, Ira, it's really important to highlight this lack of liquidity and the lack of conviction that some people have been having with some of the recent moves. This time does feel different if only you take a look at the Global Fund Manager Survey out of Bank of America, which showed suddenly people going long bonds in a material way. Why do you think that that doesn't signify some kind of real money shift that could underpin some of these moves?
Well, it could. Certainly people want to be. I think people are looking for an excuse to be long, and certainly data like this is long. But at the same time, I think a lot of people are very cautious. So a lot of the investors that I've talked to have been burned earlier this year. They got long at around 4.25%, and then of course you had the sell-off in 10-year yields all the way up to 5%. So that was a pretty painful trade. So I think people are legging into these types of longer positions, right? And at the same time, if you think about the front end of the curve, and I think one thing that is attractive about things like 2-year yields is that in the next year, you'd need interest rates to go up to 10% to start losing money by buying a 2-year, right? So that's what we call the break even. So there is risk reward that people are trying to figure out, I think, about how much risk are they willing to take given the environment.
Look at the 2-year yield, 4.86% right now, just extraordinary there, Lisa, to see. All of these dynamics continue here as Ira Jersey speaks. Ira, one more. We've got to get to Dr. Kelly at J.P. Morgan. Lawrence McDonald, one of the essays of 2023, says, forget about the nuance. There's just a wall, trillions and trillions of dollars out there. As a first-order condition, a wall of money out there. How does the wall of money of the global system, Ira Jersey, react to this shock report?
Well, I think that people are still liking the fact that they can make, over 5% sitting in cash. And so, but you do have incrementally people who want to come out, because if the Fed is done, typically duration does pretty well. So you want to be long and want to take a price appreciation and, buy bonds that are, there are some treasury bonds right now that are trading 50 cents on the dollar, right? So some people might be saying, okay, look, I can buy some treasury securities here and, play that price return as opposed to just sitting in cash and making my 5% yield. But I think, again, that'll be incremental over time, not all at once.
Quickly here, Lisa, the first guy I wanted to hear from, Neil Dutta, and you mentioned the real income growth. We're seeing lesser inflation amid income growth. Mr. Dutta at Renaissance Macro, it's a soft landing nirvana.
And let's see how long that can last. Is this just the beginning?
There we go.
Of
There's the
else?
Bramble gloom we need here. We're going to get to David. Ira Jersey, thank you so much. Greatly appreciated. I really want to emphasize, folks, off of 8:30, the shock, maybe a pause, and then we continue to move higher. Futures up 56, Dow futures from 300 up to 337, the VIX under 14, and the right guest at the right time to advance this conversation. David Kelly will adjust. He's Chief Global Strategist at J.P. Morgan Asset Management. With his years at Putnam knows when the facts change, he will change. David Kelly, how does your analysis change with this shock report? I got a technical issue there. It's the mute, but there you are, David. Start over again, please, David. We want to get that insight.
Yeah, so this report is actually very close to what we're looking for here. As we're tracing out inflation, we can see it coming right down to below 2% on the consumption deflator by the fourth quarter of next year. And I think what's really important about this report is there's a large camp of people who say that the last mile is sticky. Getting from 3 to 2 is sticky. And we don't see that at all. We're going to step down inflation all the way through the fourth quarter of next year. And what I think this report is showing is across the board, there's disinflation in the U.S. economy, and we're heading back to 2%. And I think that is gradually changing the minds of the markets. And I think that's why you're seeing this move here.
Although it's not necessarily coming with pain, David, and this goes to the soft landing nirvana that Neil Dutta was talking about, that real average hourly earnings increased by 0.8%, up from 0.5%. People's earnings are exceeding the pace of inflation in a material way for the first time in a long time. How much does that lead to a stickiness because people have the means to keep paying the prices?
I don't think so, because we've had periods of positive real wage growth before, But what I'm seeing looking at the earnings reports from the last quarter is companies are very focused on holding earnings in check. Now, yes, you can say that today's earnings are higher than inflation, but from a worker's perspective, they're not even getting catch up from all the inflation they saw over the last 2 years. So what you're seeing is partial compensation for previous inflation, but I don't see a lot of evidence that companies are being able to push higher prices, the workers being able to push higher wages. So overall, I think what we're seeing, we're not seeing a price wage spiral. We're seeing a price wage slinky. They're both gradually coming down the stairs slowly. I think this is just going to continue all the way to 2%.
And there's this question mark around, yes, this is definitely good for bonds, and you're seeing that rally in a massive wage day. Is this necessarily good for stocks over the longer term if it is accompanied with a cooling in the economy?
Yeah, I think it is. Now there are things that could go wrong, and there's certainly parts of the stock market that are overpriced. But I think what's happening is we're returning to where we were 10 years ago. We're returning to an economy with 2% inflation, very slow growth. That low inflation can allow for lower long-term interest rates, which supports all asset prices. So they will benefit from this lower rate environment. So, soft landings never last forever. They'll eventually be bumping the road and we'll fall into recession. But for right now, this does really show that inflation is steadily coming down, and we've got to recognize that's going on, regardless of Fed officials who occasionally say that we're not there yet or too early to declare victory. Look, I'm willing to say we're going to win this thing. It looks very, very likely that we're going to win this, get inflation down to 2% by the end of next year.
Small stocks, Russell up 4%, NASDAQ up 1.8%, though NASDAQ 100, I should say. Dow lags up 1.1%. Standard & Poor's 500 up 50, up 55, up 60, and now up 63 points, 1.5%. Dr. Kelly, I want to sum this up to the angst that Lisa Bramowitz has on our nation's debt. If we get inflation down, if we have a successful Fed, does that give you confidence that we can have a long-term R minus G relationship, R minus G equation that will mean our debt and deficit is of less fear?
A little bit. I mean, what you're basically saying is we can service this debt at cheaper prices no matter how large it is. Yes, we can to an extent, but I think the amount of debt we've piled up in recent years is going to mean permanently higher long-term interest rates than experienced 10 years ago. So that problem is going to be around for a while. And unfortunately, I see no evidence that there's any consensus in Washington about doing anything about it. So I'm still worried about populism on the left or the right just pushing these deficits higher and higher in the years ahead.
Dr. Kelly, thank you so much. David Kelly, JP Morgan. Lisa, I'm going to say this. I could be wrong. Everybody will come out with analysis better than me. I've never seen this. It's just that simple.
We are seeing the kind of rally in bonds, especially coming off some of the discussion from Bank of America, that indicates a shift in mood. That Fed basically is off the table in terms of another rate hike, that rate cuts are being brought forward in market expectations, and people right now, as we just heard from David Kelly, are saying we are going to win this thing. There is a feeling maybe this is not an inflation that can lead to 6, 7, 8% Treasury yields. That discussion, for now, is off the table, Tom.
4.48%. Let's Lisa, help me here with a data check as we close out this hour. I'm going to look at a 2-year yield, 4.87%, distant from 5.04. Truly a cup of tang ago.
That's the right yield to look at. I'm also looking at a 10-year yield down to 4.48% from near 5% not that long ago. Massive rallies across the curve, and you can see that dollar weakness, euro strength, 107.91.
Stay with us on radio and television through this shocking day. Ken Griffith in the 1 p.m. hour. Good morning.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
That inflation data woke up this equity market. Downside surprise and a surge in equities. From New York City this morning, good morning, good morning. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, stocks pop, yields drop, inflation coming in cold. Speaker Johnson looking to avoid a government shutdown, and President Biden and Xi looking to find a compromise. We begin with the big issue, disinflation in America.
This is just a really big week for the market.
The CPI data is a big data point.
The Federal Reserve still thinks that there is more work to be done.
They're vigilant around inflation.
Focused on inflation.
Very nervous about declaring victory and then having to undeclare victory. Markets obviously very focused on the core number.
Inflation is above target.
Still an issue. There is more to give in terms of inflation coming down.
There's a lot of disinflationary developments as of late.
Inflation's going to come down.
It is rowing in the right direction.
Pointing in the right direction.
Progress will continue. It's just going to be slow and bumpy.
It's not something that happens overnight.
Going forward, we're going to have this push and pull about inflation.
The market is all about inflation right now and what the Fed's going to do.
And we're going to talk about it with PGIM's Robert Tipp and PIMCO's Aaron Brown. Aaron, can the Fed declare victory?
Well, they've now paused for 3 out of the last 4 meetings, and I think that the bar for them to hike from here, particularly with these numbers coming in, is going to be really high. It's not to say that if we were to see another inflation spike early next year that they couldn't hike again, but I think we're probably past the point now, at least with conditions remaining as they are, for the Fed to hike again.
Look at the way the markets responded to this. A slight downside surprise on headline inflation, unchanged. A downside surprise almost across the board, and yet you've got an equity market on the S&P 500 up by 1.3%, the Russell up by more than 3%. You've got the NASDAQ up by 1.6%. And Robert Tip, in the bond market, we've got a major move at the front end of the curve. We're down 16 basis points. Maybe we need to get used to moves like this. I'm with you on that. On the 10-year, we're down about 15 basis points to break at 450 again. In your mind, Robert, can we well and truly put to bed the inflation scare of the last 2 years?
I think we can. I think the Fed can. And I think that is a great combination. You can see that all signs suggest that they're on the right path. Yields are up in a very healthy zip code for investors. And this is a fantastic environment where they're probably not going to have to do anything else. They will be on hold. But from their standpoint, they know where they want to be, which is kind of this situation I'm alluding to of inflation slowly coming back to target. They know where they definitely don't want to be. They don't want to be in the 1970s, getting all choked up. Because that was a terrible period, and there are a lot of false dawns. And the Fed, even in this cycle, has had false dawns. So they're going to stay pretty tough in holding their line against an early declaration of victory and keep rates high here, I think, for longer than people think.
Let's dig into the details. Headline, year over year, 3.2. Core, stripping out food and energy, 4.0. With the numbers, let's get to Mike McKee for more. Morning, Mike.
All right, let's take a look, John, at the good news this morning. You've already been talking about the reaction to it. It came in flat on a headline basis, helped by a 5% drop in gasoline. Nobody was surprised really so much by that, 3.2% year over year. But look at the core, 0.2. The lean was to maybe a 0.4, and so things changed there drastically and pushed us down to the lowest we've seen in quite some time, and it puts us at 4% year over year. Health insurance did go up, as did furniture, but not a lot else did. Decreasing, I mentioned gasoline. All these things go up in price, but by a lower amount. Housing, the owner's equivalent rent was up 0.6 in September, just 0.4 in October. So good news there. New and used cars fell. Used car prices fell 0.8%. Surprising a little bit to analysts who thought they wouldn't fall quite as much. And then Supercore, the one that Jay Powell likes to watch, this was good news as well. After rising 0.6 in September, it rises just 0.2 in the month of October. Big drop there. And then the overall number for year over year drops to 3.75%. So we're seeing some good news. And then you look at the healthcare issue. A lot of people thought we were going to see a rise in health insurance prices. We did, because the government recalculates. But what it ended up happening was the rise wasn't big enough to make a difference. It still was a negative print for health insurance, and so that helps hold down the overall numbers.
Mike McKee, thank you, sir, for the update. Further disinflation might be in our future. Neil Dutta of Renmac, lots of response to this reaction coming through. Here's one point from Neil this morning. Here's the quote. There is likely additional slowing in consumer prices on the horizon, particularly in core consumer goods. With the US economy holding up, the inflation data are soft landing nirvana for the equity markets. Erin, let's talk about that soft landing nirvana for this equity market. If you believe in further disinflation, I think we've got to have a conversation about what we're converging towards. Are we going back towards 2, or are we likely to get stuck around 3?
Well, I think right now what we're seeing is we're sort of gradually sliding into a softish landing. But I still think that inflation will take time to come down, and that will leave the Fed on hold longer than you typically see during a cycle. I think that the Fed is not going to, take its applause and take a bow with just one data print, and they're really going to wait to see through really the first half of next year to make sure that the data continues to confirm that inflation will fall. Now, I do think it will fall to a level slightly above what we've run in the pre-pandemic period. And so I think that's going to be the tricky argument, but it's probably a back half of the year argument and conversation that the Fed has to have, not one in the first 6 months of the year. What I do think is really confirms some of the supportive inflation data is if you look over the last year, and particularly over the last 2 quarters, what you're hearing from companies in the S&P 500 is that margin compression, margins, labor, all of those factors that really pressured margins in 2022 and also were the result of higher inflation are now starting to abate. And so we've now seen 2 quarters coming out from 500 companies in the S&P 500, all of which are suggesting that inflation is no longer as big a concern as it was in the past. And to me, that's what's most encouraging, the fact that you've seen such significant margin improvement in the equity market this year. And that, I think, is what's really bolstered equities this year and continues to drive some of the outperformance and enthusiasm today.
Do you see reasons then to bolster equities, for all of those things to bolster equities into 2024 then, Erin?
So I think it's going to be really a tale of two cities within equities. You know, the easy margin gains were gotten this year. I think as we look forward into next year, the bar for earnings is really high. Consensus is looking for double-digit earnings growth next year in an environment we're expecting pretty low nominal GDP environment. Typically, that's not, that doesn't make sense. Like, you don't have a low GDP environment and very high earnings. So I think you're going to see sectors that have gotten hit this year, that underperformed, that have clean balance sheets are going to be big performers next year, but sectors that are more highly levered, that are beneficiaries of this year's gains, like the home builders, auto manufacturers that are, you know, leveraged to consumer credit, I think those are going to get hit hard. So, you know, I think it's really going to be a bifurcated market.
That's the stock market call. Futures with a big move today. I keep looking at the Russell. The small caps up by 3.5%. In response to this small downside surprise on inflation in America. The move in the bond market, pull up bonds, 2-year, 10-year, 30-year. Look at the curve right now, down and down hard. The whole curve shifting lower. We're down 18 basis points on a 2-year. We were north of 5%. We're back to 485 on a 10-year, a break of 450 again. Let's call that 447, 446 on a 10-year this morning. Robert, let's talk about this. The 10-year peaked at around 5%. The 2-year peaked at around 525. A lot of people now concluding that was the peak. How much of a rally do you think is in store in this bond market? What are the limits to that bond market move if you're looking for yields to move lower?
You know, I think we're going to remain in this range. I think that, you know, our base case, you know, going back from when we cleared 4% at the end of last year, was basically that this is going to be an unusual bull market. It's not going to be a quick drop in rates back to the levels that we were at pre-pandemic that's going to get you good returns. It's going to be simply the level of yield itself. So I think we're going to remain range-bound around these levels. It feels good here. It feels like 5% is going to be the peak for the cycle, but I think we could spend a lot of time in the 4 to 5% range. I think the yield is going to accrete into solid returns, but I think the other thing is that having the pressure off the Fed in terms of hiking is very positive for ongoing growth, and that is a very positive environment for credit. You really want an environment where corporate managers are cautious. You don't want them unduly exuberant and leveraging up. So this is going to be an environment where spreads are likely to fluctuate around these ranges or grind tighter as people work their way back into the bond market.
Robert Sipp, Erin Brown, you're going to stick with us. We'll work through some of these markets, including bonds and equities going into the open about 20 minutes away. This move in the equity market, phenomenal. To see equity futures up 1.3% off the back of a small downside surprise on inflation, speaking to maybe what the market expected, which was maybe an upside surprise on inflation this morning. Didn't get it, a move of 20 basis points lower at the front end of the curve on a 10-year maturity. We're down about 17. Let's get you some movers going into the opening bell. Here's Abby.
It really is an incredible move on this lower than, cooler than expected CPI print, John. Those Russell 2000 futures heading to the best day since early June. As for big tech, there's a big lift. Lots of FOMO here, fear of missing out on the idea that maybe if the Fed is done, you want to be in on these names that benefit from lowering rates as valuation is less of a concern. Tesla up 5%. Take a look at Snap up 6.6%. There's a little bit of an idiosyncratic story to Snap as well, rising on a report that Amazon's going to allow folks to buy from their ads directly on the Snap ad. And then Amazon itself up 1.8%. Really a big rally. It's going to be interesting to see if it lasts through the day, John.
A big move on the FX market too. Abby, thanks for that. I think that's the question at this point. Will it stick? But at the moment, the euro stronger against the dollar for a third consecutive session, reclaiming 108, potentially the biggest move going back to July. And as things stand, the euro the strongest against the dollar since late August. Turning our attention now, coming up on this program too, a conversation on Speaker Johnson turning to Democrats to try and avoid a shutdown.
handful of far-right radical Republicans could kill this. But I think they want to give, at least on this first bill, they want to give Mike Johnson a victory.
Attempting to get legislation to the president's desk as Washington inches closer to a shutdown. That conversation up next.
Kenyan athletes are getting better and better, and their times are getting quicker.
Agnes Tirop takes the win and the world record.
With all the success, there also is a dark side to it. And this comes about when men in the community look at women as prey.
The sports fraternity is in mourning tonight. Our world beater Agnes Tirop was found dead today.
When you're moving into the career of athletics, you have to carefully look at who are the important people in your life. Even in a partnership, it can move into manipulation.
A lot of people let Agnes down. She felt that the threat was real. What she was told is exactly what happened to her.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
There's so much in the bill to hate. For the conservative Republicans, there are no spending cuts, and they're quite upset over that. For the White House and the Democrats, the fact that there's nothing for Israel or Ukraine is very troubling. And we can say, oh, we'll get them some money in February. Well, they need money now, and I think to not send our allies this money sends a very bad signal.
So everybody's unhappy, and House Speaker Mike Johnson is counting on Democrats. Lawmakers set to vote on his stopgap government funding bill in a procedure requiring a two-thirds majority, which Johnson can only achieve with significant Democratic support. Both sides of the aisle meeting separately to strategize ahead of an expected 4:20 p.m. vote. GOP hardliners making their displeasure clear over a lack of steep spending cuts. Democrats worried that the bill leaves out aid for Ukraine and Israel. Joining us now from D.C. is Katie Lyons. Morning, Katie.
Good morning, John. Well, as you say, because of the suspension of the rules that this measure is being considered under, it will require two-thirds majority. So 290 votes is going to be the magic number to get this two-step so-called laddered continuing resolution passed. It, of course, would continue a stopgap measure to fund the government so that there is no shutdown this weekend by extending funding for different programs to two different dates. First, January 19th, then a second tranche, including defense spending, to February 2nd. As you say, though, that because that this is a clean continuing resolution is what we call it here in Washington, which means it holds funding levels steady, does not give conservatives the deep spending cuts they were looking for. It is very likely that a number of Republicans are going to vote against this measure. That exact number is unclear, though enough have already come out against this bill that would mean that it does require significant Democratic support, again, because you're trying to get to 290 votes. Now, the Democratic leader, Hakeem Jeffries, heading into what he calls a family meeting this morning, did tell reporters that they are open-minded. Leadership has signaled that they are open to this plan because, yes, while it doesn't include Israel and Ukraine funding, it doesn't cut spending, and it would keep the government funded and avoid a shutdown. So this might ultimately be very hard for Democrats to turn down. Then, of course, it's going to become a question of what exactly it means for Mike Johnson if this does garner significant Democratic support, keeping in mind, John, that the last continuing resolution that passed under Speaker Kevin McCarthy was clean. It required Democratic votes, and it ultimately cost him his speakership. So Mike Johnson's future will be a little bit of a question here, as is, of course, the question open, what will happen when it reaches the Democratic Senate and ultimately President Biden's desk. Yesterday, he didn't suggest either way whether he's made a decision on signing it if it does make it to his desk or vetoing this measure.
It's like a sequel to the movie we watched only a month ago. Candy Lines, thank you. Dan in Washington, appreciate the update. Richmond Fed President Tom Barkin right now. The government shutdown impacts are historically modest. Robert Tipp, can we ignore this mess down in Washington?
You can't ignore it. I mean, it's disturbing. We have difficulties in just governing. And the ratings agencies are calling attention to this. The deficits are shockingly large for a peacetime expansion, peacetime for our country. That's something that on the margin is weighing on Treasury yields and is going to continue to weigh on Treasury yields. I think for the market, in terms of major disruption, the shutdowns are much less of a problem. Default risk, when you get to the debt ceiling, that's the big one. So I think in terms of the markets, it's less of an issue here. But in terms of the general trend of mild upward pressure on government yields versus everything else, that's a situation we're going to be living with for the foreseeable future.
Well, the trend right now is lower yields on my screen, lighting up big time. The 2-year down by about 19 basis points, the 10-year down by a similar amount. We're pricing in more rate cuts for 2024. That's the conversation as things stand. Aaron Brown, the conversation in D.C. has been the same one for the last 10 years, governance issues. Should those governance issues lead to higher yields? Does it make it more expensive for this government to finance the deficit, given the dysfunction in Washington?
Yeah, I think like the prior speaker just said, I think that the increased dysfunction that we've seen over the last decade or so does lead to more risk premium being priced into 10-year Treasury yields. And really, the dysfunction makes it more difficult for smooth government financing to occur, for the government to fund its deficits, to really, focus on its priorities. So I think that does, import some modest amount of higher yields on treasuries, but it's very hard to be able to disentangle how much is coming from, increased risk of government dysfunction. But I do think it matters.
This Treasury market just looks like a mess, Robert Tipp. Last week we had a sloppy bond auction on the 30-year, and yields were surging by more than 20 basis points at the long end. This morning, encouraging news. Let's be clear about that. We want to see more of this. Less of last week, more of this. Further signs of disinflation. And Robert Tipp, we've got another move at 20 basis points, this time at the front end. Robert Tipp, what are you making of just the day-to-day price action in Treasuries?
Yeah, and I want to take you back through the issuance aspect again. If you think back prior to the August refunding announcement and the Fed's shift to a higher for longer stance, we were kind of wrapped around 4% on the Treasury, and now we're up in more of like a 4.30 to 5% range. So I think the downgrades and the supply are really weighing on the back of the market more visibly than before. In terms of the day-to-day movements, that has been a feature. I think investors are really disoriented here. I think they're missing two aspects of the landscape here. The first one is that we were in a 10-year Treasury environment that was averaging about 2%, and now we're going to be up in a world that's probably in the 4 to 5% realm for the foreseeable future. As Aaron was alluding to, I think inflation is going to be sticky above 2%, and growth, for a number of reasons, I think is more resilient than people expect. As a result, even if you got the Fed funds rate coming down to 4%, and that is not on the Fed's radar, right, over the next year, you still, with a positively sloped curve, could have treasuries right in this realm. So I think the markets have not wrapped their head around the paradigm shift up to higher yields, which are much more normal. The second aspect is the cyclical. They haven't wrapped their mind around the fact that the Fed is likely to get marooned at 5 for quite a while, above 5, then a bit below 5. And that is going to be a serious influence on the bond market and the general range of yield. So while the market's in that realm of confusion, you're having these really violent day-to-day swings. And I think that's going to continue within an overall range around where we are here, kind of 4.30 to 5%.
What you just said is at the epicenter of a massive debate on Wall Street going into 2024, Robert. Erin, I want to share this view from UBS's Banner Buwaja, who says the following: we don't see the conditions for why this time is so different. Inflation is normalizing quickly, and by the time we get to March, the Fed will be looking at real rates, which are very high. The view from UBS is that rates fall to between 2.5 and 275 by the end of next year, and the terminal rate plunges to 125 by early 2025. Clearly, Erin, that's a view on the other end of the spectrum. Do you think they're wrong?
I do think that they're probably early in that call. Certainly I do think we'll see rates by the end of the cycle normalize back to the levels that they suggest. But I think in the very near term, it's going to be difficult to achieve, because what's different this time is that we really had an inflation scare that was persistent and well above the Fed's projections, either at the start of or the middle or even towards the end of the inflation cycle. And so it lasted much long. It was more of a supply-driven shock, which had ramifications multi-months and multi-quarters. And they continually had to revise up and were proved wrong with respect to their expectation for inflation normalizing. And so I think that recent shock will keep them a little bit more reluctant to aggressively cut rates this cycle, like you've historically seen during prior rate cutting cycles.
Too early to declare victory seems to be the conclusion from the two of you. Robert Tipp, Erin Brown, thank you very much for being with us. Inflation coming in softer, equities absolutely surging going into the opening bow. Coming up, the morning calls, and later, BlackRock's Gargi Chowdhury making the case for high-quality stocks with steady earnings growth. That conversation still ahead.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. We will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment case for this in the world.
DOJ or other authorities
could face bigger challenges next.
Was going to keep rating World Cup. This is a 3
as the economic picture,
covering the intersections of Hollywood, Silicon Valley, and beyond.
This US equity market off to the races big time. Equity futures up by 1.4% as inflation comes in just a little cooler than expected. That's the price action. Let's get you some morning calls. Bernstein upgrading Kraft Heinz to outperform, saying recent declines are now overdone. Wedbush downgrading New York Community Bank to underperform, pointing to macro headwinds and a challenging lending environment. And finally, Deutsche Bank upgrading Take-Two Interactive to buy, expecting shares to benefit from popular new releases over the holiday season. Coming up on this program, equity strategists taking their positions on the year ahead. We'll get the outlook from BlackRock's Gargi Chowdhury. That's next. Your opening bell just around the corner.
What do you worry most about your economy in Greece? When you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that, in 5 years from now, we will not have sacrificed, the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
25 seconds away from the opening bow this morning. Good morning. Snoozy start to the week. Big time snooze in yesterday's session. That inflation data waking up this equity market in a big way. The week begins right now with equity futures up by 1.4% on the S&P 500, up by more than 3% on the Russell, fueled by a downside surprise on inflation. There's your opening bow. Switch to the board and get to the bond market. Look at this for a move. Yields plunging on a 10-year, down almost 20 basis points to 4.44. It's a break of 450 on a 10-year yield to the downside. With that, tons of dollar weakness. A fair bit of euro strength on the euro right now, reclaiming 108 on that currency pair. The biggest one-day move higher, going back to earlier this year, back to February. Back to February, it's the highest on that currency pair since the end of August, 108.17. Crude with a rally up 0.8%, $78 and about 90 cents. 30 seconds into this session, equities moving one way. That's up and away. On the S&P 500, up by 1.4%. On the NASDAQ, up by 1.9%. What stock to watch at the open? Home Depot, the retailer, topping Q3 profit estimates, but delivering a warning about the U.S. consumer. Abby has more. Hey, Abby.
Well, John, if ever there was a day to deliver actually bad news. Home Depot talking about weakness ahead and essentially lowering the forecast. It was today because a rising tide seems to be lifting all boats. Home Depot heading toward its best day since November of last year. Now, a piece of it could be the fact that Home Depot on the year down 8%. So with this macro story developing around the idea that maybe inflation has been beaten and that yields are going to come in, the beaten down catch-up stocks are perhaps catching up. That seems to be the case with Home Depot. As for the quarter that was, they actually beat ever so slightly, but it's the guide. It's the same store sales down. They're looking for 3 to 4% down versus what had been 2 to 3% down. Earnings expected to fall 9 to 11% versus down 13%. Again, the stock up 4.6%. So a bit of that catch-up feel. Apparently, folks are still spending on small projects, but not so much on the big ticket projects. This stock, which had, again, been down almost 9% year to date coming into this print, closer to flat on sort of a mediocre report, but investors choosing to see the potential bright side.
That move, Abby, and Abby, thank you, has next to nothing to do with the numbers we got this morning. Let's be clear about that. This whole equity market is higher across the board. Every single sector on my screen right now is in the green. Top of the pile, real estate up by close to 4% as yields reprice aggressively lower. Consumer discretionary higher by 2.4%, utilities up by 2%, information technology up by about 1.5%. Let's stick on tech. Snap reportedly reaching a deal with Amazon, allowing its users to shop directly from advertisements on the Snapchat app. This according to the information. That stock, Kate, absolutely flying this morning.
Yeah, John, great news. Let's say that you're scrolling through Snapchat, you're taking a look at your friends' stories. If you come across an Amazon ad, you see a product that you like, you'll theoretically be able to shop directly from the app. Now, that is according to an Amazon spokesperson. It's been reported out by the information that U.S. customers would be able to check out with Amazon without leaving the Snap ad and also see the Amazon items' estimated delivery times, the real-time pricing, Prime eligibility, etc. Now, this is similar to a deal announced last week between Amazon and Meta for shopping in Facebook and Instagram, some of their app portfolio. And the thinking is that this could make these social media platforms more attractive to advertisers. We know that's been a challenge space, and that logic helps explain the currently 8% jump that we're seeing in Snap shares so far this morning. For 2023, Snap shares are higher by more than 35%, John.
Amazing. What a move this morning. Katie, thank you. What a move across the board. Let's stay on big tech. Let's stay on Apple. Shares moving higher after iPhone maker Foxconn topped profit expectations, signaling better demand for the devices. Ed Ludlow joins us on the West Coast for more. Morning, Ed.
Yeah, good morning, Jonathan. Apple up around a percentage point. It has pared some of its early gain from the open. Some of that momentum, of course, coming from the read-through into equities after the CPI print. But the catalyst is Foxconn, or Honhai Precision Industry Co., the main publicly traded arm of Foxconn, reporting third quarter earnings. They had a sort of surprise net income figure of $1.3 billion US above estimates. But the outlook for the holiday quarter, the December quarter, was for sales to decline. That would represent the third straight quarter of sales decline. And given that this is the principal contract manufacturer or assembler of iPhones for Apple, the concern is that that is indicative of the downward momentum we've seen with iPhone 15 overall, tracking the third-party data as we've done on this show. It's also kind of a poor milestone for Foxconn itself. Analysts expect sales to contract 4% in the quarter, 6% overall for fiscal 23. That would represent the first full-year sales decline for Foxconn going back to 2016. Apple higher still, though, 0.9%. We always try and read the tea leaves of a name like this in the supply chain for Apple, but the market seems positive this morning, Jonathan.
Across the board, not just on this name. Ed, thank you. That name is up by about 1%, by the way, for whatever that's worth. The broader equity market right now, super constructive, lagging as you might expect in this kind of environment. Healthcare, staples, only 36 names, 35 names now on the S&P. Make that 34. It's moving as I read it. 34 names on the S&P 500, negative so far in today's trading. The rest of this market doing better than good. Let's turn to semis. Nvidia looking to match its longest winning streak in nearly 7 years, going for a 10th day of gains after adding roughly $200 billion in market cap this month alone. Simone Foxman on top of this one. Hey, Simone.
Hey, John. Yeah, NVIDIA really going with the flow this morning. Shares up 1.8%, but well ahead of the flow for this year when you look at 239, close to percentage point gains so far this year. The best performing component of both the NASDAQ 100 and the S&P 500 index. Yesterday, we saw a bit of a gain as well, despite a down overall market, 0.6%. Part of this was because of the announcement of an H200 AI processor. This is an upgrade from that game-changing H100 processor and using a high bandwidth memory called HBM3E that allows these chips to bombard software with big data sets much faster. This is what you need to do if you're going to recognize data, if you're going to recognize speech and images. Extremely high demand. The company saying yesterday when it had made this announcement about the H200 that Amazon Web Services, Google Cloud, Oracle Cloud will all use it starting next year. But it's good for the company, which has seen more competition lately from the likes of AMD and Intel, a rare upgrade to these data center GPUs for NVIDIA. This new innovation, Bloomberg Intelligence says, will allow the company to defend its turf. Next catalyst also on the horizon, earnings, November 21st, John, but so far gains today.
So thank you. NVIDIA up by 1.7%. Broader market about 7 minutes into the session up by 1.4. NASDAQ up closer to 2% higher. Lots of reaction. Keep it coming this morning. This from Tony Dwyer of Canaccord saying inflation isn't going to be investors' problem once the rally into year-end plays out. Goes on to say, the main issue would likely be the reason for less inflation. This is what Tony has to say. Weak economic growth. He says, though, acknowledges that is a topic for a different day. It's not the topic for today, that's for sure, based on the price action we see on the screen, with the Russell up by more than 3%. BlackRock's Gargi Chowdhury discussing the outlook for markets, writing this, quote, historically, the end of a Fed hiking cycle has spelled good news for bonds. We believe the time has come for investors to step out of cash and capture opportunities in fixed income. Gargi, I'm pleased to say, joined us right now. And I'll say this up front, Gargi, you did publish this, you wrote these thoughts before this number this morning, not off the back of it. So let's start there. Why is now the right time to move out of cash? And do you think we've seen enough to really break the wall of that money market dam?
Sure. Good morning, Jonathan. It's great to be here. So as you said, the note was certainly written before today's excellent CPI print, something that investors should be celebrating. And the reason we think that investors should be stepping out of cash is we've done some work around this, and the right time for investors to outperform cash in both high-quality parts of the equity and fixed income market is not actually when the Fed cuts rates. It's that period of pause. And I think based on the data today and based on the payroll data from 2 weeks ago, we can safely say that that period of pause has now begun. So I think we have a really great 6 to 10 month opportunity where high quality fixed income and high quality equities will outperform cash, and the $8 trillion of money market funds that are sitting around globally should hopefully be stepping into the markets, and we're beginning to see that in ETF flows already.
Agagi, just build on that. 6 to 8 months of equities and bonds performing well, or specific parts of the equity market and not the index?
Yeah, so let's start with the fixed income market first, because I do think I have a little bit of a stronger conviction there. And, you know, we've been talking about that on this show in the past. We've talked about how bonds are back as an income generator in a portfolio, and perhaps even, especially in the belly of the curve, a diversifier in the portfolio. What we saw today in the CPI number was further proof to that point. Number one, the deceleration in shelter inflation. That was really heartwarming. It wasn't a good story. This was a shelter story. Number two, this print points to much weaker PCE, which, as we know, is the Fed's preferred measure of inflation. So weaker than expected PCE is going to follow this CPI number. And thirdly, the measure that the Fed themselves look at, the core services ex housing, that continues to decelerate. All of this points to a Fed that just does not need to be as restrictive. Does that mean that they cut rates this year? No, of course not. But it does mean that next year they will begin to open the window to lower rates, not as restrictive as they are. that benefits the belly of the curve. And by that, we mean the 3 to 7 year part of the treasury market, the TIPS market, the mortgage market, tremendously. Perhaps even the IG credit market, tremendously. So that's one of the biggest convictions we have going into the end of this year and into the first couple of months of next year.
So, Gagi, a lot of people listening to this program right now will have heard a lot of people saying the same thing. It's reflected in the fund manager survey over at Bank of America. These numbers, 76% say the hiking cycle is over. 80% expect lower short rates. A record 61% are looking for lower yields, and just 6% see higher CPI in 2024. It's not for me to say they're wrong. The consensus could well be right. Gagi, I'm just wondering if there's anything that makes you nervous about next year, given how much we all got wrong in 2023.
Yeah, absolutely. And these are markets that definitely make us all very humble. So we have to consider where we could be wrong. And the first one that I think about is reacceleration, especially on shelter inflation. There are some measures of rent that have turned a little bit higher, so I am watching that. Number two is the labor market. It's all been around, and Chair Powell has pointed this out. He has talked about this labor market coming back into balance. He mentioned immigration 3 times in the last FOMC press conference, just in terms of the supply of labor in the labor force. If we see that the labor force is not back in supply, if we continue to see wages reaccelerate, if we continue to see jobs growing at 200 or even higher than that, 1,000 per month, I do think that sort of raises a question of the Fed having to do more. They might not want to, but for them having to do more. So that's certainly a worry. And then I am also worried around deficits. Obviously, watching some of these debt to GDP numbers, looking at the interest expense as a percentage of payments, those are some concerning numbers. But I think that plays out in the longer part of the Treasury market. I think that's a concern for the 30-year, maybe perhaps the 20-year. I'd still like to keep the duration a little bit shorter, but certainly those are concerns on the horizon, and we have to remain humble about them.
Gagi, it's really interesting that when I think about, and got you to think about what you were nervous about maybe getting wrong next year, was that the economy could outperform your expectations, not underperform. Could we have a conversation about the latter and not just the former? Because I got a note from Tony Dwyer just a moment ago saying that this rally can play out off the back of this disinflation stuff. I'll read the quotes here. Inflation isn't going to be investors' problem once the rally into year-end plays out. He's talked about equities. The main issue will likely be the reason for less inflation, weak economic growth. He says that's a topic, though, for a different day. Gagi, this morning, I think a lot of people are embracing the idea that the inflation scare of the last 2 years is over. We heard from Neil Dutta, Renmac. He said it was soft landing nirvana for the equity market. That may well be a moment in time and not the ultimate destination. Do you think we've paid the price for the effort the Fed has gone to get inflation down? And are these figures this morning a reflection of supply-side dynamics and not the demand-side hit that could well be in our future?
Sure, Jonathan. So I think it's a little bit of both. There's certainly a little bit of supply dynamics, which is playing out in the goods inflation story. Obviously, this is the 5th straight month of deflationary prices in the goods category. But I certainly, when I look at the services category, I don't think that's just a supply side story. I definitely think there is a demand side story there. But I'll go back to your broader point, your earlier point, which is around when is this around a slowing economic growth? When does that come into the picture? Certainly, there has been a little bit of bite that we have seen on the consumer. When we look at the credit card delinquencies numbers, the auto delinquencies numbers, those are picking up ever so slightly. You need a magnifying glass. Certainly something to watch for. When we talk about our year ahead outlook, which is coming on December 5th, we're really talking about the next quarter or so for how ETF investors should think about the market, maybe the next 3 to 5 months. And I don't see a meaningful slowdown in the consumer in the next 3 to 5 months. I think when we look at the back half of 2024, there can certainly be some room for concerns there for the U.S. economy. But again, looking into the end of this year and for the first couple of quarters of next year, I think we're definitely going to slow down. We cannot expect to see a 4.9% U.S. GDP print. But I don't think those are negative numbers either.
Gagi, let's catch up again once that outlook is published in early December. I'm looking forward to doing that. Gagi Chaudhry there of BlackRock. Appreciate the update from BlackRock and the team. The S&P up by 1.5%, the Nasdaq up by 2%. You've got the Russell of small caps surging by more than 3%. If you're just joining us, you've missed out in the last 60 minutes. Inflation data coming in just a little softer, cooler, colder than expected. Not hot, better more disinflation off the back of that. Equities absolutely surging, bonds rallying too, yields dropping aggressively, and the dollar a whole lot weaker. Coming up on this program, a high-stakes meeting between President Biden and China's Xi Jinping.
We anticipate that the leaders will discuss some of the most fundamental elements of the U.S.-PRC bilateral relationship.
Team coverage up next.
On the next episode of the Business Week Show.
Reputation. People say, oh, well, LeBron gave you an opportunity, lucky you, you did this. But you don't talk about Donald Trump's dad gave him a loan, James Dolan's dad gave him a business. What's the difference?
I try not to care too much about what people think, and if that helps others see that there's more to life than a good reputation, that can be a positive step.
Watch the Business Week Show, Thursday nights, 10:30 Eastern on Bloomberg Television, or 8:30 on Bloomberg.com, or the Bloomberg app on connected TVs.
I do think what we are going to find is that outside of a very few industries and sectors, governments are not going to be willing to subsidize indefinitely production that brings it home or brings it to allies. And so the benefits of international supply chains that we've seen over 40 years, from economies of scale, from specialization, from innovation and the like, those aren't going to go away. And so if you don't have an international supply chain, you will be beat out by competitors who do.
So I think what we're looking to do is to maintain a trade policy which is based on openness, which is based on sustainability, which is assertive, where we need to be assertive and defend our rights, but certainly not one which is going to be closing down unnecessarily our trade and investment relationships with the rest of the world.
Globalization, that open supply chain, global supply chain is really important for the life science industry, particularly pharmaceutical supply chain. You think about the stress the pharmaceutical supply chain has been under since COVID-19, the war in Ukraine, not to mention the geopolitical tensions, if you will. We don't have the luxury of saying we can temporarily stock out on our product, because these products, these medicines keep people alive.
Season is here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power.
We're going to make more money. We're going to make more money. And we're going to make more money. We're making bank. And I think that is what we can take away.
Bloomberg Television and Radio. Context changes everything.
On Wednesday, as you have heard, President Biden and President Xi will meet in the Bay Area for a summit. We anticipate that the leaders will discuss some of the most fundamental elements of the U.S.-PRC bilateral relationship, including the continued importance of strengthening open lines of communication and managing competition responsibly so that it does not veer into conflict. The way we achieve that is through intense diplomacy.
National Security Advisor Jake Sullivan on Wednesday's high-stakes meeting between President Biden and China's Xi Jinping in San Francisco. The two leaders speaking for the first time in a year. On the agenda, an agreement that would see Beijing crack down on the manufacturing and export of fentanyl, potentially delivering Biden a major victory on an issue voters say is a priority for the 2024 election. Your team coverage starts right now with Bloomberg's Enda Curran and Nick Wadhams joining us down in D.C. Nick, let's begin with you. The priorities for this meeting for President Biden, Nick, what are they?
Well, obviously, fentanyl, as you mentioned, is a big one. But really what we're seeing from the Biden administration is a strategy that's aimed at essentially trying to arrest the slide in relations that's been happening over the last couple of years. And, you know, there's a real challenge there because while the U.S. has been sending numerous officials over to China to talk, to try to get this dialogue back on track, at the same time, you have both sides essentially accusing each other's armed forces of increasingly provocative actions in the South China Sea. So I think what you're going to see here is the administration really trying to thread this needle between saying, okay, we're going to stick up for our interests and call China out when we think it's doing something wrong, but at the same time, you know, we want this dialogue to continue. The big question coming out of APEC is, okay, what can you actually produce? A fentanyl agreement would be pretty interesting. That could be a deliverable for Biden, but beyond that, the administration is still grappling with where the relationship goes from here.
There really are incentives, though, on both sides to have some kind of breakthrough on something this week. And I'm thinking about the charm offensive that many are expecting, including myself, from Xi Jinping. And not just towards President Biden, but maybe towards corporate America. And what's in store?
Yeah, I think China's ultimate ambition, like Nick was saying, is to stabilize relations, but to send a message also that China is open for business. I mean, investor sentiment towards China has turned so negative, both in terms of investor portfolio flows and actual fixed asset investment in recent years, that the Chinese authorities are now really trying to turn that around. APEC, of course, is a great opportunity. You mentioned there will be that dinner with global executives, with Xi Jinping, after he meets with President Biden. That's, again, the kind of classic stage where President Xi will make the message that we're open for business, we're willing to work with you and to open up our market access where needed. So quite apart from the areas of tension on national security and human rights that Nick was talking about, I think when it comes to economics and trade, at the very least, Xi wants to stabilize relations and just say, look, nothing has changed, we still have scale, come and do business.
This is what makes it really difficult, I think, Nick, and you're dead on, right on, for pointing out the end game here. How does the president of China come across the United States and try and communicate to corporate America that we're a good place to invest after that negative FDI read that we had in the last couple of weeks, when we don't know what the end game will be for this relationship between the United States and China in the coming years?
Well, that's really the big question that is essentially on every single investor's mind in the United States. And, you know, there's in some ways not all that much that President Xi Jinping can say to counter or drown out the voices in the United States. I mean, China hawkishness, the hawks are so ascendant in the U.S. right now. President Biden is under so much pressure, especially from Republicans in Congress, but also among many Democrats, to impose more sanctions, more limits, more export controls. And, you know, it's just coming into 2024 in that election cycle, there's really going to be a very, very difficult task ahead for Joe Biden to say, listen, now might be the time for some sort of, if not accommodation, at least cooperation. And he has not figured out how to balance those two things. And needless to say, the pressure from Republicans in particular is only going to get stronger. So, you know, I'm not really sure what Xi Jinping can say to corporate America to sort of alleviate those concerns and say, okay, it's safe to put your money here, especially ahead of 2024 and all the uncertainty around the possibility that Donald Trump, who just loves imposing tariffs, could bring those back, is coming back into office in 2025.
And those Trump tariffs are still in place. Nick Wadhams and Karen, tricky time for both leaders. Two of the very best here at Bloomberg, covering the big story over the next 24 hours. Coming up on this program, your trading diary off the back of a stellar rally so far this morning.
there's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
What a move off the back of a small downside surprise on inflation. The small caps with the best move of the year so far. Let's get to the trading diary. Your day ahead looks like this. The House expected to vote at 4:20 p.m. on Speaker Johnson's stopgap bill. Wednesday, PPI and US retail sales and earnings from Target, plus Biden and Xi meeting on the West Coast. Thursday, another round of jobless claims and earnings from Macy's, Walmart and The Gap. Finally, Friday, the US government shutdown deadline. From New York, that is it for me. Thank you for choosing Bloomberg TV. This was the Countdown to the Open.
Kenyan athletes are getting better and better, and their times are getting quicker.
Agnes Tirop takes the win and the world record.
With all the success, there also is a dark side to it. And this comes about when men in the community look at women as prey.
The sports fraternity is in mourning tonight. Our world beater Agnes Tirop was found dead today. When you're moving into the career of athletics, you have to carefully look at who are the important people in your life. Even in a partnership, it can move into manipulation.
A lot of people let Agnes down. She felt that the threat was real. What she was told is exactly what happened to her.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. A dovish, tamish inflation print this morning has markets moving higher. We'll break it all down going forward. We're going to check in with Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence, get his sense of where we are going forward with some rates. Paige Smith and Scott Carpenter, reporters for Bloomberg News, join us to discuss their big take story on Wall Street profiting from unaffordable car loans. Amazing story, amazing interest rates being charged for some of the folks out there. And then we're going to break down that CPI data with Jennifer Lee, senior economist at BMO Capital Markets. She'll join us to give us her thoughts there. We're going to kick this whole thing off right now down in Washington, D.C. Nathan Hager's got a Bloomberg Business Flash for us.
Watching stock surge and bond yields tumble. Soft landing nirvana, Paul, is how Chris Zaccarelli at Independent Advisor Alliance is describing this October consumer price index that showed slowing inflation across the board for the month of October. 3.2% is the headline level on a year-over-year basis. Economists surveyed by Bloomberg were looking for 3.3%, and the core measure dropped to 4%. Wells Fargo chief economist Jay Bryson says the Fed's got the all clear to keep interest rates on hold for now.
Our view is that the Fed probably is done, but I don't expect Fed officials to be coming out just because of this one report saying, oh, it's all clear, everything's great out there. I mean, I think they're still going to continue to be biased to potentially tightening. We don't think that will happen. But, you know, if in the next few months, these numbers kind of reverse and they kind of pop up and the economy expands at a stronger than expected rate, you could potentially see them going.
We check the markets for you all day long here on Bloomberg. Right now, the S&P 500 is up 1.8%, up 80 points, 4491, close to 4,500 now for the S&P level. Dow Jones Industrial Average up 1.4%, up 473 points to 34,810. The NASDAQ is up 2.25%, up 312 points, 14,080. Is the NASDAQ level. 10-year Treasury is up 1 in 16 30-seconds. The yield 4.45%. Yield on the 2-year 4.85%. NYMEX crude is up 1.25% to $79.23 per barrel. COMEX gold up 1.1% to $19.7210 per ounce. The euro is at 1.0832 against the dollar. British pound 1.2458. And the yen is at 150.78. Thank you, Matt Miller, for the correction on that soft landing nirvana quote. That was from Neil Dutta of Renaissance Macro Research. We regret the error. That's the Bloomberg Business Flash. Bloomberg Markets is on with Matt Miller and Paul Sweeney.
I only know because Tom Keene called it out as soon as Neil sent the message on Bloomberg Surveillance this morning.
Great quote.
Yeah, it is a great quote. And I was listening to Bloomberg Radio in a great way.
How?
I was using the app on my Apple CarPlay.
Look at you getting all technical. Bloomberg is now in your dashboard with Apple CarPlay and Android Auto. It gives you access to every Bloomberg podcast, live audio feeds from Bloomberg Radio, print stories from Bloomberg News in audio form, and the latest headlines at the click of a button with Bloomberg News Now. How do you get it? Well, it is free with the latest version of the Bloomberg Business app. That's the Bloomberg Business app. Get it on your iPhone in the Apple Store or on Google Play. Just download the app, connect your phone to your car, and get started. And it's all presented by our sponsor, Interactive Brokers. So we're getting all kinds of tech.
You know what else you can listen to on the Bloomberg Business app?
What's that?
Is my new podcast.
Really?
Hot Pursuit.
Oh, that's with Hannah.
The weekly podcast I put out with Hannah Elliott.
Nice.
And I think the last episode was our best yet because we had a special guest, and that was Jason Chinook, the CEO of Ducati North America.
Talking some motorcycles, some fast motorcycles.
It gets a little bit in the weeds on motorcycles.
Exactly.
Hannah said, maybe a little bit too niche. But I thought it was good, and my wife liked it too, so there you go.
Oh, so were you getting all the demos out there?
Hot Pursuit.
download it today wherever you get your podcast. That's what the kids do. All right, Matt Miller and Paul Sweeney, we're live here in the Bloomberg Interactive Broker Studio. We are also streaming this video thing on YouTube, so head over to youtube.com as well and check that out. Markets just ripping today on that tamer than expected inflation print. Maybe folks are saying peak rates. I don't know. Bailey Lipschultz, he joins us. He covers all the markets for Bloomberg News. He joins us live here in our studio. Bailey, what are you looking at today?
Yeah, 10-year yield back to the lowest level since late September, as you mentioned, after that economic data. We are seeing the entire Magnificent Seven group lifting major averages. Amazon up 3%, Apple up 1.5%, Microsoft 1.4%, Tesla up almost 5%. So risk on rally indeed. We also are seeing notable strength across some of those beaten down solar equipment and fuel cell stocks. So your best performers, among the best performers in the S&P 500 this morning, In-Phase Energy, ticker ENPH, and Solar Edge Technologies, ticker SEDG. So seeing a lot of movement after that inflation data. One other stock that is up 5.9%, that's Home Depot, ticker HD, warned of weakness in big ticket item pullback. Analysts calling results better than feared, talking down really some of those expectations going into 4Q. But broadly speaking, that updated guidance does show, at least according to most on the sell side, that the worst case scenario is now off the table. So we are seeing some pretty strong strength in Home Depot, a store that I have been frequenting quite a bit in the last month.
Exactly. Just bought a new house, just moved in. You got a lot of projects around the house to repair?
Not a lot of repairs, but I did rake this weekend.
Look at you.
So
see, now here's a pro tip. You're in the top of the first inning for leaves coming down. Don't go crazy here just to impress your wife, because you're going to really need it in like 3 weeks' time.
I don't like that, because I spent hours on Sunday mowing and taking care of leaves and taking them from the backyard, moving them to the humongous
See,
pile in the front
I had
yard.
people for that.
I was going to say, it's admirable that you're doing this now, but I guarantee 100% that by next year at this time, you will be paying a service to do it for you.
That's what everyone says.
It's so much work, dude. You can only do that much work if you don't have a job.
I just turned 30, though, so I got to try to stay young. Try to stay young.
Just turned 30. Wow.
One other company that's sharply lower, C, ticker SE, down 15%. So this is one of those Singapore-based technology companies. Before the bell, reporting adjusted EBITDA, trailing Wall Street expectations, flipping to a loss. This is still a $22 billion company. Analysts calling out that some of that spending is likely to try to fend off rivals like Alibaba and TikTok. But when you look at the C chart, really just pretty ugly. Again, kind of an exemplifies some of the issues that we've seen for foreign-based companies listing here in the U.S. Like, why buy a company, at least according to some investors that I talked to, why buy a company like C when you can put that money to work in the likes of an Amazon?
Great story out on the Bloomberg terminal talking about Meta, our good friends at Facebook. Stock's up like 190% year to date. Meta has more Wall Street fans than ever, has rallied near 300% off of the bottom. So of the 70 analysts tracked by Bloomberg that cover the social media giant, 62 have buy equivalent ratings on the stock. That's the highest number since the firm's initial public offering in 2012. Stock is just ripping. And it was, you know, this is since this thing came public, it was all about top line growth, top line growth, top line growth. And then they got on the expense savings kick last year, which the stock market loved. And that worked. And now they're saying, hey, we're going to get some top line growth coming back. So, wow.
By the way, I wonder, I think to myself, it can't be Facebook, right? Because people don't use Facebook.
I use Facebook as a new homeowner.
Yeah, and I was just was reminded of the fact that my wife and I, we actually use Facebook a lot for like neighborhood groups. There's always a buy nothing, group in your area where you give the stuff you don't want and take the stuff that you don't want to buy but get for free. So it actually really does have a lot more uses than I would have thought about just as a typical social media platform.
You're on the gram though, right? You're an IT.
Yeah, of course. I mean, I know Instagram
and WhatsApp. I mean,
WhatsApp.
Everyone in the world uses WhatsApp.
They just have to figure out how to monetize that better. Yeah. That's the big upside there. All right, so Meta's up big, and it's got everybody and the brothers recommending 70 analysts on one stock. What's wrong with Wall Street research? There you go.
By the way, I looked at the WIRP function, WIRP. We are now pricing in, the market is now pricing in 4 rate cuts next year.
Don't listen to Jay Powell, apparently.
Yeah, I know who to listen to when you talk about that stuff. All right, Billy, thanks so much for joining us. We appreciate that. When you want to talk rates and Fed and all those banker stuff, you turn to Ira Jersey. You know, you head down the Turnpike, the Parkway, Route 1, you get to Princeton, New Jersey, and that's where Ira Jersey is with the Bloomberg Intelligence Strategy team.
By the way, on your way there, you can stop for gas and fill up for what, $3.13?
Yes, on Route 71 in Wall Township this weekend.
Which
all-time
is,
low.
you know, just a drop for the energy prices. And that's part of the reason, Ira, that we saw this inflation report come in light. It's good news, obviously, for the Fed. If you buy it, it's good news for the country as well. Does this mean no more hikes are necessary?
Yeah, I think this number takes hikes off the table, I think, at this point. And like you mentioned, the WIRP function and just looking at what short-term interest rate products are doing, we're now pricing in for even more cuts in 2024. I'm still skeptical that the Federal Reserve will actually cut, but certainly the market is thinking that there's a risk of that. And this is what's been happening, though, is that the market's been extrapolating these trends from single numbers. And we have to think that, okay, maybe we got a 0 inflation this month, but next month if we get a 0.1 or a 0.2, it's still slower inflation than we had earlier this year, but it's still not going to be necessarily near the Fed's comfort zone, at least not yet.
So what other parts of the market do you look at to get a sense of kind of where future rates may go here?
Yeah, so the big market now, it used to be the euro-dollar market, and not meaning the actual dollar, but meaning dollars in Europe and interest rates on short-term products. So if you look at the SOFR futures now, you've seen a big shift over the last 2 weeks where SOFR was thinking at the end of 2025 was going to be that we were going to have short-term interest rates somewhere around 3.5%. Now it's even lower than that, right? So we're seeing some shifts in the market that like 25 basis points over the last 2 weeks in the market's expectation for where rates are going to be in 2 years. So SOFR futures are a big one. Obviously, Fed funds futures as well. But Fed funds futures, most of the volume is really in the first 6 months of those contracts. So you looking at longer term and what the market's thinking for policy rates, SOFR is the much better product for that.
By the way, Paul, you have made a killing on your 2 years.
Sure.
As the rate obviously comes down, the price goes up. You don't need to worry about reinvestment risk. You can sell those things at a profit.
Exactly right. I mean, just today, we had 5.04. Now we're 4.85%. So just a big move in the short term.
Yeah, these big moves keep happening. Is there any problem with this much volatility in the Treasury market, Ira? I'm looking at 20 basis point drops on 3s, 5s, and 7s, and almost that much, 18 and change on 2s and 10s. Is that a problem?
I don't think it's a problem. I think it's a sign of the new environment that we're in with the amount of bonds that are outstanding versus the capacity of dealers and other intermediaries to actually see all the flow and take on risk to redistribute that risk at some point is much lower today. And part of this is electronification of the markets and the like. So you're likely to continue to see these. So actually, we were just looking this morning at comparing where the types of moves we're seeing now versus, say, 1997, when you had interest rates that were a little bit higher than they are now, but 6-7% on the 10-year instead of 4.5-5. But you actually had regularly 15-20 basis point moves. So given the level of rates, this is not that unusual. I think the thing is we were used to the last decade when interest rates were near 0, and when you had 10-year yields at 2%, a 5 basis point move seemed really big. Now that you're at 5%, then maybe a 10 basis point move or a 15 basis point move is kind of on the larger size, but also not particularly unusual. So I think you'll see more of these, partially due to rate, partially due to shifts in the market structure that are just going to provide for more jumps in the market when people are one way and want to get out of risk or into risk because of data or because of some news out of the Fed, for example.
So Ira, when I first got the Salomon Brothers, Solomon had like an army of government bond traders. No kidding. I mean, just dozens of them. And they were all trading for their book, trading for clients. And they made a lot of money. I'm guessing they also lost money from time to time. Does that even exist on Wall Street anymore? Do government trading desks exist, and are they profit centers anymore?
So there are government, there are clearly government bond traders. I think that what you've seen, and this started, in the last 20 odd years, and progressed while I was on the street myself, is that you went from having, 5-6 people trading treasuries and just treasuries to having somewhat less than that, because you have more automated pricing. So you get auto pricers and electronic trading platforms that basically look at supply and demand and price smaller trades just electronically without necessarily the dealer having to take much risk. But for those bigger trades and for trades that of decent size, you still have a person who has to accept that trade because whether or not it fits their risk limits of their trading book. And banks make money on this. You talk to Allison Williams, who covers a lot of the dealers here at Bloomberg Intelligence, and you look, and sometimes fixed income trading is a big profit center, and then other times, obviously 2022, for example, was not a particularly good year for trading, primarily because you get stuck with risk, and because you get stuck with that risk, you wind up losing money when bond prices go down and yields go up. So I think that the market's changed. And certainly the size of the market and the size of the dealer community has shrunk a little bit, right, in terms of personnel.
And the liquidity?
And also risk-taking. Yeah, liquidity is definitely lower. So you look at the Bloomberg Liquidity Index, which basically shows you how much off-the-run bonds, so these aren't like the current 10-year, but the 10-year issued, say, 6 months ago. Liquidity in those securities in particular has gone way down. And that's really where I think you see some of the pain points, and one reason why dealers aren't willing to take as much risk in some of those off-the-run securities. So getting out of risk sometimes is going to be much more difficult today than it had been in past years.
Yeah, I don't know. I'm sticking with my thought that we had way more fun on Wall Street than kids do today.
I'm sure you did.
Sticking with that point.
Well, it depends which kids, right?
Yeah, I'm just, I walk on a desk today, I'm like, there's nobody there. I mean, there's a relatively, I don't know. But anyway, they're making tons of money over there, so good for them. Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence, checking in from BI headquarters down in Princeton, New Jersey. Markets holding on to the gains of the day. S&P 500 up 1.8%, the NASDAQ up 2.1%. And let's call out the Russell. The Russell 2000 up 3.8%. So it's nice to see the small cap stocks participating. That's kind of a broadening out of the market performance that a lot of strategists will tell you they need to see to confirm kind of the strength in this market. So good to see the Russell performing well. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Good morning, Paul. The home improvement spending boom seems to be slowing after Home Depot narrowed its guidance for a decline in this year's profit and revenue. But shares, they're higher this morning. Bloomberg's Abigail Doolittle explains why.
Home Depot heading toward its best day since November of last year. Now, a piece of it could be the fact that Home Depot on the year down 8%. So with this macro story developing around the idea that maybe inflation has been beaten and that yields are going to come in, the beaten down catch-up stocks are perhaps catching up. As for the quarter that was, they actually beat ever so slightly, but it's the guide. It's the same store sales down. They're looking for 3 to 4% down versus what had been 2 to 3% down.
Right now, shares up about 5.5%. Uber is expanding its services, looking to challenge companies like TaskRabbit and Angie. Bloomberg's Gina Cervetti has that story.
Need some furniture assembled or the leaves raked up? Uber is launching a mini pilot program for a service that will let its app users hire people to complete various household chores. The feature, dubbed Uber Tasks, will launch in the coming weeks in Fort Myers, Florida, and in Edmonton, Alberta. During the initial test, drivers and delivery couriers on Uber's app can opt in to help customers with small home projects.
Uber up almost 2%. And move over Coca-Cola, PepsiCo is on track to take over as the biggest U.S. beverage company by market value. But drinks have less to do with it than snacks. PepsiCo owns the Frito-Lay and Quaker brands and businesses that Jefferies analyst says will likely continue to outperform. PepsiCo right now up just a fraction, Coca-Cola up about 0.5%. Those are the company stories we're following this hour. We'll have more Bloomberg Markets in just a bit. I'm Lisa Mateo. This is Bloomberg.
Coming up to 10:22 on Wall Street, I'm Nathan Hager. We check the markets for you all day long on Bloomberg. We continue to watch a surge in stocks and bonds after a softer than expected consumer price index for the month of October. Raised bets that the Federal Reserve could be done raising interest rates. We did just hear from the Fed Richmond president, Thomas Barkin. He says he's not convinced inflation is on a clear path toward the Fed's 2% target. But right now, markets are convinced that it's headed the right way. Right now, the S&P 500 is up 1.8%, up 79 points. The Dow is up 1.4%, or 491 points. And the NASDAQ is up 2.1%, a gain of 288 points. 10-year Treasury is up 1 and 14/32. The yield is down 18 basis points to 4.45%. The 2-year, 4.86%. NYMEX crude is surging as well, up 1.5% to $79.44 per barrel. COMEX gold is up 1% to $1969.60 per ounce. The euro 1.0828 against the dollar. British pound 1.2457. The yen is at 150.79. That's a Bloomberg Business Flash. Bloomberg Markets continues with Paul Sweeney and Matt Miller.
All right, Nathan Hager, thank you so much. We appreciate that. Matt Miller, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio, streaming live as well on YouTube. We've got a big take story. Matt and I love the big take stories. These are, every day, Bloomberg News comes up with these really deeply reported stories that go really deep into a big topic, and we've got another great one today. And joining us are Scott Carpenter and Paige Smith. They cover all the consumer finance stuff and corporates and all that kind of good stuff, corporate finance for Bloomberg News. And both of them join us live here in our Bloomberg Interactive Broker Studio. How Wall Street makes millions. Being a Wall Street guy, I like where this thing's going so far, but selling car loans customers can't repay, not so good. Guys, thanks for joining us here in our Bloomberg Interactive Broker Studio. Paige, let's just start with you. Talk to us about kind of what this story is about.
Sure, thanks for having us. So the story starts out with kind of walking through the story of James Seiler and his wife Janice Seiler, who are, a couple. They've been married for 48 years, live in South Georgia, and like many U.S. consumers, their car broke down, and they needed a new car, and they walked onto a used car lot and drove away that day with a $30,000 car loan. And very quickly after, Santander, which is the financing entity that essentially gave them that car loan, went ahead and packaged that loan up with more than 75,000 actually, other loans into this giant sort of pool of debt. And they gave it a cool kind of name called Drive 2019-3 and sold it off to a bunch of investors.
Is that a CDO?
No, that's an asset-backed bond. But
and that's where you come in, Scott, right? Because you cover all that structured credit stuff. So what kind of security did they take the car loan from our friends in South Georgia? What did they put it into?
It just sounds like the mortgages that were all packaged up together and sold off in the Great Financial Crisis.
Yeah, it's exactly the same thing when you look at it. They're taking loans, and Santander wants to be able to get cash for those loans, and it's combining them together and it's selling them to investors. Exactly the same concept in 2008. There's a lot that's changed. There's a lot that's different. One thing that's different is that these bonds are they're built to withstand enormous levels of defaults. Even if about 60% of all of the money that people owed, all of the 75,000 loans, if you add up everything that those people owed, and they defaulted on 60% of it, then all of the investors would be fine. They would get their money back. It's fine. That's obviously a very draconian scenario. You're not expecting 60% of people to default on the money that they owe. But if that happened, the investors would be fine. That's one reason why they buy these things, because they know that if the worst happens, they're still going to be okay.
Well, I imagine they're engineered that way because they expect people to lie about how much money they make, about what kind of payments they can withstand, about, employment status, right? Because in this case, the one that you picked out of the 75,000, they said that Mr. Seiler's wife, and they used her credit, made $70,000 a year, which they say they've never made that much.
And we do know that there's a lot of fraud in the industry. We are not going to necessarily go down that path with this story per se, but it is quite rampant in the industry. And yes, the Silers say that they never made that much. And the sole income put down on the sole income considered by Santander, the lender, when Janice Seiler was being considered for this loan was $5,860 a month. And
wow.
That, according to the Silers.
So what was the interest rate that the Silers thought they were signing up for versus what they really were signing up for?
So the Silers were, they at the end of the day, they did put their name, they signed their name at the bottom of that loan document. Okay. But after the fact, Mr. Seiler essentially said, hey, if I had really read this more closely and looked at the interest rate, which was 22.05% for a 6-year car loan worth $30,000, if I had looked at that a little bit more closely, I would have tried to have negotiated it down.
Did he not see the double digits? I mean, 22% is pretty much the only detail you need to pull out of that contract.
Well,
right?
actually, a lot of consumers just focus on the monthly payment.
Yep.
And if, again, a $750 a month
and they're already making another payment for $400 and some on a separate card. He's the custodian at a church. She's the cook at a school cafeteria. I mean, those are hefty payments for what I would guess they're pulling in. Plus, they have, I imagine, less than 700 in terms of their FICO score.
Yes.
So if I were a bank, I would need to have a very high interest rate and be able to withstand a lot of defaults before I'm lending to that kind of client.
And I think that the situation that the Silers were in is very similar to a lot of U.S. consumers today, where you know you need a car to get to work, you need a car to bring your kids to school, but you don't really have a choice of, you can't maybe put down a heck of a down payment or pay for a car outright in cash. So you have to go to a used car dealership and you have to go and get financing where you do have this expensive interest rate and you have these really expensive monthly
Right, but his
payments.
last car was $500 and this one's $30,000. So his new car cost 60 times what his last car. He might have thought, maybe if I'm paying 60 times what I did the last time, it's going to be difficult to keep up. He's already filed for bankruptcy once, right?
Yes, and we sort of posed that question to Santander, and Santander again essentially responded to us and said that people need cars to get to work, they need cars to bring their kids to school, and they are doing sort of a service to people by extending this really expensive credit.
Scott, give us a sense of this structured auto loan market. What do we know about it? Who are how big is it, and are there a lot of these types of deals out there?
Sure. So I think you have to go back to about 2008. Everybody back then became very wary of lending credit to low-income, low FICO score borrowers. But over time, there have been more companies that are doing that. Santander has been one of the largest in this space. There's more non-bank finance companies especially coming into this space, and they've been funding themselves by issuing these bonds. It's a critical part of their business model. So over time, we've seen banks gradually pulling back from lending to low FICO borrowers.
That's what I've heard.
Yeah, and in their place, we're seeing more finance companies that are stepping in their place, and what they do is they predominantly securitize their loans. In some cases, they securitize nearly 100% of their loans.
And I imagine in a lot of cases, this is a product that's desperately needed by someone and could be, a savior, a second chance, as the guy from Bowers Automotive Group says, right? Because if you had filed for bankruptcy, you've got a low credit score, you're not making very much money at your job, but you still need a car. Maybe you're praying for someone to give you a 22% loan on a $2,000 car.
I think this
But
is
maybe
really...
if you give them the wrong information and they give you that loan on a $30,000 car, you bear some responsibility as well for getting yourself into that kind of mess.
Yeah, I think this is really key. There is a debate at the bottom of this these companies, when they say, hey, we're giving people a car, nobody else will give them a car, this is America, you need a car, they have a point, right? There's poor public transportation if you don't live in New York City, you need a car. The question is, when you look at how badly so many of those loans end up, and we know either the default rate on average, as far as we can tell, for subprime loans is about 30%. Now there's it might be higher, it might be a little bit lower, not really sure, but as best we can tell, it's about 30%. That strikes the average person, I think, as a pretty high number.
Yep.
It only got as high as 35%, by the way, in the subprime mortgage crisis. Loans originated in the year 2006 on mortgages, ended up defaulting at 35%. We're rough, as far as we can tell, it's chronically about that high with subprime auto loans. And so,
somebody's got to do that business, presumably. Yeah. All right. Guys, great reporting, great story. You can find it that's a Big Take story, Bloomberg.com/Big Take.
It's in Bloomberg Markets Magazine.
Yes, indeed.
I love the
Bloomberg
layout.
Markets Magazine. Yeah, so you can find that. Go check it out. It's a great reporting. Paige Smith, consumer finance reporter. Scott Carpenter, structured credit reporter. Those two folks coming together, putting together a great piece coming out of Bloomberg News. Right now, let's head down to Washington, D.C. Amy Morris has got world and national news.
All right, thank you, Paul. This news update is brought to you by the Jewish Communal Fund. JCF helps you respond to crisis swiftly. Open your JCF donor-advised fund now to secure your tax deduction. Visit jcfny.org or call 212-752-8277. Washington, D.C. is bracing for the March for Israel rally this afternoon. Bloomberg's Nancy Lyons reports.
Organizers say the event is a way to show solidarity for the people of Israel as anti-Semitism grows, following Israeli attacks in Gaza that have claimed civilian lives. Among the speakers will be actress Deborah Messing and civil rights advocate Van Jones. D.C. Mayor Muriel Bowser says they are beefing up security in the city to maintain a peaceful demonstration.
MPD has asked for mutual assistance and support from the National Guard. The National Guard will be supporting some traffic safety points.
In Washington, Nancy Lyons, Bloomberg Radio.
Now, Homeland Security has designated the march and rally a Level 1 security event, the highest rating of risk assessment. The FBI says there is no specific threat. Tens of thousands of people are expected to attend and are already gathering. Israel and Hamas continue to trade accusations over Gaza hospitals, and President Biden is also calling on Israel to take less intrusive action. It's the latest sign the U.S. wants fewer civilian casualties. More on that now with Bloomberg's Oliver Crook.
The ground offensive is still just raging on in the northern part of Gaza, really cementing their positions around Gaza City and entering Gaza City, as we've seen. We've also heard that a great number of people have fled over the last 10 days. The UN says that more than 200,000 people have moved south. That brings the total of almost 2/3 of Gazans, a population of 2.3 million people that have fled their homes.
Bloomberg's Oliver Crook. Global news 24 hours a day and whenever you want it with Bloomberg News Now. This is Bloomberg.
It is 10:40 on Wall Street. I'm Nathan Hager. The rally is on across assets. The dollar is weakening after the softer than expected October consumer price index. We checked the markets all day long on Bloomberg. Right now, the S&P 500 is up 2%, up 88 points. The Dow is up 1.5% or 525 points now. The NASDAQ is up 2 1/3%, up 321 points. The Russell 2000 is up 4.4%. The 10-year Treasury is up 1 15/30 seconds, yield 4.45%. NYMEX crude is up 1.8%, $79.71 per barrel. COMEX gold is up 1% at 1970.60 per ounce. The euro is at 1.0835 against the dollar. The yen is 150.78. Big earnings story of the morning. Home Depot, the home improvement giant, narrowed its guidance for profit declines this year with demand for home improvement waning. Bank of America securities analyst Liz Suzuki says home retailers are still adjusting to the post-pandemic recovery.
We're coming down off of these very, very high levels of spend during the pandemic. Homeowners had, easy rates to be able to borrow against. They also had, stimulus money to spend. They were moving at much higher frequency. A lot of people moved out to the suburbs during the pandemic. I mean, we've seen a slowdown in that. And what's been surprising this year to the downside and just where we've seen that pressure on the top line is really mostly from housing turnover, basically coming to a standstill.
And you can hear more from Liz Suzuki of B of A on the Bloomberg Surveillance podcast. Right now, Home Depot is part of the overall rally, up 6.6%. That's a Bloomberg Business Flash. Bloomberg Markets continues now with Paul Sweeney and Matt Miller.
All right, Nathan Hager, thank you so much. We appreciate that. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Tamer than expected inflation print. That is the story of the day, sending stocks higher, bond yields lower. So let's break it all down. Jennifer Lee joins us, senior economist and managing director at BMO Capital Markets, joining us via Zoom. Jennifer, thanks so much for taking the time to join us. The markets seem to really like what they see here. How do you think the Federal Reserve is interpreting today's inflation print?
Good morning, and thanks for having me on. Well, I don't think the Fed's instant reaction is going to be like what my instant reaction was, which was a woohoo. I think, you know what? I think they are going to breathe a little bit easier, but at the same time, it's that key word that they used last week from the Fed chair, which is head fakes. They do not want to be, lulled into that. What's that saying? Lulled into a false sense of security. Right. We've had these before. It was back in, I think it was like the June figure where the CPI came in again below expected. The markets rallied, and of course we had a couple. And then it was like a couple of months of decent numbers, and then inflation reared its ugly head again. So it's got to take more than this, but certainly it's a good thing. If it was the other way, we would be having a completely different conversation right now. But the fact that it did cool and it did come in below expectations is definitely a good sign. But we need a lot more than just 1 month of good inflation data.
Well, what if we continue to get decent inflation data? Do you expect the Fed to cut the 4 times that the market is now pricing in 2024?
4 times, huh? So no, we actually have 2 times only. We have them cutting in the second half of 2024. I think overall it's going to take a little bit. It's again, I'm going to quote from the Fed chair. He said it was easy to get from 9.9% down to 3%. Getting it from 3 to 2 or 4 to 2 is going to be the hardest part. And I still think we're going to see some stickiness going on in the next few months at least. So we're probably going to see a little bit of bumping up and down along the bottom before we can start seeing or talking about more comfortably rate cuts.
Well, do you think these inflation expectations are now embedded? I mean, are we going to ever get to 2, or is 2 now the floor where it previously, before the crisis, the pandemic was the ceiling?
I think, frankly, come hell or high water, we're going to have to get down to 2% or close to it at least. So we have inflation coming down to that area around sometime in late next year. I think it's going to happen. I mean, 525 basis points of rate cuts is going to do it. And we're already seeing the economy slow, but it's just, again, that whole stickiness. And it's still that resilience that we continue to talk about in terms of the consumer, especially in terms of the labor market. And that's going to help, or at least, prevent a bigger decline in the overall inflation rate. It is not just headline inflation anymore, right? It's now core, it's goods and services, it's super core, it's all these different components that the Fed is keeping an eye on to make sure they're all heading in the right direction.
And Jennifer, you mentioned that the economy is slowing. Do you envision a soft landing for this economy, or is recession still on the table for you guys at BMO?
So we've been in the soft landing category for some time now. I don't think we were ever in the hard landing category. We actually took away our negative GDP growth outlook at a little while ago. So we still have, things slowing in the fourth quarter. Like we had that 4.9% jump in Q3, not sustainable. But so we do see things slowing in the fourth quarter, probably flattening out around Q1, and slowing, more progressively, I guess, next year. But we are not looking for that hard landing.
That's a pretty optimistic view.
Yeah.
That makes me feel a little bit better.
A little bit better. How about in Europe, Jennifer? Because I think we look at our friends over in Europe, and it's a different story there. How do you guys think about that?
Oh, Europe is a tough one for sure. They still have very high inflation. They still have very high inflation rates, and their central banks are still continuing to also be very hawkish, perhaps a bit more than the Federal Reserve. And there's still a lot of hawkish members on the ECB, for example. They also have other issues, especially the war, and that is still playing that's a big source of uncertainty that's hanging over Europe's head right now. And with energy prices, the winter coming up, or I guess we're in the winter now, and of course, depending on how energy prices play out, whether or not there's going to be more, issues with pipelines and supply of natural gas, that could actually play havoc right now on the European economy. Germany especially, by the way, has been so reliant on cheap Russian energy for so many years. Now they are trying to get themselves weaned off. Their auto sector, which is very uses so much energy, has also been losing out because of those higher energy prices in the past year. Also, they've been losing out to China's EV production as well. So Germany is having a tough time. So I think Europe is probably facing a lot more probability of recession than the U.S. is.
Are we getting back to a normal situation then economically where, the whole world doesn't go into a boom or bust together, where rates are not near zero or at zero or negative? I mean, it seems like normal for one region to have a recession and another not to.
Sort of. Who was it? I think it was the IMF that mentioned this, that used this phrase about how the global economy is limping along. They're not sprinting, but they're limping along. And that's sort of how we're seeing things going, again, until central banks completely feel comfortable enough to take their feet off the accelerator or the brake, whatever you want to call it, and stop raising rates. And then we're going to start seeing things normalize a little bit more. But right now, I still think we're in that period of uncertainty where anything could happen. We have central bankers, for example, who are not talking about just rate hikes, but some of them are talking about rate cuts. And some of them are saying, we're going to do nothing for a long, long time. So it's almost like every possibility is out there for discussion. And I don't think everyone is on the same page just yet.
How concerned are you about the consumer, Jennifer? We just had a story from Bloomberg News talking about some of these, low FICO score folks getting into some trouble with their car loans and so on. How concerned are you about the consumer and maybe the debt situation?
It is concerning for sure. It's going to also depend on which part of the consumer, in terms of the echelons, I guess, the income categories. But I'm going to lean on the view that as long as the labor market continues to add, as long as the U.S. continues to add jobs, even if it's 150,000, is still in any given year is still a pretty decent number for any month. As long as we continue to see still steady job growth, unemployment rates staying fairly low. I mean, obviously it's come off the bottom, but I think the labor market is the one point of uncertainty, I guess, that one point that continues to push the U.S. economy along. As long as people are working, they're making a decent wage. I think that is going to help support overall consumer spending. But for sure, different pockets of the consumer are, what they're going through in terms of higher rates is very concerning.
Jennifer Lee, thanks so much for joining us. As always, appreciate getting your thoughts and comments here. Jennifer Lee, Senior Economist, Managing Director at BMO Capital Markets. Markets, still right at the intraday high, man. We've got the S&P 500, 2%. Yeah. And I'm going to call out the Russell again. 4.6% gain today on the Russell 2000.
Green.
Yep, exactly.
But that just brings the Russell 2000 to basically unch year to date.
Yep, absolutely. And maybe in the context of rising rates, that's not so bad.
The S&P 500, on the other hand, it's up 17.2% year to date. The NASDAQ up 34.6%.
Let's get some company news right now with Lisa Mateo.
You got it. Apple shares, they're on the rise after its main supplier, Foxconn, topped profit expectations. But Bloomberg's Ed Ludlow says it's not all good news.
They had a sort of surprise net income figure of $1.3 billion US above estimates, but the outlook for the holiday quarter, the December quarter, was for sales to decline. That would represent the third straight quarter of sales decline. And given that this is the principal contract manufacturer or assembler of iPhones for Apple, the concern is that that is indicative of the downward momentum we've seen with iPhone 15 overall.
Apple up more than 1%. NVIDIA is looking to match its longest winning streak in nearly 7 years, going for a 10th day of gains after adding roughly $200 billion in market cap this month alone. Bloomberg's Simone Foxman explains why.
Part of this was because of the announcement of an H200 AI processor. This is an upgrade from that game-changing H100 processor and using high bandwidth memory called HBM3E that allows these chips to bombard software with big data sets much faster.
Shares right now, they're up nearly 2%. And Meta Platforms has more Wall Street fans than ever. The Facebook owner's shares have nearly quadrupled since a low in November last year. Analysts tracked by Bloomberg shows the highest number of buy ratings since its 2012 listing. Wall Street now anticipates the company will generate about $18 a share in earnings next year, up from expectations of about $10 a year ago. Meta right now up nearly 2%. Those are the company stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, Matt Miller and Paul Sweeney here in the Bloomberg Interactive Broker Studio. Stocks hanging on to their intraday highs. S&P 500 up 2%, the NASDAQ up 2.3%. And again, the Russell is the star of the day, up 4.6% on the back of that tamer than expected inflation. Yields coming down pretty strongly here. The 10 years off 18 basis points. We're now at 4.45% on your 10-year. The 2 years at 4.85%. Started the day at north of 5. So big moves down in the rates of 2 years. Energy up a little bit. WTI crude oil up 1.6% now at just under $80 per barrel. Right now, let's head down to Washington, D.C. Amy Morris has got World International News for us.
All right. Thank you, Paula. We're just getting word now about a nasty crash on a highway in Ohio. The highway patrol there says a commercial bus carrying several passengers and a semi-truck collided on that Ohio highway. Looks like it was I-70 West. A charter bus carrying students was rear-ended by a semi-tractor trailer on that highway. We're going to get more information for you as it comes in. House Speaker Mike Johnson counting on Democrats to overcome misgivings and approve his proposal to avert a U.S. government shutdown. The Republican leader plans to vote later this afternoon on his temporary funding proposal under a procedure that requires a 2/3 majority, a threshold he can only meet with support from a large number of Democratic lawmakers. Bloomberg's Jody Schneider reports he's starting to get the support that he's been looking for from Democrats.
It could happen, mostly because it doesn't require large spending cuts and doesn't have some of these poison pill issues that Democrats would not be able to vote for. It does not include money for Ukraine or Israel. So the Biden administration is kind of playing a wait and see, although yesterday there were signs that the Biden administration would not issue a veto threat. A veto threat would make it a lot harder for Democrats to vote for it.
Bloomberg's Jody Schneider in the nation's capital. Washington, D.C., by the way, preparing for that March for Israel rally and demonstration. Tens of thousands of people are arriving in the Capitol showing solidarity with Israel. The Department of Homeland Security designated the march a level 1 security event. That is the highest rating of risk assessment. The FBI says there's no specific threat, but there is fear of lone actors attacking pro-Israeli demonstrators who are coming to D.C. The event starts at 1 this afternoon. Sources tell Bloomberg Joe Biden and his Chinese counterpart Xi Jinping are set to announce an agreement that would see Beijing crack down on the manufacture and export of fentanyl. We get more on that with Bloomberg's Roz Matheson.
That's a really important development for U.S. President Joe Biden coming into the election cycle in the U.S. Of course, the fentanyl crisis is severe. For Joe Biden, it's quite a goodwill gesture, really, from Xi Jinping.
Bloomberg's Roz Matheson reporting there. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris. This is Bloomberg. Matt and Paul.
All right, Amy Morris, thank you so much. We appreciate it. All right, here's a story close to the heart here for me. Bonus season on Wall Street is looking grim for bankers in an industry hobbled by rising interest rates, bank failures, and a deal-making slump. Next year will probably be no better. Merger advisors, the big ticket folks, could see their payouts for 2023 slide by as much as 25%. That's according to a report Tuesday from compensation consultant Johnson Associates. At regional banks, year-end comp for professionals in retail and commercial banking could fall 10 to 20%, the company found. You know,
That's more of a problem.
Yeah.
At regional banks,
yep,
year-end compensation for professionals in retail and commercial businesses could fall 10 to 20%. That's going to hurt. Merger advisors, those guys are the masters of the universe.
They'll be okay. And and I'll tell you what's different. Back in my day, my bonus was about 90% of my total compensation. In some years, even more than that. That's changed. Now that percentage is much lower. They put more of the total comp in salary versus the variable incentive compensation for what, you know, that's coming out of the great financial crisis and some of the concerns about risk taking and compensation.
By the way, this story does say that some professionals, including those involved in equity underwriting and wealth management, could see a modest bump this year. Yeah. Bigger is also often better with retail and commercial bankers at major global banks seeing their pay flat to up 10% rather than down, like at the regionals.
It's the time of year these decisions get made. You find out about it in the new year, and then you get paid, usually March 31st, the last day of the quarter that they're allowed to do it. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour, we're going to check in with Alon Olsha, senior analyst. He covers the metals and mining from Bloomberg Intelligence. He's going to help us break down a deal in the coal business of all places. Glencore purchasing Teck Coal, and we get the sense of what it means for the industry. Mikey Shaw, pharma analyst of Bloomberg Intelligence. He's going to join us to discuss Matt's favorite, Novo Nordisk, Ozempa, and the weight loss drug push. It is a growing business for sure. Jake Saper, Emergence Capital. He's a founder and general partner there. He's going to give us his call on these markets. But let's kick this hour off with a quick Bloomberg News Flash. Nathan Hager's got it for us.
All right, Paul. Slowing inflation equals surging markets. That is what we are seeing as we get closer to the midday hour. We check the markets all day long on Bloomberg, and right now the S&P 500 is up 2%, up 87 points, 44.99. Getting close to 4,500 for that S&P level. The Dow Jones Industrial Average up 1.5% or 527 points, 34,864. The NASDAQ is up 2.2% or 306 points, trading at 14,074. The 10-year Treasury is up 1 and 14/32, yield 4.45%. And after that soft October Consumer Price Index, the market is now pricing in a 0.5 percentage point rate cut decrease from the Fed by July. But BMO senior economist Jennifer Lee still thinks the Federal Reserve wants to make sure this inflation print isn't a head fake. Jen joined us moments ago here on Bloomberg Markets.
We've had these before. It was back in, I think it was like the June figure where the CPI came in again below expected. The markets rallied. And of course, we had a couple, and then it was like a couple of months of decent numbers, and then inflation reared its ugly head again. So it's got to take more than this, but certainly it's a good thing. You know, if it was the other way, we would be having a completely different conversation right now.
In this month's easing inflation print has oil prices rising as well. NYMEX crude is up 1.4%, trading at $79.36 per barrel. COMEX gold is up 0.9% at $19.6810 per ounce. The euro, 1.0840 against the dollar. British pound, 1.2459. The yen, 150.79. That's a Bloomberg Business Flash. Bloomberg Markets continues with Paul Sweeney and Matt Miller.
All right, Nathan Hager, thank you so much. We appreciate that. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Broker studio. And we're also streaming live on YouTube. And we're also doing that CarPlay thing, which, Tom is very fired up about, because Bloomberg is now available in your dashboard with Apple CarPlay and Android Auto. It gives you access to every Bloomberg podcast, live audio feeds from Bloomberg Radio, print stories from Bloomberg News in audio form, and the latest headlines at the click of a button with Bloomberg News Now. How do you get it? Well, the good news is it's free with the latest version of the Bloomberg Business app. That's the Bloomberg Business app. Get it on your phone in the Apple App Store or on Google Play. Just download the app, connect to your phone in your car, and get started. And it's all presented by our sponsor, Interactive Brokers. How about that? All right, we had a nice M&A trade in, I'm going to say, the coal business, probably the last place you'd expect to see somebody make a big acquisition here. But let's check in with somebody who knows this stuff. That's his job. Alon Olsha, senior analyst. He covers the metals and minings for Bloomberg Intelligence. He's based in London. Alon, thanks so much for joining us here. What's Glencore doing here?
The motivation to buy these coal mines for Teck, and it's a transaction at just under $7 billion. The motivation really is to grow bigger in coal, to ultimately get out of coal. That's a bit of a head scratcher. And I think you need to kind of step back and understand where Glencore is coming from. So Glencore currently has a massive thermal coal business, which is highly cash generative. But thermal coal is used in power generation and it's highly pollutive. So it doesn't have the brightest future in a net zero world. And a lot of ESG-minded investors are really allergic to Glencore because of that. And really because of waning demand over time, the valuation of thermal coal mining companies is usually quite depressed. So there's a value trap here which Glencore is trying to escape. The idea is that if you combine tech resources, metallurgical coal business, and this is coal used in steel making, which is more valuable, with Glencore's thermal coal business, you could potentially have a business which re-rates, and all Glencore's remaining assets, which are all geared towards the energy transition, things like mines in copper, cobalt, nickel. What happens to those assets is that the ESG yoke is effectively cast off, and all the assets re-rate, so you unlock value. That is the thinking behind the transaction.
I'm surprised to hear, although because you have a British accent, less so.
No, I think it's South Africa.
That people care about. Well, outside of America, I guess ESG-minded investors are a thing, but here I'm not sure how much of a role that plays. How big is it?
Yeah, I mean, and that's actually a great point, because Glencore specifically have said that when they spin off this combined coal business, it's going to be in the U.S. With secondary listings in Toronto and Johannesburg. And that's because, to your point, you just don't have that same kind of consideration that you do in Europe. So they believe that's how they're going to maximize value, is listing it in the States.
Nice, smart thinking there. All right, Glencore, the stock is up 5.6% today, so the market likes what Glencore is doing here. So if I have a steel factory, in reality, how much of my steel factory is being run by coal? I mean, versus some green source of energy. Where is the industry today?
So the industry globally is still overwhelmingly producing steel through what's known as the blast furnace, basic oxygen furnace route. And that uses metallurgical coal as its main source of energy. About 70% of steel is still produced in that way. In the U.S., actually, it's the inverse of that. In the U.S., most of the steel is produced through electric arc furnaces, which actually just all the energy comes from electricity, and the feedstock is either scrap steel or a high grade form of iron ore. Metallurgical coal still has a really important role to play globally in steel making, particularly in Asia. While the West, the US, Europe increasingly are moving towards making steel through the electric arc furnace because it's greener, particularly if you have renewable energy powering the grid. In Asia, most of the capacity is still blast furnace orientated, and so met coal is still going to play a pretty big role there.
Well, I know, like here in the States, there's bad coal, as in dirty coal, and less dirty coal. So the stuff you get out from like West Virginia, dirty coal. The stuff you get from Wyoming, the Powder River Basin, less dirty. How's Tech coal? Where's their coal rank?
So Tech coal, it's different from thermal coal. It has different properties, but it's still incredibly pollutive. But even in a steel mill, there are ways to reduce that pollution, particularly if you're using a blast furnace. There are technologies you could use, things like carbon capture and storage, for example, or ultimately converting some of the iron ore production to a different form using what's called direct reduction iron, DRI, and actually powering that with gas.
All right, good stuff. I like a nice M&A trade in the steel business. Who doesn't like that? Citi it was advising.
It's also a fascinating segment, right? I mean, the split of coal for metal production, for steel production, and then thermal coal, I think is interesting. The two different ways of making steel, right? Electric arc and blast furnace. Like, it's so cool.
Yep, good stuff. All right, Alan, thanks so much for joining us. Alan Olsha, senior analyst covering metals and mining for Bloomberg Intelligence, working out of our London office. Let's switch, Matt, to one of your favorite topics of the day.
Love it.
Ozempic.
Yeah.
See, I think this is a whole scam, but Matt's all on board. He thinks he's going to get this stuff. Mikey Shaw, he is one of our senior analysts over in London, covering the pharma space. He's been doing it a long time, along with that guy, Sam Fazeli. Mikey's got much better hair than Sam Fazeli. We'll go there right away.
I'm jealous.
Exactly.
It's overflowing.
So, Mike, you guys have done a ton of work on these GLP-1 drugs. Can you frame out, we've had a little bit of time now to kind of think about this and look at the different products out there, but where are we in terms of developing that market, that part of the market?
I mean, in terms of penetration rates of GLP-1 drugs for obesity, I think we're still in the very early stages. Excitement around the class is constantly growing. Even more so after this weekend, where we saw the detailed cardiovascular outcomes data in obese patients for Wegovy. I think that was met very positively by the prescriber community in general. We saw kind of early benefits as early as day one in terms of, these drugs can reduce major adverse cardiovascular events in these heavy obese patients. But there's also still a lot to be kind of learnt in terms of, the mechanism itself. When we look at the two curves of interest are the cardiovascular outcomes curve and then the body weight curve. So we saw
and diabetes, right? Because if you're pre-diabetic and you can't stop eating Haagen-Dazs, this thing could be a lifesaver.
Yeah. So I mean, when we look at obesity, it's a risk factor for diabetes, and in that data set, it showed that it definitely cut the move of pre-diabetics to developing diabetes. And I mean, the key question though with the data is, yes, body weight is a contributing factor. But given the disparities we saw in terms of maximum weight loss being achieved, and that early separation of the cardiovascular outcomes curve, it's not the sole driver. So that
there's a secret ingredient. What's doing it?
Yeah, I mean that's what Novo said. It's got an X factor, which we need to find out more about.
Well, that's what you did. Like this weekend, you were at a conference, right?
Yeah,
up in Boston. Where was it?
It was in Philadelphia.
Philadelphia. Okay.
Oh, so you saw the apparently multiple rounds of applause when the data were released.
Yeah. So the room was full. It was like almost a standing ovation.
Okay. No, okay. When I go to a conference, this is my schedule. I get up, have a little business breakfast, maybe a little business lunch, maybe a meeting in the afternoon, and then boom, dinner. Then we go to the craps table in Vegas. That's how you do an investor conference. These guys, healthcare, they go on the weekend. And they go into these conference rooms for like 10 hours and have to deal with all this medical scientific data. And you guys actually have to write research notes based upon this stuff on a weekend, by the way. That's what you guys do, right?
Yeah, that's about right.
See, that's just no way to do
it. Yeah, but your badge is worth 2 drinks at the meet and greet after.
Yes, exactly. All right, so, but in reality, how have you guys sized out this market? Because I've seen
listen, I have some important questions.
Okay,
because I want to get this. I've got a doctor's appointment on December 7th, and hopefully he's going to hook me up. I need to lose 20 pounds. I want to avoid getting diabetes, and I don't want to die of a heart attack.
Well, then you should do better.
And I have I have no willpower, right? So I'm hoping that this drug can do this for me, and maybe do my taxes as well. I don't want to lose muscle. I only want to lose fat. Is there a competitor to Ozempic / Wegovy that is going to help me with that?
I mean, in terms of the data with regards to kind of the loss of lean muscle, it's limited at the moment. But Lilly has done a deal for a drug, which potentially, when used in combination with their drug, which is just got approved as Zepbound, that could potentially address that issue.
Okay, so that's one question I have. The other one is, do I go Ozempic because I really want to avoid diabetes and a heart attack? I mean, I need to lose 20 pounds. I don't have to, right? I'm not morbidly obese. Or do I go Wegovy because it's a stronger dose and actually has better results for heart issues?
I mean, in order to get Wegovy, because of the supply issues, it needs to be on label, right? So you need to be either overweight with a weight-related comorbidity, so that might be diabetes, or you need to be, clinically obese, so BMI of 30 or above.
Okay, I don't check that box, but yeah. I feel like I know people. I can go to Canada. I can get the drug elsewhere. But so you're saying, like, is Wegovy the right choice, but it's going to be hard to get, or should I just settle for Ozempic?
I mean, at the moment, there's a lot of off-label use of Ozempic simply because of the supply situation with Wegovy. In essence, you know, the active ingredient of these drugs are both semaglutide, and in both cases, you would start off at a lower dose and then start titrating up. So the maximum dose for Ozempic is 2 milligrams.
All
The
right.
maximum dose for Wegovy is 2.4.
All right, Amy from South Carolina writes in, how long does someone have to stay on the weight loss drugs? Forever? A few weeks? And when you stop taking it, does the weight come back on? What's the data show there?
Yeah, so there's clinical data from both Lilly and Novo showing that, you know, as soon as you stop these drugs, you eventually, you know, put the weight back on. Prescribers we've spoken to as well, they're all kind of saying, you know, chronic dosing of these drugs are needed. But I mean, there are various kind of things that you could, you know, potentially do. You could potentially, you know, reach your targeted weight loss, and then perhaps you lower the dose of the drug.
Who pays for this stuff?
So that's one of the main questions
See,
at the moment.
That's you got to go to the money.
Mikey, we have the same insurance provider. And if I go in there and I test like positive for pre-diabetes, or if I have a BMI of like 27, 28, is my insurance gonna pay for this?
I think as we get more and more data, we're going to see kind of access and reimbursement for these drugs improve. I think the outcomes data for Wegovy, you know, is a big step in the right direction there. What insurers need to do is, you know, balance that the short-term costs, which are going to be high, of, you know, GLP-1 therapy versus the long-term benefits in terms of, you know, saving. Cost savings through reducing kind of hospitalizations and
Dude, I'm sure
cardiovascular deaths.
there's an actuary at Novo Nordisk, and the boss comes into his office and says, how much does heart disease and diabetes and obesity cost the world? And he says,
trillions.
Yeah, and then he says, okay, let's price our drug for that price, right? That's exactly what they want to do. They want to get it so some studies say it saves, some studies say it doesn't, but it's basically at the same level.
Yeah, I mean, like if you look at the direct and indirect costs of obesity and diabetes, it runs into the trillions, right? And you know, all the prescribers we spoke to at the conference, you know, they believe in these drugs. They believe that eventually they'll be cost effective in terms of as we get more competition coming into the market. That price point will come down as we see orals, which are cheaper to produce, also get approved. That price point is going to come down too.
That's what we need. All right, Mikey Shaw joins us. He's the senior industry analyst at Bloomberg Intelligence. Dude, you got to come here to New York more often. I mean, we see Sam a lot. Who cares? We'd rather talk to the smart money behind the healthcare research at Bloomberg Intelligence. Mikey Shaw joining us here in our Bloomberg Interactive Brokers studio. We'll have more coming up. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
You got it, Paul. You'll soon be able to shop on Amazon while you're scrolling your Snapchat feed, if that's your thing. The information is reporting Snap has reportedly reached a deal with Amazon to allow its users to shop for products directly from ads on the app. We have more from Bloomberg's Katie Greifeld.
U.S. customers would be able to check out with Amazon without leaving the Snap ad and also see the Amazon items' estimated delivery times, the real-time pricing, Prime eligibility, etc. Now, this is similar to a deal announced last week between Amazon and Meta for shopping in Facebook and Instagram, some of their app portfolio. And the thinking is that this could make these social media platforms more attractive to advertisers.
Snap right now up about 8%. Amazon right now up about more than 2.5%. And the news of the deal comes after Amazon announced some layoffs. Bloomberg's Gina Cervetti has that story.
Amazon has struggled for years to develop its own games. Now it's cutting 180 jobs in the gaming division and shutting down 2 of its business units, including a channel on its live streaming site, Twitch. The Crown Channel is where gaming celebrities provided variety show entertainment.
And a warning to Amazon Prime customers. The company says scammers are pretending to provide technical support for Amazon Prime Video. So here's what's happening. Customers are sent to a website that presents an error message and tells them to call a phone number to fix a phony issue. When they call, they're asked to purchase hundreds of dollars of fake support services. Now, Amazon has filed trademark infringement claims in 2 federal courts against those scammers. Those are the company stories we're following this hour. We'll have more Bloomberg Markets coming up in just a bit. I'm Lisa Mateo, and this is Bloomberg.
Coming up to 11:22 on Wall Street, I'm Nathan Hager. We check the markets all day long here on Bloomberg, and we are watching risk assets surge across the board. The Bloomberg Dollar Spot Index sparked a red headline on the Bloomberg terminal when it dropped 1%, its biggest decline since January 6th, all after an October consumer price index that came in softer than expected and raised bets in this market that the Fed could be done raising interest rates. Right now, the S&P 500 is up 2% or 89 points. The Dow is up 1.6%, a 551-point gain. The NASDAQ is up 2.3%, up 312 points. Russell 2000, the big star on this session, up 4.9%. 10-year Treasuries up 1 and 16/32, yield 4.45%. Yield on the 2-year, 4.84%. NYMEX crude's higher by 1.3%, trading at $79.26 per barrel. COMEX gold is up 0.9% at $1968.40 per ounce. The euro, 1.0853 against the dollar. The yen, 150.80. That's a Bloomberg Business Flash. Bloomberg Markets continues with Paul Sweeney and Matt Miller.
All right, Nathan Hager, thank you so much. We appreciate that. Matt Miller, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio. We're doing the YouTube thing. I think that's the internet, Matt. So for the kids, youtube.com, go over there and search Bloomberg Radio. Bloomberg
Paul's
Markets.
85. So
yes, exactly. The Bloomberg Markets is brought to you today by Commonwealth, supporting more than 2,000 independent financial advisors with the solutions they need to grow a thriving business. Commonwealth, go where you grow. Visit commonwealth.com to learn more. All right, AI, artificial intelligence. That's how I knew it. I just think it's tech. I just think it's incremental tech. But no, people tell me it is new. It is, just going to revolutionary, I should say.
Like the internet.
Like the intraweb.
Like YouTube.
Exactly. Jake Saper knows. Did I pronounce it right?
You did.
Jake Saper, founder, general partner of Emergence Capital. He's out there in Silicon Valley. He does all that stuff. So when we talk about AI, Jake, I like to ask people, just say, from your perspective, what is AI?
It's machines helping humans do their jobs.
Machines helping humans do their jobs. All right, I'm down with that. So how do you guys view that space, and maybe how you view investment opportunities for your venture capital
Yeah,
fund?
totally. Well, I'll start with just some context on where we think this fits in enterprise software more broadly. We're focused just on enterprise software, B2B software, something that probably near and dear to the hearts of Bloomberg folks, presumably.
Absolutely.
Our firm started 20 years ago with the thesis that software would move from on-premise to the cloud. Okay. That thesis largely worked, right? So the very first investment for us in 2004 was in Salesforce. We've been investing in all sorts of enterprise software companies like Zoom ever since. And we think that this AI wave is very similar to the wave of on-prem to the cloud.
Okay.
So just like that was transformational for tech, we think this will be transformational. We're very bullish, and we're very focused on how we can help B2B software companies make that transition.
But should we have a fast food company talking about AI on an quarterly earnings conference call?
I think it's real, right? There's so much hysteria, and so you have to cut through all the crap to figure out what's real. But in the case of fast food, the idea of using this to help augment the people doing the drive-thrus and make drive-thrus more efficient, that's very real. Voice recognition technology is real. So I think what may be in danger is a lot of tech companies, public companies over the past 6 months have gotten so excited they may have overcommitted, overpromised on what they can do with AI in the near term. So we may be, near-term negative, but I think over the long run, this thing's going to work.
Dude, think about, you don't want a high school, a stoner that you hired for your drive-thru to be like, do you want fries with that? He's not going to be enthusiastic about it. He's not going to remember to ask every time. AI can be better at upselling in the drive-thru. I think
Stoners are pretty good at upselling, though. I feel like they're hungry.
That's true. Man, these fries are so good.
Exactly. All right, so what's the next? I want to say what's the next, because I don't even know where the starting point is. But
well, NVIDIA is the only one that we really know, right? Yeah. I mean, Microsoft, okay, with OpenAI, but where do you invest? I mean, you're not looking solely at public markets, so you have a much better view of what the roots are down underground. What are you looking at?
So the way I'd think about it is there's different layers to the AI stuff. There's NVIDIA, which is at the base layer, right? It's the actual chips that are helping power this. Then there's the foundational models. This is OpenAI, and Microsoft's developing their own in addition to OpenAI, and there's a bunch of others. And then there's the application layer. And that's the stuff we're most excited about, which is what do you do with this stuff once it's built, right? You don't just build it for the sake of building it, but how can you make the stoner dude more effective at taking your order? How can you help doctors treat patients more effectively? How can you help lawyers go through contracts more effectively? So we're investing in companies that do all that stuff, aided by AI.
So All right, now given it feels like we're in the top of the first inning for AI.
Yeah.
Where are you guys looking, and what types of deals are you guys looking at?
Yeah, for sure. So we're seeing a lot of activity in vertical-specific AI solutions. And this actually mirrors software. So in the first wave of cloud technology, horizontal SaaS was the thing, so Salesforce, Workday, et cetera. In the second wave, it was vertical SaaS, or what we at Emergence call industry cloud. These are companies like Veeva Systems, which is a $30 billion public company selling into the pharmaceutical industry. The same thing is starting to happen in AI, where you're taking this technology and instead of just trying to broadly apply it anywhere, you're actually choosing a specific job to be done, and you're having it solve that problem. So we have invested in companies, as I said, that use this technology to help lawyers draft contracts better. So the idea is you can, as you're writing a contract, say, hey, help me make this clause mutual, and it will use AI to help draft that. We've invested in companies that help doctors communicate with insurance companies and write the letters to get approvals for different treatments. A company called Doximity that does that. So that kind of concept we think is going to be really powerful. The question is, what are the jobs to be done for which this technology is most applicable in the near term?
And what are the data sets that they use to train on? Is that like a sticky issue? Because recently Elon Musk came out with his competitor to OpenAI, Grok. And apparently it's supposed to use real-time
Twitter data.
Twitter data. I didn't even know they could do that without breaking certain, privacy clauses. Maybe they don't mind. But, I think of Google, they have so much data, at their fingertips. Can they use all that?
So I think the larger companies are the ones that have to be the most conservative about this, which is kind of interesting, actually. Like in many ways, those are the folks that have the most to lose. And so startups, I think, can be more innovative on this front. They can, find different sets of data and actually kind of outmaneuver some of the incumbents. There's a real innovator's dilemma problem for the incumbents here. Right? If you're Google, if you're Salesforce, if you're one of these established public companies, you have a lot to lose in this, certainly from a legal perspective. You also, if you drastically try to change your UX, your user interface, let's say doing a chat-based interface is better than doing the traditional interface, you could piss off a lot of your existing users. So there's risk there. There's also risk on business models. I think a lot of these technologies are starting to think about, how do I charge not on a per-seat basis or usage basis, but actually on an outcomes basis? Because this technology actually can help you process contracts more quickly or cure patients more quickly or what have you. What if you could start actually charging on that basis, which would be disruptive to the incumbent? So as a startup investor perspective, which is what I'm focused on, I'm spending a lot of time thinking about what are the advantages a startup has over the incumbent in this new era.
How much incremental CapEx, if I just look at the macro tech CapEx numbers I get from IDC or whatever, and I see some of these big growth rates, how much of that do you think is incremental AI or maybe taking from some other bucket and putting it into AI? I don't know how much to think about as how much is incremental.
It's a really good question. I think some of it will actually come from labor. Right? So if you had hired a consulting firm before to help you implement some new technology, and you had a big budget for that consulting firm, it's very possible that you can use AI to help you implement this technology more effectively, and so you don't need to spend as much on consulting firms.
Interesting.
Which actually brings me to another point I've been reflecting on, which is we thought that it was like the stoner dude that was going to be most at risk in this age of AI, that it was a lot of the kind of more blue-collar workers, the janitors, the nannies, et cetera. What's happened with this past year of AI is it seems like white-collar workers are actually the ones that may have more infringement upon their daily work.
Yeah.
And as a result, they're the ones who have to probably get up to speed faster on how to make use of this technology to augment what they do. Otherwise, they may fall by the wayside.
I always think about this as well, the jobs at risk, but what will be created?
Yeah.
Because every time there's a technological wave or an industrial wave, it does knock out a whole group of jobs, but it also creates so many more.
Totally.
So what's going to be created here?
Yeah.
It's not just more coders, right? Please say it's not more coders.
No, in some ways we may have different types of coders in the sense that you may not need to know as much code because the AI can help you do it. So you'll have probably more of a democratization, so there'll be more people that code, but you may have less people that do it as their full-time job. I do think like in the near term, figuring out how to implement this technology in existing tech stacks is something that everyone's figuring out real time. Remember, like this ChatGPT thing, it's a year old. Like we've aged a ton in a year. So what's it going to look like in a year, 2 years from now? So I think the world will look different and jobs will look very different.
Hey, Jake, just on the VC business today, talk to us about what it's like out in Sand Hill Road out there, and if I have a cool technology, will you fund it?
Well, I'll start by saying Sand Hill Road isn't what it used to be.
Really?
Yeah. What I mean by that is like...
And where did Sand Hill Road come from?
Sand Hill Road went to San Francisco.
From
Sand Hill. So Sand Hill
from New Jersey, actually.
Oh, sure.
And
And
Menlo Park, California. Where'd that come from?
It was
Menlo
copied
Park,
from
New
Jersey. No, much love to the East Coast. Like, there's so much happening here.
Institute for Advanced Study, Albert Einstein.
Okay.
My backyard. Go ahead.
There's a lot of history that came from the East Coast that made the West Coast what it is, and actually the military is a lot of what made the West Coast and Silicon Valley what it is. Anyway, Silicon Valley and Sand Hill in particular have moved up to San Francisco largely. I think there's more action there. We're at Pier 5, actually right next to Bloomberg.
Right?
Yeah.
But you get that Humphrey Slocum action.
Yeah, like there's a lot of ways to. You were talking about Wegovy before, so if you want to, get on that train, that might be the right way to do it.
I need to get some secret breakfast first, and then I'll do the Wegovy.
Exactly. But to answer your question on like what's the state of VC, there's kind of a weird bipolar state of VC right now.
And we got about 20 seconds.
Cool. What I mean by that is like there's lots of hysteria and excitement around AI, some of which is justified, and there's also some real challenges that these companies who are dealing with high interest rates and having slower sales cycles are facing.
All right. We'll get you back next time you're in the big town here. Jake Saper, he is the general partner of Emergence Capital.
We can do it over Zoom too.
We can do it over Zoom. We love Zoom.
No, I don't. We go real time here, and that's how we do it. Jake, thanks so much for joining us here. Markets tearing it up here today on the back of some good inflation data. Right now, let's head down to Washington, D.C. Amy Mars has got world and national news for us.
All right, thank you. Paul, an update for you now on that crash in Ohio. A charter bus that was carrying some high school students was rear-ended by a semi-truck on I-70 West in Ohio. That happened this morning. 3 people were killed, 15 others were injured. The Ohio State Highway Patrol says the cause is not immediately known. Several National Guard units are assisting D.C. police with today's March for Israel rally on the National Mall. D.C. Mayor Muriel Bowser told reporters yesterday the National Guard is deployed at certain traffic safety points. They're redirecting vehicles and blocking off intersections, and the mayor made it clear that even though this event is being called a march, they're not marching. Those who are attending are not expected to move away from their position on the National Mall. Eric Fingerhut is with the Jewish Federation of North America and says this is a significant movement for Jewish Americans.
To be seen together, that we're not intimidated, we're not scared. We're going to come to the most visible place in the United States of America, the National Mall, between the Capitol and the White House, and we're going to stand together.
Now, more than 60,000 people are expected for today's rally, which is expected to begin at 1 o'clock this afternoon. Homeland Security has also designated the march and rally a level 1 security event, the highest rating of risk assessment. The FBI says there is no specific threat. Israel and Hamas, meanwhile, trading accusations over Gaza hospitals, and President Biden calling on Israel to take less intrusive action. More on this with Bloomberg's Oliver Crook.
The ground offensive is still just raging on in the northern part of Gaza, really cementing their positions around Gaza City and entering Gaza City, as we've seen. We've also heard that a great number of people have fled over the last 10 days. The UN says that more than 200,000 people have moved south. That brings the total of almost 2/3 of Gazans, a population of 2.3 million people that have fled their homes.
Bloomberg's Oliver Crook reporting, and nearly 160,000 members of SAG-AFTRA voting on the terms of that new contract. Global news 24 hours a day. This is Bloomberg.
It's 11:40 on Wall Street. I'm Nathan Hager, watching stocks surge and bond yields tumble off the back of an unexpected inflation slowdown. The October Consumer Price Index came in weaker than expected, raising bets that the Federal Reserve's aggressive hiking cycle is over and that rate cuts could begin as soon as the middle of next year, but really all month long, I should say. The stock market's been on a pretty decent run. We asked Nadia Lovell, senior U.S. equity strategist at UBS, what she needs to see to know that this rally has legs.
I think you need to see a healthy reacceleration in earnings growth. We are looking for that next year. We're looking for high single-digit earnings growth. But if you can get double-digit earnings growth, at the same time, you'll have bond yields coming down because inflation has come down, not because of a slowdown in growth, and you could see further upside to the market well above that 5,000 range.
And you can hear more from Nadia Lovell of UBS on the Bloomberg Surveillance podcast. Right now, the S&P 500 is up 2%, up 88 points, trading right at 4,500 now. The Dow is up 1.6% or 561 points. The NASDAQ is up 2.25% or 309 points. The Russell 2000 is up 5% at its highest level since September. 10-year Treasury is up 1 in 15/30. The yield 4.45%. 2-year yield 4.84%. NYMEX crude is up 0.8% or 66 cents higher at $78.91 per barrel. COMEX gold up 0.9%, up $17.20 at $1967.40 per ounce. The euro trades at 1.0859 against the dollar, and the yen is at 150.83. That's a Bloomberg Business Flash. Bloomberg Markets continues with Paul Sweeney and Matt Miller.
All right, Nathan Hager, thank you so much. We appreciate that. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Brokers studio. Looking at Facebook, or as the kids call it, Meta platforms, it's up 180% year to date, 52-week high. It's not an all-time high. That was back on August 31st of 2021 when it hit $379, but it's getting there. And boy, it's had some volatility the last few years. $380 down to $100, now back up to $335. Just crazy. What's moving this stock here? So let's check in with Mandeep Singh. He's a senior technology analyst for Bloomberg Intelligence. Mandeep, what's going on with this company? I thought it was just a steady Eddie revenue growth story, but the stock went 330 down to 100, now back to 330. It's crazy.
I mean, last couple of years have been a whirlwind in the sense their revenue growth really cratered. That was the time, everyone was really kind of objecting to their metaverse ambitions and how much money they are
that's right, the
losing. And this year, they've, all credit to how quickly they did an about turn in terms of focusing on that core business and really paring back on the metaverse, even though they're still losing north of $10 billion on that. But the revenue growth has come back in the core business, and they have done 3 rounds of job cuts. So this company has laid off almost 25% of its workforce, and top line growth has come back. So that's why you see shareholders reward that. But obviously, they have had a big change in their shareholder base because the stock was trading at close to $80.
Can they continue to innovate and grow, having cut so much of their workforce?
I mean, look, when you look at Meta, it's really a combination of the family of apps, and the engagement it has in terms of the overall time spent. And from that perspective, on an average, with the 2 billion daily active users they have about, north of 60 to 70 minutes per day engagement. That's the sort of engagement no other platform has. And that is what gives them the power to, keep growing that top line, is because of the engagement. They can keep layering ads. Now, those ads aren't as effective as they used to be because ad pricing has been going down for the last 6 quarters. So clearly, the advertisers don't view those ads as valuable as they used to, but there's no doubt that they still have the engagement and the attention of the users across the board.
Is all of that engagement that you're talking about on Facebook, or is it also including Instagram and WhatsApp?
Oh, yeah. Instagram and WhatsApp are the growing portions in terms of engagement. The Blue app clearly has stalled in terms of user growth and engagement, but it has kept its engagement. So it's not growing. But clearly, when you aggregate everything in terms of overall time spent in a day, it's by far the the app with the most engagement.
All right, one of my favorite functions on the Bloomberg terminal, Rich Go. Mark Zuckerberg of Facebook comes in at number 7, $119.2 billion. It's been a good year. That number is up $73.6 billion just this year alone. So pretty good to be Mark Zuckerberg these
Didn't
days.
he transfer like 95% of his wealth to a charitable foundation?
I don't know. Who cares? I
mean, he signed that pledge, but I don't think he has done that.
No, he's not giving any stock away. But TikTok. How competitive is TikTok to Facebook and some of the other digital media companies out there? Because, man, that's the rage, and we don't really have a good handle on it.
And that's why, for a while, everyone thought TikTok was eating their lunch in terms of engagement and attention. But what Meta has done really well is they've built a competitive offering, Reels, which is available on both their Instagram and the Core Blue app. And it's a $10 billion run rate business now. So clearly, not only have they develop video content, but they've been able to monetize it. And look, the Oculus bet, everyone keeps saying, they're losing money. But if the VR form factor clicks with Apple's launch next year, then Meta has about an 80% share in that VR headset market, even though they have a much lower price point than what Apple is coming
So
out
Mark
with.
hasn't stepped away from the whole metaverse as a, I guess, a new product. I don't know, I don't know what you call it.
Yeah, it's a new form factor.
New form factor,
Yeah.
okay. So he's not walked away.
He is not, and plus they have made that pivot to large language model and generative AI, and a lot of the open source investments in Gen AI are led by Facebook. So when you compare that with ChatGPT, that's proprietary, closed source. Meta is going more with the open source approach, which so far is helping develop an ecosystem around its LLM.
Is the metaverse idea, are they still into that? Like, are we going to eventually, like, plug ourselves into a machine in the closet and, like, live our lives virtually?
I mean, I look at everything with time spent and attention, right? So I mentioned how Instagram gets over 60 minutes a day per daily active user. Maybe a VR headset will get 10 minutes on an average per day or 20 minutes. But
Well, if I'm using it, then I'm going to go for an hour, right?
And the user base is going to be much smaller. So if Meta has about 2 billion daily active users, for VR, it probably is less than 100 million. But they can develop a following. They can appeal to a certain segment of users. Yeah.
Where's all these advertising dollars coming from? There's none left in TV and radio and billboards. I mean, where are they getting the advertising dollars?
So Meta has a very long tail of advertisers. They have over 10 million advertisers. Think of, all the mom and pop shops that can use Meta to advertise, on the platform across the family of apps. And they have a lot of Chinese advertisers. In fact, last quarter, they called out how these apps, Temu and Shine, they are spending almost, $1 billion or more on Meta to promote their apps, to develop their e-commerce. Yes, TikTok was one of the earliest advertisers that used Meta to really build their user base. And now you see these e-commerce apps, Temu and Shine, who are trying to build their presence in
Shine,
the US.
SHEIN.
Yes.
Yeah, I've heard of it.
You're hip to that?
I'm hip to it.
All right, nice.
I thought it was the Shineheart Wig Company, that owns...
Seinfeld reference?
No, it's a 30 Rock.
Okay.
It's a 30
I thought it was the
Rock
dental equipment maker, Henry Schein.
Yeah, no, that's also one that I was
another
confused with Jack Donaghy's employer. But no, Shine is like the kids use that, I think, to buy clothes.
Yeah,
like
and,
cheap.
and it's cheap, exactly.
Yeah.
So they fulfill the order directly from China.
I mean,
you
it's
don't
cheap
even have to
if
ship
you
it.
don't think about how the clothes are made, because then...
Since when do you care about that stuff?
Dude, I don't want some, 11-year-olds in a third world country, slaving over a sewing machine to make me clothes every day. I
didn't know, but
no, thank you.
Didn't know that side
no,
of
thank you.
Matt Miller. Mandeep Singh, thanks so much for joining us. Mandeep Singh, senior analyst covering all the technology space for Bloomberg Intelligence, joining us live here in our Bloomberg Interactive Brokers studio. Again, just a ripping move here for the last 12 months for Facebook, otherwise known as Meta. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Thanks, Paul. The hacking group behind a recent ransomware attack in the largest global lender, Industrial and Commercial Bank of China, said it received a ransom payment. A representative for the group called Lockbit, it confirmed the payment, but did not provide further details. Bloomberg News wasn't able to verify that claim. The breach blocks some U.S. Treasury market trades from clearing, forcing brokers and traders to reroute transactions. Grabbing a cup of coffee from Starbucks won't be easy on Thursday. Bloomberg's Steve Potisk explains why.
The chain's unionized baristas plan to hold their biggest strike yet, accusing the coffee giant of refusing to fairly negotiate. The one-day walkout involving thousands of employees at hundreds of locations is pegged to the company's Red Cup Day, when Starbucks gives out holiday-themed reusable cups.
Here's right now, they're up about 1.5%. Boeing continues its order haul at the Dubai Air Show. After closing a major deal with Emirates, the plane maker has landed an agreement with Ethiopian Airlines for 20 737-8 short-haul aircraft, as well as 11 787-9 Dreamliners. It also includes options to expand the order to as many as 67 aircraft. Now Airbus, they're struggling to keep up. They pulled in an order from Egypt Air for just 10 of its planes. Boeing right now up about 1%, Airbus right now up about 2%. And from planes to rockets, Elon Musk says the SpaceX Starship's regulatory approval should happen in time for a Friday launch. Now, he made the announcement on X, formerly known as Twitter. The rocket is the centerpiece of Musk's plan to take cargo and eventually humans to the moon and Mars. Those are company stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.